एवरीवन, गुड मॉर्निंग टू ऑल ऑफ यू। वेलकम वंस अगेन टू दिस लाइव एनालिसिस। स्टार्ट करते हैं। आज का सेशन 1:30 होने वाला है। लंदन सेशन इज गोइंग टू ओपन इन कमोडिटी मार्केट। इंडियन मार्केट सुपर बुलिश है। कल बाकी एक बिटकॉइन में एक ट्रेड लगाया था, ऊपर रेजिस्टेंस बने हुए हैं। ध्यान रखना बिटकॉइन में वो रेजिस्टेंस एरिया से 5 मिनट टाइम फ्रेम पे थोड़ी बहुत सेलिंग आई है। देखते हैं और गिरता है या फिर यहीं पर रुकता है। कमोडिटी मार्केट की बात करें, क्रूड ऑयल हल्का सा फ्लैट ही ओपन हुआ था, अपसाइड जा रहा है, फिर थोड़ा बहुत सेलिंग रेंज के अंदर ही फंसा हुआ है काफ़ी टाइम से। नेचुरल गैस भी कल सपोर्ट एरिया के अराउंड आया था, थोड़ा बहुत बाइंग, फिर साइडवेज हो गया था एंड अगेन वापस आ रहा है उस लेवल पे। फिर से देखते हैं, एक बार रिफ्रेश कर देता हूँ लेवल। डेटा की बात करें, आज कोई डेटा तो शेड्यूल नहीं है। लास्ट ट्रेडिंग सेशन इस वीक का, कल सैटरडे संडे मार्केट क्लोज्ड। निफ्टी, बैंक निफ्टी, सेंसेक्स तीनों ही बुलिस हैं। निफ्टी तो ज़्यादा बुलिस है, ऑलमोस्ट मुझे लग रहा है अपने ऑल टाइम हाई को एक बार फिर से टेस्ट करेगा, आज ही लग रहा है। ऑलमोस्ट इंट्राडे में, फ्यूचर में अगर देखोगे तो 130 पॉइंट के अराउंड पॉजिटिव चल रहा है स्टिल। ओवरऑल 150 पॉइंट की पॉजिटिव मोमेंटम निफ्टी में, निफ्टी फ्यूचर में, बैंक निफ्टी फ्यूचर में भी लगभग 400 पॉइंट का मोमेंटम है, सेंसेक्स में भी। देखते हैं ऑल टाइम हाई आज टेकन आउट करता है या नहीं करता है। 26,495 के अराउंड है, तो ज़्यादा नहीं, 50-60 पॉइंट ऊपर जाता है तो ऑल टाइम हाई बनेगा फिर से एक बार। लास्ट टाइम ऑल टाइम हाई हमें 28 नवंबर को देखने के लिए मिला था। क्वेश्चन रहेगा तो कमेंट बॉक्स में पूछ सकते हैं। बाकी 6:30 न्यूयॉर्क सेशन की ओपनिंग, 7 पी एम 8 पी एम यूएस मार्केट ओपन। और कोई डेटा रहता है तो विल सी दैट एज वेल, बट अभी के लिए कोई ऐसा डायरेक्ट डेटा नहीं है इसका इम्पैक्ट मार्केट पे देखने के लिए मिले। हॉलीडे के बाद हो सकता है मंडे से थोड़ा वॉल्यूम प्रॉपर आना शुरू हो जाए कमोडिटी मार्केट में भी। बाकी गोल्ड और सिल्वर फ्लैट बने हुए हैं अभी भी। स्पेशली गोल्ड को देखोगे ऑलमोस्ट फ्लैट ही है इंडियन मार्केट में। गैप अप जरूर हुआ था, उसके बाद से बिल्कुल फर्स्ट 15 मिनट की कैंडल के अंदर साइडवेज आप कह सकते हो। फॉरेक्स में थोड़ा बहुत लोअर एंड से बाइंग आई है, बट यहाँ पर अभी थोड़ी देर से साइडवेज ही बना हुआ है। सिल्वर भी थोड़ा बहुत रिबाउंड किया लोअर एंड से एंड लेट्स सी। परसों मैंने बताया था 15 मिनट एक टाइम फ्रेम पे रेजिस्टेंस है, वहाँ गया ही नहीं अभी तक। लेट्स सी वहाँ तक जाता है तो। बाकी नेचुरल गैस में से देखें तो लोअर एंड पे 15 मिनट में तो कुछ सपोर्ट है नहीं। 30 मिनट में और 15 मिनट में एक बड़ी सी, 30 मिनट में स्पेसिफिकली एक बड़ी सी कैंडल बनी है, मार्केट उसी के अंदर टाइम पास कर रहा है फिलहाल के लिए। लोअर एंड पे लिक्विडिटी है तो सही, थोड़ा सा अगर नीचे आता है परसों के लेवल पे 15 मिनट में, तो वहाँ पर लेवल शो नहीं कर रहे हैं एक्चुअली में। सो वी कैन एक्सपेक्ट यहाँ से एक वापस से बाइंग नेचुरल गैस में। 30 मिनट में देखना, 15 मिनट में दिखेगा नहीं उतना पीछे का लेवल, इवन पेड वर्जन में भी शो नहीं हो रहा है। तो नेचुरल गैस थोड़ा सा नीचे आता है तो इसमें बाइंग करेंगे। परसों वैसे ऑलरेडी वो नीचे सपोर्ट को हिट करके चला गया था, बड़ी सी कैंडल बना के ये, तो थोड़ा सा नीचे चाहिए हमें, बाइंग तो है एक्सपेक्टेड। नीचे आपका 310 से 315 के बीच में, या 312 से 316 के बीच में देयर विल बी सपोर्ट। परसों आ गई है ऑलरेडी वैसे बाइंग, अब देखना पड़ेगा थोड़ा सा और फिर से हिट करने जाता है उस लेवल को या नहीं। सपोर्ट अच्छा है। Oil price seen subdued between $55 per barrel to $65 per barrel. 55 to $65 in first quarter Q1. क्रूड ऑयल में देखोगे ना, नीचे एक सपोर्ट 5070 टू 5080 के अराउंड है, अच्छा सपोर्ट है वो। ऊपर देखोगे तो ये रेंज मल्टीपल टाइम टेस्ट हो गई है, बट अभी तक ब्रेक नहीं हुई है, तो स्टिल एक्ट लाइक एज अ रेजिस्टेंस। नीचे एक छोटा सा आप कह सकते हो कन्फ्लुएंस पॉइंट आ गया है, 5200 टू 210, ये जो ब्लैक कलर का बॉक्स ड्रॉ किया हुआ है। यहाँ से देखते हैं बाइंग का सेलिंग का ऐसा और कोई रेजिस्टेंस तो नहीं बना है, और ऊपर छोटा रेजिस्टेंस। तो बिटकॉइन को देखना, वो रेजिस्टेंस बहुत बार टेस्ट हो गया 5 मिनट में, मुझे लग रहा है शायद ब्रेकआउट के लिए जाने वाला है। बिटकॉइन अगर जाता है, अभी गया नहीं है, बट देयर चांसेस कि ब्रेकआउट करेगा शायद। ऊपर एक और रेजिस्टेंस है, कल का जो लेवल लगाया था बिटकॉइन में 5 मिनट टाइम फ्रेम बाय द वे। देखो, अगर अभी तो ब्रेकआउट हुआ नहीं बिटकॉइन में 5 मिनट में ये लेवल, लेकिन अब 4 बार टेस्ट हो गया इस लेवल पे। ये 5 मिनट टाइम फ्रेम है, अगर अब की बार ये नीचे आता है तो फिर मेरे अकॉर्डिंग आना चाहिए 87,850 तक। देखिए इस लेवल पे देखोगे रेजिस्टेंस को तो एक बार, दो बार, ये तीसरी बार यहाँ पर हिट हुआ है अर्ली मॉर्निंग, चौथी बार आ रहा है। तो हो सकता है इसको थोड़ा सा ब्रेक करके इस लेवल तक ले जाए, नहीं तो अगर यहाँ से आपकी बार सेलिंग आती है तो फिर नीचे आपका 87,900 के अराउंड एक सपोर्ट है। बाकी कल एक यहाँ पर सपोर्ट था 87,000, वहाँ एग्जैक्टली हिट तो नहीं किया, टच करते करते रह गया यहाँ पर ये। कल वॉल्यूम भी नहीं था वैसे। बिटकॉइन में जो लोग ट्रेड करते हैं 5 मिनट टाइम फ्रेम पे याद रखना है लेवल्स। क्रूड लुक्स लाइक थोड़ा सा मुझे लग रहा है शायद 5100 तक जाने वाला है। 5100 टू 110 एक्सपेक्टेड है, इस रेंज तक जाना चाहिए अब, अगर कोई स्ट्रॉन्ग पुल बैक नहीं आता है। यहाँ पर एक पॉइंट ऑफ इंटरेस्ट था, वो भी ब्रेक हो गया है। कैंडल ही सीधा ओपन इक्वल टू हाई बनी थी, ये भी एंड ये भी, तो चांसेस हैं थोड़ा सा पुल बैक कंटिन्यू होना चाहिए अनटिल अनलेस स्ट्रॉन्ग पुल बैक नहीं आता है। ठीक है, यहाँ पर भी एक आपका पॉइंट ऑफ इंटरेस्ट है हमारे पास, यहाँ से एक ट्राई हो सकता है। ये क्रूड ऑयल का थोड़ा सा ऊपर आता है, यहाँ से एक वापस सेलिंग का प्लान, और फिर टारगेट थोड़ा सा और बड़ा यहाँ तक। कि इंडियन मार्केट भी क्लोज होने वाला है। कंप्लीटली पॉजिटिव डे कह सकते हो इंडियन मार्केट के लिए। निफ्टी, बैंक निफ्टी, सेंसेक्स, ऑलमोस्ट एवरीथिंग इज क्लोज, क्लोजिंग ऑन पॉजिटिव नोट। स्पेशली निफ्टी फ्यूचर आज इंट्राडे में। ऐसी जनवरी में क्या हम एक नया हाई बनते हुए देखते हैं या फिर नहीं? बेस्ट रहेगा इस मंथ एक नया ऑल टाइम हाई बनाए मार्केट। आगे नेचुरल गैस भी साइडवेज ही हो गया बिल्कुल। 15 30 मिनट 40 मिनट 6 पॉइंट की रेंज। ये थोड़ा ध्यान रखना, निफ्टी बैंक निफ्टी में ऑल टाइम हाई की ओर जरूर जा रहा है, बट इट माइट पॉसिबल कि लाइक ट्रैप ना कर ले ऑल टाइम हाई पे, फिर से इन्वेस्टमेंट करने के बारे में सोचें और फिर ट्रैप करके बड़ा फॉल ना हो जाए। यहाँ पर क्रूड ऑयल में छोटा सा एक प्रॉफिट इसको बुक करना एंड यहाँ पर एक सेलिंग का देखते हैं प्लानिंग। डायरेक्टली सेल मत करना, ठीक है? अभी थोड़ा वेट करेंगे, कैंडल देखेंगे। ये तो कैंडल, हाँ ठीक है। ये कैंडल ओपन इक्वल टू लो है, तो ओपन इक्वल टू लो पे तो नहीं कर सकते सेल डायरेक्टली, वी नीड टू वेट इन क्रूड। लेवल के नीचे आनी चाहिए क्लोजिंग बेसिस पे। दो, 1 मिनट रह गया है, 2 मिनट 1.5 मिनट और है समथिंग। क्लोजिंग बेसिस पे नीचे नहीं आती है तो फिर थोड़ा सा वेट करना पड़ जाएगा, बिकॉज ये कैंडल ओपन इक्वल टू लो है, लेवल के अंदर क्लोजिंग बेसिस पे चले गई तो प्रॉब्लम क्रिएट कर देगी सेलर्स के लिए। सो वी नीड टू वेट, क्योंकि ओपन इक्वल टू लो बन रहा है रेजिस्टेंस पे, इट मींस कहीं ना कहीं रेजिस्टेंस पे बाइंग का प्रेशर इंक्रीज हो रहा है। वॉल्यूम देखते हैं। कि नहीं, कैंडल वॉल्यूम ही नहीं है। ठीक है, नहीं इसमें मेरे साइड से अब कोई ट्रेड नहीं है सेलिंग का, भाई वेट करेंगे थोड़ा सा। निफ्टी फ्यूचर भी क्लोजिंग होते होते अच्छा क्लोज हुआ है। कल देखते हैं मार्केट कहाँ ओपन होता है। गिफ्ट निफ्टी को ध्यान रखना, क्योंकि क्या गिफ्ट निफ्टी इंट्राडे मार्केट आज का क्लोज होने के बाद ऑल टाइम हाई के लिए जाता है या फिर नहीं जाता, क्योंकि अगर ऑल टाइम हाई के लिए चला गया तो पॉसिबिलिटी है मंडे को थोड़ा सा नीचे ही ओपन हो। अगर नहीं गया तब एक पॉसिबिलिटी है कि मंडे के दिन भी मोमेंटम रहे या फिर गैप अप हो जाए। गिफ्ट निफ्टी में नजर रखनी पड़ेगी ऑल टाइम हाई के ऊपर निकल रहा है या फिर नहीं। टाइम हाई से हिट करते करते ओनली फ्यू पॉइंट्स, फ्यूचर में तो सिर्फ 20 पॉइंट। करते रहो गाइस, इन लोगों ने लाइक नहीं किया, डोंट फॉरगेट टू लाइक द स्ट्रीम। लेकिन नेचुरल गैस में वॉल्यूम ही नहीं आ रहा बिल्कुल। लुक एट द कैंडल, 15 मिनट कैंडल इज इवन नॉट प्रॉपरली फॉर्म्ड।
So, what will Rachel Reeves's pivotal new budget mean for you?
Has an innovative think tank just come up with a solution for replacing stamp duty?
Hello, I'm Steph McGovern.
And I'm Robert Peston.
And we wanted to recommend you our podcast, The Rest is Money, where we answer questions like these to try and make sense of the UK's economy.
Look, we get it. You're a discerning sort of person. You're a Bloomberg listener after all.
So we're not going to waste your time. Here's why it's worth you searching for The Rest is Money in your podcast app or watching us on YouTube.
Twice a week, The Rest is Money tells you everything you need to know about the money matters affecting all our lives. Fiscal and monetary policy, housing, immigration, even the high street.
Yeah, we do conversations for curious minds. No dry discussions here.
That's why we speak to brilliant and fascinating people.
Yeah, recent guests include Dan Needle, Art Laffer, JP Morgan's Karen Ward, and even the Chancellor herself.
So why not give us a try? Search for The Rest is Money.
News when you want it with Bloomberg News Now. I'm Nathan Hager.
And I'm Karen Moscow.
Karen, we will have more on the markets as we kick off the first trading day of 2026, but we begin with a new era in New York politics. Zoran Mamdani is officially in office and will lead New York City for the next 4 years. We get more from Bloomberg's John Tucker. Good morning, John.
Good morning, Nathan. A 34-year-old Democratic socialist born in Uganda, Mamdani becomes the city's first mayor of South Asian descent, its first Muslim mayor, and the youngest leader of the metropolis of nearly 8.5 million people in more than a century.
The work, my friends, has only just begun. Thank you.
With no apologies during his inauguration, he laid out his agenda.
City Hall will deliver an agenda of safety, affordability, and abundance, where government looks and lives like the people it represents.
He detailed many of the campaign promises that earned him a decisive victory, including free child care and bus transportation, as well as a vow to freeze rent for tenants in stabilized apartments. And now comes the hard part. The price tag for his universal child care program may reach $6 billion a year, which would be funded through the imposition of additional taxes on corporations and millionaires. But any new tax increase would require approval from Albany and Governor Kathy Hochul, who has vowed not to raise taxes. And Mamdani's promise to freeze rents in the city's rent-stabilized apartments faces significant hurdles after the former mayor, Eric Adams, named 4 members to the board that sets rents in those units. And as a warning to those who believed he might moderate his positions after taking office, his inauguration featured speeches by 2 of the U.S.'s most liberal members of Congress, Representative Alexandria Ocasio-Cortez and Senator Bernie Sanders. In New York, I'm John Tucker, Bloomberg Radio.
All right, John, thank you. While rising healthcare costs are now a pressing issue for millions of Americans. As of New Year's Day, enhanced tax credits that cut premium costs for the vast majority of people with Affordable Care Act plans have expired. Democrats forced a 43-day government shutdown over the issue, but it wasn't enough to save the subsidies. Pangea policy founder Terry Haynes says he thinks lawmakers will find a way toward a solution.
You will see a lot of effort in the winter, maybe even into the spring, to battle between trying to keep the subsidies in place versus replacing the subsidies with some sort of alternative tax-favored account, whether it be an HSA, whether it be a health freedom account, as the president has talked about.
And that's Pangea policy founder Terry Haynes. But till then, the health researcher KFF estimates most Obamacare enrollees will see their premiums rise on average 114% this year. An analysis from the Urban Institute and Commonwealth Fund projects 4.8 million Americans will drop their coverage without the subsidies.
Let's turn to geopolitics now, Karen, because the U.S. is continuing to ramp up the pressure on Venezuela. Let's get the details from Bloomberg's Erica Herskowitz.
The Trump administration has slapped sanctions on 4 companies based in Hong Kong and mainland China with ties to Venezuela's oil industry. It's also imposed penalties on 4 tankers connected to those firms that it accuses of evading restrictions. This comes as the U.S. launches more strikes on purported drug trafficking boats. U.S. Southern Command says it hit 3 more vessels on Tuesday, killing 3 people. And it follows a CIA-led strike last week on a Venezuelan docking area that the Trump administration believes was used by cartels. Venezuelan President Nicolas Maduro says he's open to negotiating with the U.S. to combat drug trafficking, but he reiterated in a New Year's Day interview that the U.S. is trying to force him from power and gain access to Venezuela's oil reserves. Erica Herskowitz, Bloomberg Radio.
All right, Erica, thank you. President Trump pledged in a late-night social media post that the U.S. will come to the rescue of Iranian protesters if they're attacked by Islamic Republic authorities. The post comes after protests erupted this week in Tehran after the currency slumped to a record low. Demonstrations have since spread to other parts of the country, setting off clashes between civilians and security forces.
We want to turn now, Karen, to the latest on a tragedy in Switzerland. Officials there say about 40 people have died in a fire at a ski resort bar where partygoers were celebrating the new year. They estimate more than 100 others were injured after flames ripped through the bar at the popular alpine resort Crans, Montana. Swiss President Guy Parmelin says it's one of the worst tragedies his country has ever experienced.
Their lives should be honored for what they were. Promise, energy, a part of our shared future. We owe it to them to respect them. We owe it to their memory to make sure that such a tragedy never happens again.
That was Swiss President Guy Parmelin speaking through an interpreter there. Eyewitnesses tell French media a sparkler in a bottle ignited the ceiling.
Time now for the Bloomberg Sports Update, and we bring in John Stashower. John.
Thanks, Karen. A trio of college football playoff games starting with the Orange Bowl in Miami and a shutout win for Oregon, 23-0 over Texas Tech, who had 4 turnovers. The Rose Bowl in Pasadena was an easy win for Indiana, 38-3 over Alabama. Fernando Mendoza, the Heisman Trophy winner, only 2 incomplete passes. He threw 3 TD passes. And then the Sugar Bowl in New Orleans in a back-and-forth game, won by Ole Miss, 39-34 over Georgia. The Rebels broke a tie on a field goal with 6 seconds left. That's your Bloomberg Sports Update.
Thanks, John. And that's news when you want it with Bloomberg News Now. I'm Karen Moscow.
I'm Nathan Hager, and this is Bloomberg.
I'm Barry Ritholtz, inviting you to join me for the Masters in Business podcast. Every week, we bring you fascinating conversations with the people who shape markets, investing, and business. CEOs, fund managers, billionaires, Nobel laureates, traders, analysts, economists, everybody that affects what's going on in the market. Whether you own stocks, bonds, real estate, commodities, crypto, you really need to hear these conversations. Sometimes it's behaviorists like Dick Thaler or Bob Schiller. Sometimes it's fund managers like Peter Lynch, Bill Miller, Ray Dalio. Sometimes it's authors, Michael Lewis, author of The Big Short and Moneyball. Regardless of the conversation, these are the folks that move markets each week. That's the Masters in Business podcast with me, Barry Ritholtz. Listen on Apple, Spotify, or wherever you get your podcasts.
I'm Carol Masser.
And I'm Tim Stenovec, inviting you to join us for the Bloomberg Business Week Daily Podcast.
Now, every day we are bringing you reporting from the magazine that helps global leaders stay ahead.
We've got insight on the people, the companies, and trends that are shaping today's complex economy.
That's right, Tim. We're all over global business, finance, tech news, all as it is happening in real time. And we've got complete coverage of the U.S. market close. Gotta say, basically, if it impacts financial markets, if it impacts companies, if it's impacting trends and narratives that are out there, we are on it.
We also have a lot of fun doing it. Bloomberg Business Week also brings you the analysis behind the headlines through conversations with our expert guests.
And we are doing this all live each weekday. And then we bring you the best analysis in our daily podcast.
Search for Bloomberg Business Week on YouTube, Apple, Spotify, or anywhere else you listen.
Check it out on your way home from work to catch up on the conversations that you missed during the business day.
And on the weekend, check it out for a complete wrap-up of your business week.
That's the Bloomberg Business Week Daily Podcast. I'm Carol Masser.
And I'm Tim Stenovec. Subscribe today wherever you get your podcasts.
And the people doing it were very young and very ill-informed.
Kara Swisher, podcaster, author, someone who's been covering tech and Silicon Valley since the early 1990s.
Real serious wealth creates real problems for people. They isolate themselves in their wealth. They didn't have any safety thoughts in their brains. They never felt unsafe, and therefore they created systems that were easily abused and easily gamed, and they didn't care.
From Bloomberg Weekend, this is The Michelle Hussein Show. Kara Swisher first started watching startups in California as a journalist many years ago, when the idea that these companies would make any money at all was curious and frankly entirely unproven. That head start has meant that she's seen the entire trajectory of how Silicon Valley ended up producing companies that are cornerstones of the US economy today and really important to all of our lives. She has known all the key players from Steve Jobs to the present day, and she's built a reputation for being unafraid of what she says to them. Some of them are probably quite afraid of her, not that they'd ever admit it. But she's with us on the Michelle Hussein Show to talk about what she's seeing right now and what she thinks is around the corner. So here is Kara Swisher talking to me. Kara, you have seen the story of tech companies up close for so long.
Yes.
As a new year begins, tell us, therefore, what is on your mind and the areas or the people that you think we should be watching for the breakthroughs or the big moments of 2026.
Well, for this coming year, I think a lot of focus will be on whether big tech continues its hegemony, especially influence with Donald Trump. Obviously, the midterms are coming up here, and the tech industry has been running wild in the Trump administration, whether it's crypto, whether it's this recent executive order about AI, which will not hold up in court. But they've gotten what they wanted, and they've seen a huge run up in their stock prices because they're basically running the stock market. So a question of what will happen to valuations, whether there will be an AI bust, I think everyone will be focused in on. It has a lot of echoes to the internet crash, and it happened right after the new year then too, and sort of was a darker winter for tech at that time. So that's one question. The other is IPOs. There's a lot of possible IPOs coming up, whether it's Stripe or OpenAI or SpaceX and things like that, and that could really invigorate the tech system. And where are the valuations of those? But I think probably most people are focusing on whether AI will be a bust, whether it's a bubble.
So you are taking the thought that this could be an AI bubble seriously. You do not think that that's something we should disregard?
No, not at all. Why would you disregard it? You're being stupid. These build-outs are enormous. And the question is, where's the business behind it and how patient investors are going to be about it? It's not to say that AI isn't important and critical going forward, and it is the industry that is the next iteration or the next Cambrian explosion, but they may be ahead of their skis, right? With these too many data centers, too many back and forth deals. Feels a little round trippy in a lot of ways that are holding each other's valuations up. I think NVIDIA has an outsized role here, the way Cisco did, many in the first internet. So you're going to have to wait and see. If companies so far seem to be buying, and I'm not talking about just non-tech companies think AI is important, there might be a point where they're like, maybe we don't need to spend this much on this technology now to get the savings we need.
And is there something circular that's dangerous for the industry, which is that they need the IPOs to get the investment, to get money flowing in, but the IPOs and going public also puts further pressure on them and greater pressure on them to achieve the returns?
Well, they've done plenty well being private, like these valuations, and they're for sale. You can buy and sell stock, on the private market of these things. I mean, I think the most interesting IPO would be the SpaceX IPO, because I think it's $1.5 trillion. It didn't grow that much last year. I think it went from 13 to 15 billion. I think it's correct. So it didn't grow as much as, say, OpenAI did. But right now, not forever, it's going to own space. I think it's got 90% of the rocket launches here, some crazy number. So that's a separate IPO that's different. The only thing is related to Elon Musk, who also has to drag around Twitter and Grok behind him, and Tesla, of course, which even though the stock has managed to stay afloat, the business is disintegrating, at a very rapid pace.
He provided one of my most memorable, if toughest moments of 2025 when I had a long conversation with him.
I saw it.
Some of this certainly came up then.
Yeah, it's pointless to interview him right now. He's not there. He's there to be a troll. It's pointless. He doesn't say anything of any substance. He just makes things up.
And he avoids it most of the time, right? Other than in a very friendly setting.
Yeah, exactly.
I just want to get one bigger point before we pivot more into you, which is that, is there a lack of big enough ideas? I mean, Elon Musk has certainly had them, but overall, you have said recently that in a way the industry is below its potential, that people aren't necessarily solving the big problems of our age.
Well, there's a lot of promise with AI, right? I've just finished a documentary about health and AI, not just AI, but longevity. And AI plays a big role in terms of drug discovery. I was just at a lab in the University of Pennsylvania, and they're using it for vaccines. The problem is the Trump administration's cutting money to those places, and so they're all going to Canada. So that's who will benefit from this. But I think there's a lot of promise of where it could go, right, in terms of not just job destruction, but job creation, too, and all kinds of new and fresh ideas getting forward. The question is it fast enough, or is it more of a slow burn the way electricity was? Electricity didn't change everything overnight. And the question is, how do we adapt it? And I don't think we have enough imagination to know right now, because like at the beginning of the internet, when I started covering it in the early 90s, you didn't know there was going to be Uber or Airbnb or, Google didn't exist until almost the turn of the century. So we just don't know where this is going, but it's certainly promising. There's no question about it.
Take me back then to your own relationship with the industry, if you like. I was struck by the words in your book where you characterized it as a meet-cute love story that turned sour. Let's do the love story then. Do you remember sending your first email? Do you remember the first key internet moment you had?
Yeah, when I downloaded a Calvin and Hobbes comic collection on a university server. I was at Duke, and I messed up because at the time you didn't have that much speed. And so the person who was running it was at me because I clogged it up. But I was like, I downloaded a book. And he was like, so what? I'm like, so what? Everything can be downloaded. I remember thinking everything that can be digitized would be digitized. And then my imagination took off. Like, what else can be digitized? Well, my entire workplace, when I looked around, and there was still paper there. Like, what's paper doing here? Why do we need paper? Why do we need phones on the desks? Why do we need to be at the desks? Why can't we be on the move? And I was a very early user of cell phones. I was a very early user of a lot of this stuff. And some of it was silly, but most of it, you could see it shifting and changing how we work and live. And so it was really like probably being around when the car or plane was invented, right? Like, wow, like, whoa.
Would I understand you correctly if I say that I think that you loved the products, the technology, the promise of the technology, some of the products, but you weren't convinced by a lot of the people even early on? I think lots of people you're sitting with when you end up moving to Silicon Valley and they're making these big promises, we're going to change the world. Some of them do, a lot of them don't.
Right. I think very early on, one of my first articles when I was at the Washington Post covering AOL, right, because it was in the area, it was a local company. But when I moved to the Journal, where I really started covering these companies in the 96 period of time, this is 1996, kids, it's way in the last century. But when I started doing that, it was very clear, one, that these were groundbreaking technologies, and number two, the people doing it were very young and very ill-informed. And so what was striking to me, and one of the first stories I did for the Journal was, I think it was the top 10 lies Silicon Valley people have told me since I got here. And one of them was, we're in this together. The other was, we don't care about money. It's all about community. There are no titles here. It was all a lie. They all were very monarchical. They'd have hoodies, but they'd be like cashmere hoodies. There was always such a disconnect. We don't care about those things. And of course, every one of them ended up with a private plane and a private chef. I mean, look, real serious wealth creates real problems for people. They isolate themselves in their wealth, essentially. And so you could see the warping of them right from the get-go, or as it was starting, because they love to tell lies about things. Most of them were harmless at the time, but later not so harmless.
But you would call them lies, not just hype. You would say they were saying things that were not true.
No, they believed it. They were lying to themselves. I had covered other industries, and no one ever, they had an evangelical bent to them, right? I suspect it was probably like this when you had the founders of Hollywood. They started it. And so they really had a real belief system. The finance guys were just like, we're here to make money. I was like, okay, got it. Thank you. Like, essentially, they weren't there to change the world. There was a lot of discussion about changing the world, and it was very religious almost. It became increasingly religious. And it's not religion like Catholicism, having studied propaganda for years, it felt a lot like that. I did that at Georgetown, like watching propaganda move. And then when they had the tools of propaganda, which was to weaponize and exploit information, well, then the story changed really quickly.
Who do you mean, Cara, when you say they?
Oh, Zuckerberg. You know, someone who had built a worldwide network of information, and largely on other people's ideas sometimes, although we give it to him. He's sort of like Bill Gates in that regard. Although Bill Gates became a better person, and I have great hopes for Mark Zuckerberg someday. But, you know, this sort of idea that it's really good that we let people do whatever they want and give them all the information and there's not going to be a problem. It was a naivete and an ignorance of history, of everything else, and a pretend that it wasn't his fault. You know, I'm sorry I made this gun. I didn't know people would get shot by it. Like, it's not my fault people get shot by my guns. I'm like, but they're designed to shoot people. Like, several different interviews showed that, really, that I did with him over the years. He doesn't speak to me now.
I know you had a couple of exchanges with him that were really striking for different reasons. Yeah. I remember the period in 2011 when the Arab Spring happened. I did a documentary called How Facebook Changed the World.
Yeah.
I slightly cringe when I think about the title of that now, because at that time, social media we saw it as benign at that time. It was connecting people who were not being connected in other ways. 2016, the US election, it's a different story by then.
Right.
Which is why I wonder, perhaps it is not all their fault. There is something of the gun argument that the technology was also used in nefarious ways, albeit it obviously always had that potential.
The fault would be our regulators who decided to let them do whatever they wanted. They have a product that has a lot of safety issues around it, and they never wanted to address any of it, and nor did anyone force them to. So you could blame citizens, I guess, if we could have risen up against them, and that just doesn't happen. But our legislators never made a move around privacy. I mean, I used to write about this I did an Internet Bill of Rights. Here's 10 things that will not stop innovation and are important for the safety of consumers. You could have seen this stuff coming. Like, it wasn't like it was that hard to understand propaganda. You know, you could just study Hitler, study Mussolini, study any of the autocrats. There's a playbook that's really quite robust over the many centuries of humanity. So I think that they didn't have any safety thoughts in their brains. They never felt unsafe, and therefore they created systems that were easily abused and easily gamed, and they didn't care. Like, if you designed a car with this many lack of safety features, you know what happened to the car industry. They had to put seatbelts in. They had to put airbags in. That's not to decry the car. Some people don't like cars. I happen to. But, you know, I think it's safer with seatbelts and airbags. And I'm sure the people in the car industry would have preferred not to put that in. It's a big cost. So they just didn't care about the consequences. And I've never seen an industry without any regulation whatsoever and have caused us great harm. That's all. I just compare it to other industries. All those other industries would do the same thing. If pharmaceutical companies are allowed to pollute rivers, they certainly would. They have. There's histories of that. Watch Aaron Brockovich, you know, like they just do it until they can't.
How do you think you changed in this period of covering the industry? Did you yourself have massive belief at the beginning? Clearly a lot of enthusiasm because you saw the potential.
I love technology.
Did you become cynical along the way as you saw some of these characters? I mean, there were others, weren't there, like Steve Jobs?
He actually thought about safety. He thought about privacy. He thought about, like, he was an adult. So when you said it to him, he didn't act like you had, like, stuck him in an eye with a dry stick. You know, he could have a discussion about it. That's why, I guess it's a low bar. But, you know, every time you say something tough to Mark Zuckerberg, he looks like you killed him. Like, oh, how dare you say this to me, sir? If you study technology history, electricity had plenty of problems with safety. Every single industry has this tension. It's just that they're the richest people on earth with the most expensive companies, and it's going to be very hard to pull them back, especially because they're being facilitated by a president who openly accepts donations. And I'm using that donations is doing a lot of work there. Who was part of the system. They've made $5 billion, the Trumps, in cryptocurrency over the past couple of months. That's pretty good.
When you lived in Silicon Valley, which you did for a long time, and your former wife was at Google, you socialized with the founders?
No.
You were at the same parties?
There were a lot of work parties. Yes, they weren't my friends. I mean, maybe one or two became friends, but I can't think of, way lower down. But we didn't hang out and, you know, massage each other's feet or anything. But I knew them really well, and they were accessible, and then they weren't, obviously, a lot of them. Some of them were, some of them weren't. I worked for the Wall Street Journal by this time, so they really wanted to know me because they were building their businesses, and the more they could interact. At the time, the Journal could make, like Walt Mossberg could make or break products, right? If he said, I didn't like this, I did like this. I was under no illusion that they were my friends, though, I have to say, and nor did I want them to be.
He was a legendary columnist who was also a mentor to you, and you worked together.
A partner with me. Right, exactly. So when you think about the change, I just interviewed Sam Harris. The tech guys loved him. I would say he has not changed. They have changed, and he is calling them out now. Like, Sam Harris was all mobbed up with those people. I mean, they liked him. They liked his work. And he just kept saying, what you're doing is incomprehensible and heinous. And then they got mad at him for being normally critical, which is what he was of everything. Same thing with Yuval Harari, who wrote Sapiens. They couldn't get enough of Sapiens and Yuval Harari. Then he wrote a book that said these information systems are not unlike the propaganda from the Middle Ages that killed a lot of women. And then they're like, what are you talking about? So I don't think Yuval, myself, or Sam have changed. They have changed.
There does seem to be a common thread of being very thin-skinned.
Yes. Well, you got the big one. You got Elon.
But you did think he was different, I think, early
I did,
on.
and he was. Let me say, I feel like that's the one I got wrong, completely wrong. Not completely wrong, no. Because, look, what Tesla did was astonishing. Same thing with SpaceX. He was the earliest person I talked to artificial intelligence. Now, it's been around. Artificial intelligence has been around from the 50s. But he was the first person to talk about the importance and danger of it. First person I talked to about it in Silicon Valley. So until his most recent personal toils, which I think have been well reported, I think he had a vision that was big. And then who knows what happened? The hatefulness, the obsession with trans people, the drug use, everything else just got out of, I don't know. Howard Hughes comes to mind when I think of him.
So let's go more into then politics and the relationship with the president. Is that political expediency? Is it a version of, okay, it doesn't take just a donation now, you've got to show up to the inauguration, You've got to sit round the table while the president talks about you. Is it expediency the way tech has behaved, or is it a fundamental belief that Trump is good for business?
Both. I would say both. I think they don't mind doing it. They kind of like it because they don't like being insulted by the press. The press is such mean to me. Like, when they say mean to me, I'm sort of like, are you 12? Like, I'm asking critical questions. So what? Wake up. Like, I think one of the things is they get to do what they want when they want to do it. They're a little like, I want it now, like from Willy Wonka, if you remember, Veruca Salt. It's like a bunch of Veruca Salt. I want that squirrel right now who tests the nuts or whatever. They just want it now, and they want it, and so they're willing to stand there. Now, a lot of them do think the Biden administration wasn't as pro-tech, and they have some argument to be made, but the reaction is a massive overreaction, right? Oh, I didn't get invited to the White House. Oh, really? Like, that was Elon's entire shift to Trump, was I didn't get invited to some stupid car summit that the Biden administration had. I mean, really, he went on and on about that. That's the last bunch of communications we had. I was like, calm the down, dude. Like, what's the deal? But I get it. It was an overreaction. But then they saw someone willing to take their money in a more explicit way, either through cryptocurrency or sweetheart deals. I mean, Tim Cook, Steve Jobs would have died, would never have brought Donald Trump a golden statue, not on any planet Earth that I would know of. He would be happy to talk to him. Steve often engaged with people he didn't like or he had difficulty with, like Rupert Murdoch, and he talked a lot because he was hoping to shift him a little bit in some way. But the idea that you could bring someone a gold statue and then get a tariff break, I mean, they'll do it. I wouldn't do it. Maybe you wouldn't do it, but they'll do it because they think shareholders win overall. And so I'm not surprised by any of it.
How much of what's happening now do you think is about the influence of Peter Thiel, who was in a pro-Trump position for a much longer time?
He always was.
Yeah.
Not even before that. He was conservative for a long time. No shift from him. He's the same.
But is it partly his influence behind the scenes or the people he's helped bring up, like J.D. Vance, for example? Is there a link from that to the roots of the political
Vance is
connection?
an unusual character because he was so anti-Trump. I was in the presence of him where he was insulting Trump so much one time. I said, you know what? He does have some good characteristics. If I'm the one saying, don't be so mean to Trump, you know, it's like something's awry.
What year was that? Do you remember?
Oh, when he was working for Steve Case, I think, years ago. He was in tech. he's a different character, who I just don't understand in any way. I mean, I do in some ways, given his background. But I think one of the things that's interesting about them all is that they have become like Peter was always like that. And if you read his old books, it's not unsimilar to what he did in college. He did some, very conservative from the get-go. A couple of them were also conservative, I would say. Some of them, I didn't even know what their politics. Mark Andreessen, I had no idea what his politics was. He dabbled wherever his interest was. Some of them are just doing it for expediency. I would say Tim Cook, he doesn't want tariffs, so he'll do what it takes. He'll do the minimum, but he'll do it. Or Sam Altman. I think the problem is when anyone gets in their way and then someone gets out of their way, they like the person who gets out of their way more than they should. And I guess if that's your only value, sure.
You mentioned Sam Altman. I wonder whether you see anything different in the younger generation of tech leaders. I talked to Mustafa Suleyman of Microsoft the other day, who is
He's really smart.
Smart and resolute about AI needs to serve humans. And does that give you some hope for the future of the industry? Is Sam Altman in the same sort of category?
I don't know, because Sam Altman has also exhibited a lot of stuff that's troubling, like the same stuff, right? And I like Sam personally, and he certainly does respond, but he's going to do anything it takes to make OpenAI win. He's incredibly aggressive. And so, he's in a jam because Google has decided to be Google again and is really coming on hard with Gemini. And OpenAI, what I always say, and I think he hates it every time I say it, but is OpenAI Netscape or Google? Which one? Because that Netscape, which was started by Mark Andreessen and others, really was it until it wasn't, right? Until Microsoft came and mowed them down. And so that may be happening to OpenAI right now, even though it's the most popular by far. These things, the planes are covered with the bodies of tech pioneers.
Isn't it, Cara, because the industry moves towards dominance, right? There was a time when there were so many browsers, and now that is largely Chrome, Google Chrome's market.
There's also the cost now. The cost of starting, you couldn't have started an Uber now. It would have been owned by Google. Jeff Bezos would not have been able to start Amazon today because the cost with the compute power, it's just so money losing. I mean, internet companies used to lose money and then some of them made money, but now they really lose money. Like it's trillions of dollars. It's kind of, you sit there and you're like, whoa, they lost that much every quarter and they're still doing it. And the question is, if you're saying someday we're going to get to California and own California, that's a good thing. So let's spend anything it takes to get there. But only a few of them are going to get there. That's the thing. And then they're going to be so big that we won't be able to control them, which we already can't, actually.
I do have a very clear memory of interviewing Jeff Bezos in 2000 or 2001.
You're right, when he was
selling books, they were doing well. And he said, I'm going to make Amazon a portal where you can buy anything on it. And I sort of did not visible, but sort of the equivalent of an eye roll, thinking I just can't see that day. Well, anyway, he knew I didn't. But the point about dominance, do you think that it's unlikely that there will be a world where there's a market for ChatGPT and Claude and Google Gemini and Microsoft Copilot?
No. They do the same thing.
Does only one of those four survive ultimately?
Yeah, they do the same thing. They're not that different. I think what'll be interesting is the LLMs that are specific to industries, right? If you create your own. Like I was just on a portal, I'm working on this medical documentary that a company has of my medical information, which I can't believe I let them have it, but there it is. And it's actually very helpful. It's more helpful than the doctor, and it's accurate because it's based on my information and available scientific information, which is mostly, they're using LLMs that are true, right? They're very selective in terms of the information they download into it. And so once you start using this stuff on a one that works and isn't hallucinating and isn't too solicitous, it's like Google on steroids, right? A really helpful Google.
Which one do you use?
I use ChatGPT, but I try them all. I think Claude is quite good. You sort of start to get in the usage of something like you did with Google, and then you don't go. At one point, Microsoft's search engine was quite good. It just didn't use it because I use the other one, right? I use Google. So I think you get into a habit. And that's the hope of ChatGPT is they can stay ahead enough in order to, but it's hard to beat Google at being Google, right? I don't know. It seems like they've got all the cards, including YouTube and some other businesses.
What about spatial intelligence? Is there a lot of focus on large language models and many of us miss this other dimension. Fei Li was, obviously, she really believes in that.
She's great. I love her. She's amazing. She was one of the early people I talked to about, too, because she was doing ImageNet. But I think a lot of people aren't paying attention to robotics as much. If I had to say one thing I'm going to pay a lot of attention to this year, it's robotics all throughout the world. And the thing is, unfortunately, Elon has hijacked this with his stupid robots, that have to run. And, you don't want a robot to run. You want a robot to walk the dog, but does it have to look like a human? No, it could be a box. You have to be more creative in how robots are going to enter our lives in ways that are not as if we're on Lost in Space and, warning Will Robinson. That's how our conception is, our popular conception, that it has to look like us. It doesn't. And so I think years ago I went to an Amazon warehouse, and they had just bought a company called Kiva. And I thought, oh, wow, they're a logistics company now. They're a robot company. Because these little Kiva robots were moving all these things around and then putting them in the most unlikely ways. But it was all mathematical, like why there was shampoo next to a book by Sheryl Sandberg next to this. But it knew. I didn't. A human couldn't do it. But it did. And it was so much more efficient. And I thought, oh, they were trying to show me how many people were in their warehouses, and I'm like, you're not going to need any people here. I could see the day of no people. And they're like, no, that's not true. And I'm like, oh, totally. You're going to go for no people, right? That's where you're headed. And so I'm fascinated with robotics and replacing just almost everything.
You mentioned Sheryl Sandberg, which reminded me that you...
Remember her?
Yeah. Well, I wonder how you see her now, because I know that you had conversations with her about, she was obviously one of the few women in tech and really prominent, and she wrote Lean In. And then in Sarah Wynne Williams's recent book, Careless People, there's a very different picture that emerges of how supportive or otherwise the company really was of women having a family. Sarah Wynne Williams is off on long business trips while she's still breastfeeding and being told that the answer to being a working mother is to get a Filipino nanny.
Well, it'll be interesting historically. I had a lot of sympathy for Sheryl, and then I didn't, I guess. As you say, some of the stories in the book weren't exactly right, but I do agree with the careless people idea, is that Sheryl and Mark were careless people, and they didn't seem to care about... They would do this a lot, like, oh, don't worry about it. And I'd be like, I'm worried about Russians and bot farms, and I'm worried about information being cleared up so that we don't understand anything. And I'm worried about propaganda. And they'd be like, oh, don't worry about it. And that was the famous interview I had with Mark, where he said, Holocaust deniers don't mean to lie. It was so striking for that level of ignorance to be at the head of this company. I think Sheryl did go along with him. She went along to get along, right? And I think a lot of people place the blame on her, and I would put it on him more than her. But she was certainly right next to him doing these things, and certainly could have mitigated it, or maybe she couldn't. Right? I don't know. I wasn't there, but she certainly could have left and said something, but she didn't. So,
do you think you learned from your time in Silicon Valley in terms of the startup mindset? Because you've had a really successful business of your own.
I still am.
Yeah, early adopter of podcasts, and you've owned that space and events. What did it teach you that you took away?
I think I was probably like that before, because I was always a difficult employee. People would tell me things and I'd be like, oh, you're such an idiot. You've been in that situation, I'm sure, right? You're such an idiot. Except I started to say it, right? I was like, oh, geez, did that just come out of my mouth to an older white man? Oh, well, too bad. And so I just decided I was better on my own to make or break it for myself. And I actually turned out I had some good business sense of what audience wanted. I also do think I was, as I was early to cell phones or using the internet or using email. I think I was one of the first people at the Washington Post to put an email on my stories because I wanted to hear from readers, which the other writers like, why do you want to hear from them? I'm like, I don't know, maybe they're smart or something. But I was willing to do that stuff. And so I already had a risk profile that was probably higher than other people. And then I think I really did see the coming destruction of media as I started to cover the internet. We had a classified business at the Washington Post, and it was expensive. The people were rude that took the ads, and it didn't work. And that was one of the big pillars. And I was like, the internet, the digital age is going to change this so easily. It's going to bring down the prices. You don't have to talk to anyone, and it works. And it doesn't cost anything. Like, it was so obvious to me at the time. And I kept having those moments. Like, there was a teletype machine at the Washington Post that I wanted to knock over. I was like, what is this doing here? And they're like, just leave it alone. I'm like, but we shouldn't be getting everything from paper. We should be getting it on the internet. It went on and on like that. And then I realized I was a nuisance. And I think probably I learned being a nuisance is a positive thing from this. It's okay if you're a nuisance. And, you know, in a lot of ways, Jeff Bezos was a nuisance. And I mean that as a compliment, not today, but back then. Why are we doing it like this? And I think I got the courage to do that and then could see the coming decimation of media. So I wanted to be on my own. But I also saw ways to make money, too. Like, it didn't have to be a doom story of media. You could control it your own way. And so I just kept shifting, and that's what I do.
And we have the word podcasting from the iPod and Steve Jobs.
Yes, the iPod and broadcasting.
Which is obvious when you say it.
Pods. I remember him saying it. I don't think he was the one that actually did it, but he said pods, broadcasting, pods, broadcast. And I was like, oh, I was sitting there. I was like, yes, of course. I got interested in that because the relationship between myself and my phone got rather intimate. And I thought, oh, if you're listening to people on these things, you have a parasocial relationship, which I think I do with my listeners, you know, in a lot of ways. And I just liked it better. And I remember being in a subway in San Francisco, and I usually had always a white tech guy coming up to me, or occasionally a group of Indians or Chinese tech guys. They're all tech guys, right? Tech guys were always my fans. And they'd come up and say, oh, how is Walt, or whatever they would say. I had a group of young African-American women come up to me after I started doing my podcast. And it was over YouTube. It wasn't over YouTube, but whatever. It was over Apple and Spotify, I guess. And they said, we love this, and we love when you did this, and we love when you said that to that guy. And they had started a business. They were entrepreneurs. I think it was a nail business, but for women of color. And they were telling me all about their business. And, oh, we liked when we learned that. And I said, oh, are you reading my website? And they go, website? Do you have a website? They listen to the podcast. And I thought, oh, it's over. I'm going to just do podcasting.
So you realized at that moment you were reaching this whole other group of people who...
It was, but it was a real relationship. Like, I finally had reached the reader. There's a lot of top down with media rather than on the same level. I like my audience.
So can I cheekily ask you for some advice then? I'm the opposite of the early adopter because I've spent most of my career in broadcasting and now I'm in this space. What should I do?
One, make something that is useful to people. And I don't mean like, here's a list of 10 like quiches you should make. Maybe you do that. I don't know. But something it has to be useful to people. The second thing, it has to be interesting. And it could be funny. It could be mind-blowing, whatever. It has to be interesting. And the third is you can't get it anywhere else. Like, it can't be copied by AI. It can't be copied by anything. If you have those three things, you tend to do really, really well. But figure out what you really love to do all day. And if it happens to be in a broadcast setting, you do have to be in a studio. But this is in my house right now. I have a teleprompter. This cost me a couple $1,000s to set up. I got nice lights over here. So do I need CNN or / whatever? Do I need a studio? Not really. I could do a broadcast from here. I think I will. I'll be Walter Cronkite. This is now.
As long as there is still an audience for any of that, as I think we've established through this. Yes, I love what I'm doing.
That interview with Elon, I really was admiring of it. I was like, well done. You weren't going to win, but well done. You know,
I survived. Maybe that's the most important thing.
You know what? He's impervious. It doesn't matter. You can't talk to you can't do a good interview with a toxic narcissist. You can't. Like Donald Trump, you can't do one. It's impossible. What are you going to do? Wrestle him to the ground? I mean, seriously.
Does he ever reach out to you these days?
Elon? No. At some point, I bet he will. Maybe not.
Let me end where we began, Cara, and to say a new year. How about you in this new year? Do you have a New Year's resolution? Do you do such things?
No, I don't. One year, someone said, "What's your New Year's resolution?" I said, "I hope it rains more." And they're like, "That's not a resolution." I'm like, "No, I like rain and it's good for the earth and I hope it doesn't rain too much." And they're like, "That's a bad resolution." I'm like, "I think it's a great resolution. I like being in the rain. So why wouldn't I want more of that?" But I'm spending, I've just finished this documentary series for CNN and I'm more interested in the topic, which is longevity and the uses of tech to keep everybody healthy, not just the rich people. I think we're at a cusp of really saving a lot of lives from cancer and stuff like that. And including mental health. So I think I'm going to start talking about the possibilities and the life after Trump, life after this ugly, nasty period, which has been fueled by social media, absolutely been fueled. And let's leave that behind. I'm kind of in the K-pop demon hunter zone right now because I have small children. I have big children and small children. But you listen to it. Go see that movie. Have you seen it?
No, I haven't.
You need to. Look at me. You got to go see K-pop. There's something in the spirit of that movie, and I believe in cultural shifts and people cultural affecting society, and that's what that movie is about, actually, in a broad sense, because the characters are trying to create a golden dome over people. It's wonderful. It's a wonderful spirit, and I hope we move into that spirit. That's where I'm going to focus. I'm going to focus on the things we can do to improve people's lives, versus arguing with people who could care less about people.
Kara Swisher, Happy New Year. Thanks for talking to us.
Thank you. You too.
I'm Barry Ritholtz, inviting you to join me for the Masters in Business podcast. Every week, we bring you fascinating conversations with the people who shape markets, investing, and business. CEOs, fund managers, billionaires, Nobel laureates, traders, analysts, economists, everybody that affects what's going on in the market, whether you own stocks, bonds, real estate, commodities, crypto. You really need to hear these conversations. Sometimes it's behaviorists like Dick Thaler or Bob Schiller. Sometimes it's fund managers like Peter Lynch, Bill Miller, Ray Dalio. Sometimes it's authors, Michael Lewis, author of The Big Short and Moneyball. Regardless of the conversation, these are the folks that move markets each week. That's the Masters in Business podcast with me, Barry Ritholtz. Listen on Apple, Spotify, or wherever you get your podcasts.
News when you want it with Bloomberg News Now. I'm Nathan Hager.
And I'm Karen Moscow.
Karen, we'll have more on the markets in a moment as we kick off this first trading day of 2026. But we begin with the new era in New York politics. Zoran Mamdani is officially in office. He will lead New York City for the next 4 years. And we get more from Bloomberg's John Tucker. John.
And Nathan, a 34-year-old Democratic socialist born in Uganda, Mamdani becomes the city's first mayor of South Asian descent, its first Muslim mayor, and the youngest leader of the metropolis of nearly 8.5 million people in more than a century.
The work, my friends, has only just begun. Thank you.
And with no apologies during his inauguration, he led care program may reach $6 billion a year. Believed he might moderate his positions after taking office. His inauguration featured speeches by two of the U.S.'s most liberal members of Congress, Representative Alexandria Ocasio-Cortez and Senator Bernie Sanders. In New York, I'm John Tucker, Bloomberg Radio.
All right, John, thank you. While rising healthcare costs are now a pressing issue for millions of Americans. As of New Year's Day, enhanced tax credits that cut premium costs for the vast majority of people with Affordable Care Act plans have expired. Democrats forced a 43-day government shutdown over the issue, but it was not enough to save the subsidies. Pangea Policy founder Terry Haynes says he thinks lawmakers will find a way toward a solution.
You will see a lot of effort in the winter, in maybe even into the spring, to battle between trying to keep the subsidies in place versus replacing the subsidies with some sort of alternative tax-favored account, whether it be an HSA, whether it be a health freedom account, as the president has talked about.
That's Pangea Policy founder Terry Haynes. But till then, the health researcher KFF estimates most Obamacare enrollees will see their premiums rise an average 114% this year. An analysis from the Urban Institute and Commonwealth Fund projects 4.8 million Americans will drop their coverage without the subsidies.
Turning to geopolitics now, Karen, the U.S. continues to ramp up pressure on Venezuela. We get the details from Bloomberg's Erica Herskowitz.
The Trump administration has slapped sanctions on 4 companies based in Hong Kong and mainland China with ties to Venezuela's oil industry. It's also imposed penalties on 4 tankers connected to those firms that it accuses of evading restrictions. This comes as the U.S. launches more strikes on purported drug trafficking boats. U.S. Southern Command says it hit 3 more vessels on Tuesday, killing 3 people. And it follows a CIA-led strike last week on a Venezuelan docking area that that the Trump administration believes was used by cartels. Venezuelan President Nicolas Maduro says he's open to negotiating with the U.S. to combat drug trafficking, but he reiterated in a New Year's Day interview that the U.S. is trying to force him from power and gain access to Venezuela's oil reserves. Erica Herskowitz, Bloomberg Radio.
All right, Erica, thank you. Well, President Trump pledged in a late-night social media post that the U.S. will come to the rescue of Iranian protesters if they're attacked by Islamic Republic authorities. The post comes after protests erupted this week in Tehran after the currency slumped to a record low. Demonstrations have since spread to other parts of the country, setting off clashes between civilians and security forces.
Well, now, Karen, we want to bring you the latest on a tragedy in Switzerland, I should say. Officials say around 40 people have died in a fire at a ski resort bar where partygoers were celebrating the new year. They estimate more than 100 others were injured after flames ripped through the bar at the popular alpine resort Crom, Montana. Swiss President Guy Parmelin says it is one of the worst tragedies his country has ever experienced.
Their lives should be honoured for what they were. Promise, energy, a part of our shared future. We owe it to them to respect them. We owe it to their memory to make sure that such a tragedy never happens again.
With Swiss President Guy Parmelin speaking through an interpreter, eyewitnesses tell French media a sparkler in a bottle ignited the ceiling.
Time now for the Bloomberg Sports Update, and we bring in John Stashower. John.
Thanks, Karen. A trio of college football playoff games starting with the Orange Bowl in Miami and a shutout win for Oregon, 23-0 over Texas Tech, who had 4 turnovers. The Rose Bowl in Pasadena was an easy win for Indiana, 38-3 over Alabama. For Fernando Mendoza, the Heisman Trophy winner, only 2 incomplete passes. He threw 3 TD passes. And then the Sugar Bowl in New Orleans in a back-and-forth game, won by Ole Miss, 39-34 over Georgia. The Rebels broke a tie on a field goal with 6 seconds left. That's your Bloomberg Sports Update.
Thanks, John. And that's news when you want it with Bloomberg News Now. I'm Karen Moscow.
I'm Nathan Hager, and this is Bloomberg.
I'm Carol Masser.
And I'm Tim Stenovec, inviting you to join us for the Bloomberg Business
Markets move fast. Get the insights you need in 10 minutes with Barclays Brief, a podcast from Barclays Investment Bank. Each week, our experts analyze market themes, helping you anticipate what's next. Listen to Barclays Brief wherever you get your podcasts.
You can get the news whenever you want it with Bloomberg News Now. I'm Amy Morris.
And I'm Karen Moscow, here to tell you about our new on-demand news report delivered right to your podcast feed. Bloomberg News Now is a short 5-minute audio report on the day's top stories. Episodes are published throughout the day with the latest information and data to keep you informed.
Yes, there are other products like this from a variety of news organizations, but they usually rerun their radio newscasts throughout the day. That's not what we do. We create customized episodes that can only be heard on Bloomberg News Now.
And we don't wait an hour to publish breaking news. When news breaks, we'll have an episode up in your podcast feed within minutes, so you're always getting the latest stories and developments.
Get the reporting and the context from Bloomberg's 3,000 journalists and analysts. We're all over the world. Listen to the latest from Bloomberg News Now on Apple, Spotify, or anywhere you listen.
Bloomberg Audio Studios. Podcasts, radio, news.
Hello and welcome to another episode of the Odd Lots podcast. I'm Joe Weisenthal.
And I'm Tracy Alloway.
Tracy, we were down in D.C. several weeks ago. We were at that IIF conference, and we had a great meal when we were in town.
We did indeed.
It was a really good meal.
Yeah, we went to a place called Butterworth's, which is getting a lot of buzz, has been getting a lot of buzz for a while, and sort of serves, I don't want to say farm to table, because that's not really it, but like an emphasis on organic, maybe like rarer cuts of meat. I remember we had bone marrow.
Which you love.
I love bone marrow. The first time I ever ate bone marrow was at an all-you-can-eat buffet in Las Vegas. And it wasn't even the best bone marrow, but like I ended up with a mountain of empty bones on my plate.
I think both of us like sort of rich, fatty food.
Well, I always say it's like sucking the life force out of an animal.
I love
it's
it.
Animal essence.
We had really good fries, which famously, and we'll probably get beef tallow, no seed oils, very hip these days. I'm pretty sure we had something with foie gras, which I love. I seem to recall there was some left on the plate, and I was like, does anyone want this? Can I take this bite? Can I take this bite? I cannot resist foie gras. Anyway, it was a really good meal. I love doing restaurant episodes or talking about the food industry, because if you want to understand the economy, both in the sort of short term, like where we are in the cycle with food costs and labor costs and how free spending people are, they're a great snapshot. And at any given time, they're just this perfect combination of labor costs, inputs, and rent, which is like the whole economy there.
There's also the supply chain issue, right?
Yes.
And we did that whole episode on Cisco, the dominant food supplier to restaurants in America. I doubt Butterworth's uses Cisco for obvious reasons, but like where they actually source their ingredients is a really interesting topic.
Right. This is what I was going to say, which is that like they're this perfect combination of the snapshot at the moment and then the big structural things of how the economy works across the cycle. So I really like restaurant episodes.
There's also an interesting cultural element in this. And like everything is cultural and political nowadays, including the restaurant business. Because Butterworth's has been described as a sort of right-wing MAGA hangout. So we should talk about that too.
Yeah, I'm fascinated by the DC scene because I was like, oh, they're like Democrat bars, Republican bars. Do they mix?
You got to declare your political allegiance before you walk in.
It's so, and actually there's something really profound here because I feel like this is happening to brands of all types, right?
Yeah.
Is this the right coded brand or the left coded brand, et cetera? But in DC,
people have to choose sides.
You have to choose sides. But anyway, it's funny, because we were there and our producer, Kel, is like, we should go to Butterworth's. I was like, oh, there's the MAGA restaurant. Great, I want to check it out. But when you go in, it's not like there's, you wouldn't know it. Let's say from the inside.
People aren't wearing red hats and stuff.
But you would never know it at all. You would never, like, at least the night we were there, I didn't see any, like, White House notables that I recognized, although apparently they do hang out there from time to time. But it's not like designed. It looks just like a very nice, normal restaurant, a great dining room. So
there is a bit of a clubhouse element to it. We should talk about the overall design because it is pretty unique as well.
Well, when I tweeted, I was like, oh, we had a great meal at Butterworth's on Twitter. All these people respond because, apparently, whatever. Anyway, it made the connection with the chef. and owner of the restaurant, Bart Hutchins. We really do have the perfect guest, therefore, to talk about Butterworth. We're going to be speaking with Bart Hutchins. Bart, thank you so much for coming on the Outlaws podcast.
Yeah, thanks for having me, guys.
What's a MAGA restaurant?
Oh, God, where do we start?
Do you think of it, when you see in the media, it's like, oh, this is like, do you conceive of it the same way that it's written about? What does that mean in your head?
So the history of restaurants more or less doesn't include DC. Like when we think of the great American restaurants, they happen sort of in LA or they happen in New York. And so you think about like Spago in the 80s, I guess. And what people talk about when they talk about Spago is like this actor was there, that actor was there, whatever. And then when you talk about the great restaurants of New York, you talk about this model ate there, this actor ate there, this bank person ate there, this like important person ate there. And so in DC, the version of that, now that sort of politics or pop culture, is like what politicians are eating at these restaurants. And that sort of becomes what you're known for. And so early on, we were on the Hill. And so we developed a following among the new administration that came in like 2 months after we opened. And so now it is a MAGA restaurant because that's like an interesting way to talk about the restaurant because they're there. And so it's this like your notability is like who's in the dining room. And so early on, we had a lot of customers from the administration, from like Scott Bessent to Mark Rubio, Steve Bannon, whatever it may be. And so as that sort of developed, it became the MAGA restaurant. But like if we did what we did at Butterworth's well in New York, it would be like I don't know, if we did it somewhere near Wall Street, it would be like the Wall Street restaurant. So I'm not entirely like it'd be like,
Yeah. But just one quick thing, follow up. When anyone launches an establishment in D.C., do they have to sort of think about this question of sort of which side will be aligned with this restaurant in terms of like the market opportunity?
No, it's relatively new. It was a binary sort of in the 70s, 80s, 90s of like you had political customers or you didn't.
Oh.
Right. So there was a very famous restaurant in downtown DC in the 70s called Sans Souci. It was like this French restaurant. And all the administrations went there, all these things. And Mick Jagger showed up one day and he wasn't wearing a proper sports coat, so they kicked him out. But it was a political place. Like you had to look like you sort of belonged there. And so there was political restaurants or non-political restaurants. And it was a lot about proximity and how close you were to these various buildings. But this like declaring everything sort of right or left is very new and odd.
Okay.
I want to go back to something you said. I'm kind of surprised that Washington, D.C. didn't develop more of a food scene, given that, I think about it as a political city for obvious reasons. A lot of politics is about, being seen with the right people and appearing important. And so it's kind of surprising to me that it didn't develop more of these like seen and be seen restaurants.
Yeah, it's strange. When we started the place, this was sort of explicitly an aim. Like the dining room is designed to not hide anyone, right? Like you will be seen and be seen. Like there's no hiding place. That was a big part of the business model because I was looking at Spago and a couple other places in New York from the 80s and thinking through that process. I think maybe the answer to DC is like it was more of a house party thing. And there's always been sort of like the gentlemen's clubs and the private clubs. And like the Georgetown scene was you bring in a chef and do a party at your house. Like it was always like behind closed doors. It's a very like the smoke-filled room thing exists for a reason, right? Like DC is a town that likes to hide itself.
Huh. Yeah, it is interesting to think like you read stories about DC and all the legendary things that'd be like some editor at the Washington Post or something like that were famous for their cocktail parties and everyone was there. So it is true. It does feel like the places where people congregated did tend to be these more like private entities. Just one more question, though. It is not quite true that it's like, oh, you opened the restaurant before the new administration and they started out. I mean, one of your co-owners, I think, was like affiliated with Breitbart UK. I mean, there are
Mr. Butterworth.
Yeah,
it's named after him.
There are political roots to the restaurant, right?
Totally. I mean, this is part of being in DC. We have 6 investors. I think 2. The third one I would have to ask because he's like a tech bro. So you never know where they align. But 2 of them are pretty solidly like classic libs.
Okay.
And a few of them are pretty like MAGA adjacent conservatives. I will say the one you're talking about, Raheem Kassam, he used to work with Steve Bannon, was the Breitbart editor in London, has done a lot of work with the administration. One of our investors, when we opened the place, you sort of invite all your friends and family, and that's how you sort of get the business going. And it turns out he was just way better at it than the rest of us, right? So like the first night we were open, there's like 60 reservations, and I'm pretty sure like 45 of them were from Raheem. And so the MAGA thing did sort of generate in that way.
How difficult is it to get investors for a restaurant business in general, but also specifically in DC?
Yeah, it's like it's a terrible investment, right? Like if you're listening to this for financial advice, don't do it.
Yeah, they say never open a restaurant, and I imagine they also say never invest in a restaurant.
Right. So if you're looking to make money off an investment, never invest in a restaurant. If you're looking to sort of build for yourself a place to be, to always have the good table, to invite your friends, to have something to talk about at dinner parties, it's one of the best investments, right? Like there's nothing more interesting than sort of like what's going on, and there's nothing more convenient than like not having to host at your own house and to be able to say, oh, like come to my restaurant, sit at my table. That part of it's great. But as a business investment, it's like the worst, especially post-COVID. Like the margins are a joke.
Let's talk about the menu. I mean, the whole team came. Everyone loved the meal. Like, how do you go about the process of sort of conceptualizing the overall menu, a goal for the menu?
Yeah. So ours specifically is working with farmers. So I have a host of farmers that I've been working with as a chef for, I guess, a decade now. And most of them are the sort of Pennsylvania Amish and Mennonites, these sort of not technologically plugged in folks. And so I get a call from them on Mondays. They go, this is sort of what's coming out of the ground this week. These are which animals are being slaughtered. Which ones do you want? And then those products come in and the menu is based off of that, which sort of doesn't really allow you to have the same dish on the menu every single day, which is a classic sort of trope of the restaurant industry. If you're like in culinary school or whatever, they'll sort of say like consistency is super important. You should have the same dish prepared the same way every time, because if it becomes somebody's favorite and they can't come get it next week, they'll be super mad and they'll stop being your customer. But what that does is sort of create a sort of leans into a global supply chain where you have to have bananas every single day if you have a Bananas Foster.
Yeah.
But like bananas are not growing year round unless you're willing to sort of go across the globe. And then you're dealing with shipping and the product's not as fresh and all of these sort of problems. So what we do is we work with these farmers, and whatever's coming out of the ground at that time is what we're doing. And so in the summer when there's a ton of tomatoes, we're getting all the tomatoes in that we can. And what we're not selling and using, we're canning to make tomato sauce in the winter when there's no tomatoes. Like that's a really sort of good way to work around not having produce in the winter. But other than that, we're sort of obligated to and constrained by what's actually coming out of the ground at that time.
Is it true that you don't serve burgers because you don't want everyone to just go into the restaurant and order a burger all the time?
The burger conundrum is
the burger conundrum.
The burger conundrum is the bane of my existence. So I had a restaurant 3 blocks from Butterworth's years ago called Buchert's. It was a lot like Butterworth's but smaller, and we did a burger because it's good money at the time, and it quickly became like one of those like, oh, this is the best burger in DC, really popular burger. And so then you do this like really interesting dish with pheasant or, whatever, and you work really hard on it and you're so excited and you can't wait for people to try it. And then you sell 30 burgers in a night and then you're done. And so the problem with the burger is not that it's bad economics or that it's a bad dish. I love burgers as much as anyone. The problem is if you do it well, it's the only thing you become capable of selling. Because it's so self-explanatory and it's so desirable. And so if you want to sort of work with all these products, if you want to be able to like sort of sell bone marrow, or you want to be able to sell these game birds, or you want to be able to sell this weird vegetable, you can't have a burger because it just dominates the entire menu.
This actually reminds me of the podcast industry, right? Because often like some of our best episodes, I would argue, some of our episodes that get the best feedback come in lower in terms of downloads than some that I am not such a fan of.
No, this is really interesting. I'd never thought about this. If you have any, I guess, signature item, it has this crowding out effect. The moment you have a great burger and it gets on the bus, and it's like, oh, we all show up, oh, got to order the best burger in DC because we're here. Then what is the point of invest? I had never thought about this phenomenon.
The curse of
the curse of the burger, but how it's like, okay, what about all this other great stuff that we have?
Audience capture for ground beef.
Business Podcast. Every week, we bring you fascinating conversations with the people who shape markets, investing, and business. CEOs, fund managers, billionaires, Nobel laureates, traders, analysts, economists, everybody that affects what's going on in the market. Whether you own stocks, bonds, real estate, commodities, crypto, you really need to hear these conversations. Sometimes it's behaviorists like Dick Thaler or Bob Schiller. Sometimes it's fund managers like Peter Lynch, Bill Miller, Ray Dalio. Sometimes it's authors, Michael Lewis, author of The Big Short and Moneyball. Regardless of the conversation, these are the folks that move markets each week. That's the Masters in Business podcast with me, Barry Ritholtz. Listen on Apple, Spotify, or wherever you get your podcasts.
Okay, so you talk to the farmers in Pennsylvania, et cetera. How does it get there? Who are the entities that actually deliver the food, and how built out is that? Who are these companies and so forth that actually make this distribution happen?
So I'm a psycho, and I try to avoid the quote unquote larger supply chain at all costs. So the actual way that the produce and most of the meat gets to the restaurant is a literal Amish guy with like a hat and the beard and everything shows up at 7 8. He's like one of the few people that has the key box code to the restaurant, because he refuses to be in DC during the day because there's too much traffic and it's too loud, he says.
Fair enough.
So he comes in early, comes in the restaurant, drops it all off. We show up, it's there. For a lot of restaurants, it is sort of Cisco and a couple other really large companies that are doing this procurement, and then a huge tractor trailer shows up, and these are sort of commoditized and like they're pretty standard across the industry. But if you want to break out of that, you're dealing with like a guy with a Ford F-150 and a trailer.
I know you said you had these farmer relationships from your previous experience as a restaurant owner, but how do you actually go about finding and identifying potential suppliers, especially in the Amish and Mennonite community? Because, you know, I imagine they're not necessarily posting ads online or something like that.
No, they have a landline that they're only allowed to use in the barn for one of them. So in the earlier days, now that there's sort of an economy for this because the farm to table thing happened. But in the early days before that was sort of an industry of it in and of itself. The trick was you would go to farmers markets, like actually the same one that you would go to on a Saturday morning or whatever. And you would talk to the farmer and you would sort of say like, hey, these carrots are really good. I have a restaurant. I want to buy 80 pounds of them every week. Can I get your contact information or whatever it may be? And then for a lot of those, if you see your favorite farm stall at the market on Saturdays disappear, it's because of enough of us are buying their stuff to where they don't have to deal with that anymore.
It's your fault.
It's my fault.
I didn't know that.
Yeah.
So there's farmers markets in my neighborhood in the East Village. I love going to a farmers market. Actually, I never really thought about farmers market economics before, but how much are farmers markets in general about the revenue that they make there versus like building some of these connections such that they have more, a place to be seen by potentially commercial clients?
Yeah. You should definitely, next time you're there, ask. But my understanding is that if you're at the farmer's market, you're sort of at the beginning of your cycle as a new company, a new enterprise, or the end. And so, there was a farmer that I bought from a long time who did pigs up in Illinois, and now I'm working with a closer distributor in Virginia. But the last time I saw him, he was at the farmer's market, and he was like, yeah, this is the only outlet I have to sell things anymore. Like, we're on the way out. We're done. We're closing up shop. We're selling the farm. And so that's sort of the cycle is either they're trying to build an audience so that they can do this wholesale process, or they're sort of like, this is their last leg, because it's not a great economic model. Like being at a farmer's market it's like small potatoes for them.
I know you said that the ingredients and the menu construction was influenced by seasonality, so what's in season at any given time. But how much does price actually influence your decisions? So, if a farmer comes in and says, trying to think of an expensive thing, foie gras, I have the best foie gras in the world or something like that, but it's really, really expensive, would you still buy it? Do your customers care about price?
Oh, boy. They do.
Sorry.
No, they do. I've been thinking about this a lot. So I was, it's the end of the year, so I'm doing numbers and all those things you have to do when you have investors. And I was looking at the price of French fries specifically, and we've been noted for the French fries and the beef tallow fries and the best fries in DC and whatever. And I think they're on the menu right now for $12 an order. And I was looking at an old menu of mine from a restaurant in 2019, and they were on the same fries. I've been making the same fries forever. They were on the menu for $9 an order. And I was like, wow, they've, really gone up. $12 is kind of expensive for an order of fries. Like, is there any room for this? And I started sort of digging into the price of goods and the labor involved, and realized that, like, if I wanted the same sort of margins on that $9 order of fries that I have on my now $12 order fries, they would actually be $25.
Wow.
So, like, we've just sort of like the cost of goods is like eviscerated sort of the margins on that. And we found other ways to make it up in different areas of the menu or with private events or whatever, catering, whatever it may be. But chefs are not inclined to, at least like chefs that are in the kitchen every day are not inclined to think about the price of goods because they want the best product. Like they'll sort of stretch their own margins to get the better product. If you're eating at a restaurant where like the chef is named on something, you're getting the best product no matter what it costs because we're just psychotic and obsessive in that way. Because they tend to be more artists than like economists, right? So they want the thing to taste as good as they can, specifically because other chefs are going to come in and eat and be like, this is that doo-doo foie gras from Cisco or whatever. And why are you serving that? And it's really embarrassing for you.
Wait, do you have specials at the restaurant?
No, because we change the menu every day. So the special thing is sort of like designed to allow you to keep the same menu year round and then like do the seasonal thing on the weekends or whatever.
Oh, I see. Well, maybe you could this is just a general question. I think like everyone who read that Kitchen Confidential became really like cynical about specials. It's like, oh, this is just how the chef gets rid of the fish that's about to go bad or whatever. Can you clear up some misconceptions or like how real is that? I don't know. That book made me, I read it in high school. You know, a high schooler loves a book like that, but like, or maybe early college, but like it makes you very cynical about a lot of decisions. And this comes out and it's like, oh, this is just a plate of like tomatoes with vinegar and they called it something fancy. Like how real is that phenomenon?
Yeah. So two things. Number one, in his second book, Anthony, in his second book, Medium Raw, I think it was called, he totally regrets writing that essay. He's like, this has been detrimental to the restaurant industry. I was an idiot. I was really mad. I'm sorry I wrote that. It's not true. So the funny thing about Anthony Bourdain, and he wasn't like a good chef. He was like a very normal run-of-the-mill chef. He was a great writer, a really good media personality. But like, if he lived in Columbus, like he would be the chef of an Applebee's. Like it was a very like medium the road.
Oh,
like
that's so mean.
A workman. God, that's gonna get clipped. I'm gonna look like a jerk. But like, he would say that himself. Like he wasn't like a grand sort of haute chef or whatever. He was a workman. He was a journeyman, and so. That is true at that level. It's totally true. And all of it's still true to this day. Like if the fish is starting to go bad on Friday and you're at one of those restaurants, they are going to toss it in some vinaigrette and put it on a salad on the brunch menu. That's 100% going to happen. But the bar, since that essay was written in the 90s, or I think it was the 90s, the bar for chefs, and because of the whole foodie revolution of the mid-aughts, the lowest level of like chef is much higher than it was then. Like there's fewer and fewer journeymen. And there's more and more people who are into it because they're like obsessive about the products and sort of artistically minded in that regard. So if you're eating at a restaurant that's not a chain, I wouldn't worry too much about that stuff because if anything, they're more inclined to throw it out before you would even notice because they're just sort of like they would be ashamed if they sold a piece of fish that smelled bad.
Yeah.
In defense of Anthony Bourdain's cooking ability, his cookbook is really good. And he has an awesome recipe for lasagna and then a whole like schedule for doing Thanksgiving dinner, and I follow those religiously. Although I will admit they're basic recipes in some sense. They're not particularly creative, but they're great and I rely on them. Anyway, you mentioned the importance of chefs in a restaurant like this. How competitive are restaurants when it comes to getting the best chef?
Extremely. It's like when we were opening Butterworth's, I would go stand out back of restaurants that I liked where the sort of dumpsters were where people might take smoke breaks in hopes that I could talk to the cooks and steal them. So we trade talent and sort of fight over talent in an extremely competitive way. So much so that there's like serious feuds over it across cities like in New York, DC, and LA. There are chefs who hate each other because they steal each other's cooks. Particularly if you have like a really good fast dishwasher and I can have one dishwasher instead of two, I'm going to take your dishwasher.
Wow. Can I ask you, so the night that we were there, after I tweeted we were there, and I think maybe it was via DM, and you're like, oh, I'm glad you enjoyed the meal. I think we had sort of an off night or something like that. What does that mean, like an off night or from the perspective of the chef? Because it certainly seemed like a very busy night, et cetera. Our food was excellent. In your mind, when you say, you know what, we kind of had an off night, what does that mean to you?
It can mean a few things. That night specifically, it meant it was very busy that night, but the busyness was not spread out. It wasn't like, there's a table at 6:15, then another table at 6:30, then another table. It was every single table came in at the exact same time. And so what happens then is all your production lines get screwed at the exact same time. So then there's a huge wave of cocktails and the bartender's rushing through all the cocktails because all the cocktail orders came in at the same time. And then it moves to the kitchen and the kitchen's rushing through all the orders because they all came in at the same time, instead of sort of like being super purposeful and like, okay, I have 10 minutes to do this one and then the next one's going to come in and then the next one's going to come in. They all come in at the same time. So you're rushing through it. And as a result, like things get sloppy. And so that night specifically, I watched the rhythm of the restaurant and everyone came in at the exact same time. And I could see the kitchen getting backed up and tickets were a little slower than I would like them to be. And some of the plates, like I was like, ooh, I wish we had plated that a little bit differently. I wish it was a little neater here. And so when that happens, reservation systems are mostly designed to do that. Some of them are designed to fit as many people in as they can and good for them. But most reservation systems are designed to slow down the number of people who are coming in so that the dishes and the drinks and whatever it may be are done well and done intentionally. And when there's like a huge swath of walk-ins on any given night, that's when the sort of like the production capacities of a kitchen or a bar get sort of backlogged and they get sloppy.
Tracy, it sort of reminds me a little bit of like our conversations that we talk about electricity and grid, which is the difference between total throughput and peak throughput, right? And so, you know, you want an even distribution and the problems come on that one really hot day or whatever. And so spreading the demand out is also a very important consideration in sort of optimal grid design.
Only you would compare the restaurant business to electricity grids, but it makes sense. I agree. Since we're on the topic of reservations, one phenomenon of living in a foodie city is that you have restaurants where it's very difficult to get a reservation. And I'm thinking specifically of Carbone. I would love to take my husband to Carbone one day, but my impression of the process to get space there is that it's so difficult, it's basically not worth it. And in fact, in New York, you now have reservation auctions, people selling platforms.
There are these, one, I forget which app it is, where you can get a reservation fairly easily if you pre-commit to a minimum spend. So it's like you pre-commit to like a $300 spend or whatever.
$300 worth of garlic bread
and then
Carbone.
Anyway, so...
First of all, how do I get a reservation at Carbone? What are your tips? And then secondly, what do restaurants think of these like very intense competitions for seating in the restaurant?
Yeah. Number one, this is mostly David Chang's fault. So I hope he knows that this is entirely his fault. Momofuku Ko was this his like sort of Michelin starred restaurant. I think it's closed now, but it was the first one that I knew of at the time that did this. Like, there's no way around the reservation system. Like, you have to log on exactly 2 weeks before, and you have to sort of win the lottery. There's this famous story about how his parents couldn't get a reservation for the first year because he refused to sort of break out of this system. And so used to, you would like know somebody and you would shake hands and you would sort of get a reservation and whatever. And this like super scarcity model sort of produced this like this reservation thing to some extent. So how do you get a reservation? A lot of them are now designed to not have any workarounds, right? So like knowing somebody's not going to help you, because if you interfere with that scarcity model, you interfere with the entire system. And so your best luck is to sort of be online at the right time when they go live. Some reservations book a month out, some book a whole year out, some book 1 week out. So understanding exactly where you are in that process and when those dates unlock is sort of where you want to be. Most of these systems are sort of automatically ran by OpenTable or Resi. And so they're pretty standardized. A lot of them are midnight. I think Resi's midnight, and I think OpenTable's like 2 a.m. So understanding that might be helpful. Other than that, there's just like not a lot of ways around it anymore because of this sort of scarcity model that we have to maintain. That being said, knowing the owner would help. So go meet the Teresi brothers, have them on the podcast, and then see if they can get your reservation. That might do it.
There's an idea.
Very ethical.
Yeah. You mentioned David Chang. I just remembered some friends of mine back when David Chang had his food magazine, Lucky Peach.
Lucky
Do you remember
Peach.
that?
Yeah.
It closed down in like 2017. But they used to do dramatic readings of Lucky Peach. We'd sit there and, you know, someone would read it out loud in a really dramatic fashion. And it was hilarious. It was so much fun. I need to do that again.
I think that sounds very fun.
I love Lucky Peach. I still have every issue. I still have it like.
Oh, really?
Yeah, it's like a complete set.
Those
it's
are
like
probably valuable now.
You know what? They might be actually.
Those were the good old days. We need a new Lucky Peach. I want to talk a little bit more about the labor market. So you talked about the intense competition for chefs, but also, you know, there's the competition for a really high-skilled dishwasher. I kind of have like a two-part question, which is like right now, we're recording this December 17th, like, how does the competition for sort of more everyday restaurant labor, like what does it look like? And I'm also curious, restaurant kitchens, I suspect, are sort of disproportionately draw from the immigrant workforce, probably in many restaurants, a lot of undocumented immigrants. I'm curious if you see any effect from that, and just to the extent that there is a restaurant ideology, or that, and I associate, obviously, as sort of the crackdown on immigration or the reversal of unrestrained immigration as part of the signature moves of the current political environment. Could you talk a little bit about how this all looks from the perspective of someone who has to staff a restaurant?
Yeah, I mean, there's an arms race to some extent, right? Which is like, traditionally, the restaurant industry has drawn from this undocumented labor market, and there's obviously less and less of those each day right now for a multitude of political reasons. And so the good restaurant workers that are left are becoming incredibly scarce. And so there's huge incentives. If your dishwasher comes and asks for a raise, you just give it to him, because you finding another one, like training a new person who's never done it before, whatever it may be, is going to take you months, and the cost will just work out to be exactly the same as giving the one you have a raise. And so the market on cooks is, sort of, when I started out, the cook and dishwasher sort of level of the staffing, not the management level, but below that, the average was like sort of $2 or $3 above the minimum wage. And now it's like it's close to double now, right? Like, so the DC minimum wage is creeping up to 15. And I think our average cooks and dishwashers are like 26, 27 an hour. And so that market is becoming harder and harder to staff, because there was decades of sort of training this undocumented community on how to do these tasks. And now all of that sort of like human capacity, all of that training has been pushed out. Mm-hmm. And so for the ones who are documented, the ones who stayed, or whatever it may be, their prices and their value are skyrocketing, because there's just less and less of them. And that time that was spent training, whether it was at sort of at an Applebee's or a restaurant like mine, or whatever it may be, those years and years of training are becoming harder and harder to find. You can't just like replace that in 6 months. Like, you can't teach with a dishwasher, maybe with a cook. I can't take a guy who works at Dunkin' Donuts or whatever and train him to be like a French line cook in less than a year. It's going to take a long time to get him sort of to where he can do things to order and be useful.
And I'm Tim Stenevec, inviting you to join us for the Bloomberg Business Week Daily Podcast.
Now, every day we are bringing you reporting from the magazine that helps global leaders stay ahead.
We've got insight on the people, the companies, and trends that are shaping today's complex economy.
That's right, Tim. We're all over global business, finance, tech news, all as it is happening in real time. And we've got complete coverage of the U.S. market close. Gotta say, basically, if it impacts financial markets, if it impacts companies, if it's impacting trends and narratives that are out there, we are on it.
We also have a lot of fun doing it. Bloomberg Business Week also brings you the analysis behind the headlines through conversations with our expert guests.
And we are doing this all live each weekday. And then we bring you the best analysis in our daily podcast.
Search for Bloomberg Business Week on YouTube, Apple, Spotify, or anywhere else you listen.
Check it out on your way home from work to catch up on the conversations that you missed during the business day.
And on the weekend, check it out for a complete wrap-up of your business week.
That's the Bloomberg Business Week Daily Podcast. I'm Carol Masser.
And I'm Tim Stenevec. Subscribe today wherever you get your podcasts.
One notable thing about Butterworth's is it's in a really cool building, like a historic building, and the decor is really nice. Joe knows that I'm into interior decorating. So, you've got the antler chandeliers and the sort of plush seats and all of that. How important is the vibe of the restaurant to the overall business?
Massively important, right? Like, I think these days I spend as much time thinking about lighting and volume level and like spacing out of seats and whether or not you can hear the person you're talking to and that stuff as I do about the food.
Wow.
Because there's this sort of arc that started in the foodie thing sort of started in 2008 with the housing crisis and the real estate bubble. And so all of a sudden, all of these young, ambitious chefs could afford to go open a restaurant, and they hired cooks beneath them. And they trained those cooks. So we got a sort of a wealth of good cooks and good people that went on to be chefs. And so that foodie thing that we saw in the mid-aughts produced a ton of really good food. Like we were better off because of it.
Yeah.
But now sort of real estate and those things are back to where they were in that way before that. And so now your competitive advantage isn't just that your food's good, because good food is easier and easier to come by. Like you can find a good chef in any neighborhood.
It's everywhere now.
But you need a competitive advantage because rents are sort of back to where they, were or whatever. They're very incredibly expensive right now. And so we have the best food in town. It like doesn't work anymore, right? So like you have to combine the best food with a comfortable place to hang out, or with a specific social scene, or with a whatever it may be.
You mentioned lighting. When you think about lighting, how much is it about the experience of the diners that night versus lighting for Instagrammability or TikTok or whatever it is? And how do you think about the fact that part of eating is creating social content? And how does that factor into your strategy and thinking about the overall vibe?
So I think a lot about it. And you saw this again with that sort of like the foodie thing. The restaurants were incredibly bright, and this Scandinavian minimalism thing was a trend at the time, but also lent itself to Instagram and like posting and taking pictures.
I hate minimalism. I
can't stand it. But it lent itself to sort of photography and those sort of things incredibly well, because you had these bright natural light restaurants and you could sort of photograph something top down in a way and it would look really good on Instagram. And so to say I don't think about it or I don't want to be a part of that is not true, because what I'm actually trying to do is the exact opposite, which is like our food photographs terribly. If you have photos on your phone from that night, they probably look awful. But it's a reaction to that thing, which is like, I want to feel like something sort of before that date or something sort of more classic or more timeless than that. The rule of thumb, I worked for this really good restaurateur named Brendan, who's down in Florida now. So if you're ever in Destin and you find a good restaurant, he probably owns it. But his rule of thumb was if it's too bright to reasonably get away with giving a hand job, then it's too bright in the restaurant.
That's not what I thought you were going to say,
but that is a good rule of thumb. It's good to I'm gonna start paying attention to that.
If you tell that to your staff, they never forget. Like you'll never come into Butterworths and it'll be too bright, because they won't forget that one.
Thank you for changing my restaurant experience forever. There's a really good breakfast place in Connecticut that I like to go to. The food's amazing. The service is excellent, but the decor is terrible. It's like gray vinyl flooring and just white walls. And every time I'm in there, I'm like, they should let me redecorate. I would do it for free just to enjoy it a bit more.
And Tracy, you know how much I loathe the degree to which the built environment has been designed for. Like, you've heard me like rant about millennial pink and all of these design cliches.
Like millennial pink.
I know, but these design elements that are just so clearly designed to be a backdrop for someone's Instagram, and the way our whole real life has been reoriented for social photography, it drives me crazy. And I do appreciate anything that just like, this looks like the pre-iPhone era. You know what I'm saying?
Absolutely. One thing I wanted to ask is, we talked about the clientele earlier, and, you get some well-known people into the restaurant. Do you try to like directly publicize that or like monetize that? If Steve Bannon comes in for the first time, what do you do?
So it's actually the exact opposite. And on some level, I'm grateful that the media at large has done this for us, because it's, as a restaurateur, it's like really embarrassing to do that. And so my big fear is if you have a major client, Nancy Pelosi was like a regular at one of my older restaurants. The big fear is if the people find out they're there, they'll start coming to interrupt her in the middle of dinner. And then that person's gone. And I've watched it happen with restaurants over and over again. And that can range from like a famous person to, if your bar gets known for having like pretty women at the bar, like all of a sudden it's like 70% male and the pretty women are gone. Like this is like a reality of this thing, right? Which is like they're there because nobody's bothering them there and they get to be normal and sort of human. And so in some ways it's been an incredible thing for us that the sort of media has picked up on this and they're happy to sort of write about it, because it does bring in new customers who are looking for that specific thing, but at the same time, you're always afraid of losing those customers. So for me specifically, I would never, ever in a million years be like, hey, Politico, by the way, like in the spotted, Marco Rubio having dinner with his family, because then you'll just never see that customer again. And that's a terrible thing to do to somebody.
Okay, but it's funny you said Marco. I was literally just going to use Marco in my example of the question I was going to ask. So you're there, the chef. Someone says, "Oh, by the way, Marco Rubio's in the dining room tonight." Do you do anything different?
So at that point, it's the same thing with a food critic. At that point, it's too late to do anything different. So much of cooking and so much of preparing food for a restaurant happens before the first diner sits down, right? Like if you're braising something, you take the 4 hours it takes to braise that thing, and then the service starts, and you're basically just sort of heating up at that point. So there's not a lot you can do on the food level, but there is the sort of like minor details around the edges, which is like, okay, the plate's going to be a little bit cleaner. You're going to let the server know. One of the funniest ones is we had the ambassador from the UK in early on, and I didn't know who he was. And so I was like, hey, what's up, man? And like all the British people were like, well, you're supposed to say sir, whatever the title. I don't even remember at this point because I don't care. But, I used the wrong greetings, and there's a whole proper greeting etiquette that I just didn't know. And so you do sort of try to let the servers and the front of house know that sort of thing, because it's just embarrassing for them if you don't.
You mentioned pretty women at the bar, so now I have to ask. I imagine running a restaurant, you see some interesting things go down, and you probably hear a lot of interesting conversations. What's the most dramatic incident or intriguing conversation that you've seen?
This is so funny. So the sort of political era we're in now, where that seems to be all anyone talks about, is incredibly boring to me. So there's a lot of sort of like political arguments or deal making that happens at the restaurants in DC. Whereas like pre this era, I had a nightclub, restaurant, lounge thing in Adams Morgan where like semi-regularly, this one I'm specifically thinking about, this woman came in with her, she was in a relationship and she was having an affair. And so she came in with her affair partner and was seated next to a guy who was also having an affair. Which was her partner. And so they were seated right next to each other.
Wow.
And we had to find the bouncers and sort of drag all of those people out, because the sort of arguments and the yelling at each other that started was just over the top and ridiculous.
I don't know. I feel like maybe that'd be a good way to discover that. It's like, okay, let's just call it a wash here. We're both,
we're both guilty.
Yeah, we're both guilty. All right, I actually have like a million more questions. I'm mindful of the time. I have one last that's sort of like maybe an important macroeconomic question. So Butterworth's hasn't been open that long, but you've been in the business for a long time. And one of the things that we talk about a lot is, in the 2021, 2022 era, one of the phenomenons of that time was, for the first time in maybe many people's lives, if they were a small business owner, it may have been the first time that you couldn't just put a sign in the window saying help wanted and expect a lot of people to show up. It was an era of labor scarcity, the likes of which we hadn't seen in decades. And maybe people never had to contemplate that possibility before. And the question we've been wrestling with and asking a lot of people is like, what are the sort of scars from that period, the traumas of that period, and how do they carry over? Has your experience of that time, of realizing that you could wake up and might literally not be able to perhaps staff a restaurant that day so that you can function, has it stayed with you to now in such a way that you think strategically different about things like optimal staffing levels or optimal inventory or anything like that? Did it change the way you do business in some sort of lasting way?
Yeah, in a ton of ways. I'm not even sure which one to start with. So number one, if you came to the restaurant tonight and you went into the kitchen, it's the exact same people that worked with me the day COVID started.
Wow.
And so I've kept them in various ways through multiple restaurants, because I watched all my other friends sort of lose cooks and dishwashers and whatever during that time and not be able to get them back. And so a chef designs a dish and maybe even does a bunch of the prep, but at the end of the day, you're still putting it in the hands of your staff to do it right when an order comes in. And I saw the wholesale quality of their food plummet because all of a sudden they were handing it to people they didn't train. And so through a number of reasons, got really lucky, kept a lot of those people, and I will keep them as long as I possibly can, because to train a new generation after them myself would just, I'm almost too late in my career to do it. And so that's a big thing. We did see a huge exit of like management level staff during that time. So if you're a really good front of house staffer, if you're a really good waiter, really good manager, really good bartender, turns out you're also a great salesman. So a lot of them went into real estate and sales and whatever it may be. And so there is, if you're at restaurants now and you're like, why is service so bad? Number one, they're understaffed because labor has become so expensive that they're trying to get more tables out of one server. Number two, the people that they spent training to do those front of house jobs exited that entire economy during COVID, because we were sort of front lines of this thing happening. We were expected to be open every day, but without any staff or money to do it with. And so a lot of like the best sommeliers, the best front of house managers totally exited the market. So those are still hard to find. And we struggle with it all the time. I've got a good front of house manager right now. I'm really lucky, but it took us, he's our third one in 1 year because they're just really hard to find. The talent pool for that is really empty right now. And then the cost of goods is just never recovered. And so sort of like, when it started, we were like, oh, supply chains are bad right now because of shipping or whatever it may be. And they'll go back down on, whatever it was, fryer oil. This is a big part of the beef tallow thing with the fries is I buy the cows from this farmer. So I also get a good price on his tallow because I sort of buy the whole thing. But most fryers in any restaurant in the entire world are filled with canola oils that are sort of globally processed, right? And so during COVID, you saw these things go up in price and you were told they were going to come down and it's shipping containers, whatever it may be. They never came down. It cost an unbelievable, it's like $200 a night to fill a fryer or something like that. And so that's when I sort of started the switch to beef tallow and all that because I was like, okay, well, I know this guy, he's 30 miles away or whatever. I'm going to just buy his entire product and keep the supply chain like 1-to-1. So there's just all kinds of things that happened during COVID that we're still recovering from. But the big ones are the staffing and the cost of goods, obviously.
Yeah.
Vertical integration. Yeah. There's one more macro question that we got to ask. We talked about the supply side, but what are you seeing on the demand side in terms of customers coming in and ordering? And how connected would you say you are to the broader business cycle? Because I imagine, if you're running a McDonald's franchise, you probably experience the business cycle in a very different way to someone who's running a boutique restaurant.
Yeah. So my understanding just from other restaurateurs and the news and stuff is that it's down right now and that I think reservations are down like 15% from last year is what most people are reporting. We're in a very special circumstance. Obviously, we're new and we're at the end of the day a luxury item. And so Hermes prices never dropped once and Hermes demand never dropped once during COVID. Like this is sort of like the side of the business that we're in and we're lucky to be in and I hope we can stay in it. So for us, it's a totally different ballgame. My understanding is that reservations are way down, spending is way down across the board. Yeah.
I'll give you a chance to sort of like really let your right-wing side come out. Health code violations and permitting and all that stuff, of course, those are some of the most uncomfortable scenes if you watch that show, The Bear. How real is it from your perspective? Do you want to rant a lot about the sort of, do you want to tell us anything about permitting and such in D.C.?
Yeah, I mean, so number one, The Bear is fascinating. The first season, that Uber Eats episode, so all of us switched to Uber Eats and all of these things during COVID to figure out how to survive. Yeah. And that ding that it makes when a new order comes in still sends me into like a blackout rage. I remember one time during COVID picking up the iPad that the Uber Eats order came in and just throwing it in the deep fryer and being like, screw it, I'm not doing this anymore. And so that episode, I watched it with my wife. We, at one point I was like, I think we might have to turn this off. Like I was getting like too upset, too anxious because it was too accurate. It was totally spot on what that feels like. With the health code violations and the permitting and all that stuff. Oh God.
Is this where we're going to have to bleep the episode?
I've been doing so good avoiding that.
Yeah,
I'm trying so hard. It's ridiculous. There was a restaurateur that I worked for, and the prep kitchen was in the basement, and it wasn't ventilated. And I was like, "How did you get a permit for this?" And he was like, "Well, we put $10,000 in a briefcase and gave it to the guy." And that's how we have this. So if you go down to City Hall and you pull the records for the building, this basement doesn't even exist. And this was less than 12 years ago. And so that obviously doesn't seem like an ideal system. But to do that same thing at the restaurant we have now took us almost 8 months to get the single permit for that. And so there's sometimes where you're like, was it better when we just put some cash in a briefcase? Like, I'm not entirely sure what we're doing here because you're paying rent that entire 8 months. At that point, $10,000 is a lot cheaper than whatever your rent is X 8 months. And yeah, it's this strange thing. I'm not sure what sort of like, don't say that, what sort of make work job it is for the city to have these health inspectors that come by and say the same thing every single time, which is like, hey, by the way, like they put a thermometer in all your food, which is hypothetically for food safety, but all the half decent restaurants are fine. So like, what are you doing here? I saw you last month. They were the right temperature last month. Can you leave me alone? But it's really the permitting process because you're in this race against your landlord to open before you start paying them. And getting 17 different permits to like have a basement or have a closet or whatever it may be is legitimately stopping new restaurants from opening. So it's pretty miserable. And that's not left or right wing. That's just like really like sort of like a technocrat would be better in this regard, right? Like it's like, please let me get my permit a little bit faster. Or a mob system, right? Like my understanding is from my friends in Montreal is that it's still very much a mob system. And so they go, yeah, well, we still put some cash in a briefcase and then boom, we're open in a month. So, let's pick one of those, but this middle ground right now where like it's just like 3 guys in an office who are completely, God, they're going to come like inspect me this week for saying this. There's like 3 guys in an office who are all idiots is miserable.
Yeah, you're definitely going to get a visit, I think.
Well, whatever, screw them. Who cares?
Bart Hutchins, that was fantastic. Thank you so much for coming on Odd Lots. That was a lot of fun.
It was good to talk to you guys.
Really fun. Thank you so much.
Thanks, guys.
I love restaurant episodes.
I know.
I mean, I love restaurants, but I love restaurant episodes. I've just always learned so much talking to these guys.
We could do like a spin-off series
We totally
on
could.
restaurants or something.
Yeah.
No, they're incredibly informative in terms of the macroeconomic environment, but also all these little themes that we talk about on Odd Lots, like the supply chain, like labor hoarding, like, to your point, distribution of resources such as energy.
No, I never thought about that time because obviously I presume a restaurant wants all tables filled at any given time, right? But I had never really thought about the thing, you have to have them staggered so that you do not have all the cocktail orders come out all the same. I had never thought about that and the sort of risk of like demand spikes. You have this system designed for some optimal throughput, but the idea of like you don't want it all at the same time, very intuitive, I suppose. It hadn't occurred to me before.
Did you watch The Bear? You must have.
Oh, yeah.
I had to stop watching because it was so stressful
Yeah.
and it was so many people shouting at each other. I couldn't do it after the first season.
It's funny how like basically everyone we talk to is like, yep, it's exactly how it is. And it's super difficult. That and have you watched The Pit, by the way?
No, but you keep recommending that.
It's good. There's a new season starting soon, but I was talking to a friend of mine who works at one of the NYU medical facilities, but he had the same reaction, like he can't watch that. As a consumer of TV shows, to my mind, that's a very good sign.
Yeah.
When the people say, no, I can't watch this. It's too real. It's like, okay, I'm not getting something overly dramatic.
Yeah, I'm going to put The Pit on my list.
Yeah, you
but
should.
This is something that stands out whenever we do a restaurant episode, which is there's an intensity about the job. And in many ways, it's a unique industry because the profit margins aren't that big.
Right.
You're probably doing it for something other than money. You're selecting your ingredients usually, often, because you want to make the best menu item possible, not necessarily, again, because it's going to produce the most profit. And you basically dedicate your entire life to this undertaking, right?
Absolutely. It's interesting to think about what is a chef? You think it's like, oh, this is someone who makes good food, right? But then the idea is like that the chef then has to think about lighting, all these other things that do not strictly fall under what we think of as the making of food. I don't know. There's so many interesting things. I mean, it's so interesting how many trends seem to date back to 2008. And so part of the story there was like, okay, there's a lot of cheap rents, restaurants can open up, but it's also the truth that media was such at the time because of the invention of the iPhone and so forth, that like foodie culture was like a thing in the media, right? And all these different crosswinds that happen and at certain key points that make it difficult to disentangle history. I don't know. That was just a really fun episode. I felt like I learned quite a bit in that one. Oh, and also the burger crowding out was something I'd never known about before.
Yeah, that makes sense. Again, intuitively. I gotta say, though, it makes you wonder what comes next. So, like, we've perfected food. A lot of restaurants have perfected the vibes or certainly pay attention to it more than they used to. What comes next, do you think?
I don't know. What do you think? Do you have some thought? Do you have some?
I mean, I'd like it to be service.
Yeah.
I worry that it's going to be like some customization thing, which I hate.
Oh yeah.
We shouldn't give customers options. I hate that.
No, I don't like. I don't like choice.
Yeah, that's right. That's right. Okay, shall we leave it there?
Let's leave it there.
This has been another episode of the Odd Lots podcast. I'm Tracy Alloway. You can follow me at Tracy Alloway.
And I'm Joe Weisenthal. You can follow me at The Stalwart. Follow our guest, Bart Hutchins. He's at White Guy Fieri. Follow our producers, Carmen Rodriguez at Carmen Armin, Dashiell Bennett at Dashbot, and Cale Brooks at Cale Brooks. And for more Odd Lots content, go to Bloomberg.com/oddlots. We have the daily newsletter and all of our episodes. And you can chat about all of these topics 24/7 in our Discord, discord.gg/oddlots.
And if you enjoy Odd Lots, if you want us to do more restaurant episodes, then please leave us a positive review on your favorite podcast platform. And remember, if you are a Bloomberg subscriber, you can listen to all of our episodes absolutely ad-free. All you need to do is find the Bloomberg channel on Apple Podcasts and follow the instructions there. Thanks for listening.
Bloomberg Daybreak is your best way to get informed first thing in the morning, right in your podcast feed. Hi, I'm Karen Moscow.
And I'm Nathan Hager. Each morning, we're up early putting together the latest episode of Bloomberg Daybreak U.S. Edition. It's your daily 15-minute podcast on the latest in global news, politics, and international relations.
Listen to the Bloomberg Daybreak U.S. Edition podcast each morning for the stories that matter with the context you need.
Find us on Apple, Spotify, or anywhere you listen.
News when you want it with Bloomberg News Now. I'm Karen Moscow, and we begin with a new era in New York politics. Zohran Mamdani is now the mayor of New York.
And the youngest leader of New York not to raise taxes. The rent freeze promise may lose traction with members of the Rent Stabilization Board, newly named by the outgoing mayor, Eric Adams. But Mamdani vows to press on, and during his inauguration, he made no apologies, telling supporters he was elected as a Democratic Socialist and will govern as a Democratic Socialist. In New York, I'm John Tucker, Bloomberg Radio.
Thanks, John. Well, we've been hearing from the president on social media. This morning, the president said White House doctors have just reported that he is in perfect health. That was according to a post on Truth Social. Trump said that he aced the cognitive examination for a third straight time. President Trump also pledged that the U.S. will come to the rescue of Iranian protesters if they are attacked by Islamic Republic authorities. That was according to a late-night social media post. The post comes after protests erupted this week in Tehran after the currency slumped to a record low. Demonstrations have since spread to other parts of the country, setting off clashes between civilians and security forces. Millions of Americans now face higher health insurance costs after tax credits for the Affordable Care Act expired on New Year's Day. Democrats forced a 43-day government shutdown on the issue, and President Trump floated an extension before backing off over a conservative backlash. Now the health research nonprofit KFF estimates premiums will rise an average 114% this year without a solution. The House is expected to vote on a subsidy extension this month, but success is far from guaranteed. The U.S. pressure campaign on Venezuela continues. The Trump administration has slapped sanctions on 4 companies based in Hong Kong and mainland China with ties to Venezuela's oil industry. It also sanctioned 4 vessels linked to those firms. This comes after a CIA-led attack on a Venezuela docking area thought to be used by drug cartels. In a New Year's Day interview, Venezuelan President Nicolas Maduro said he's willing to negotiate with the U.S. on a drug trafficking solution, but he did not acknowledge the dock strike. In Switzerland, officials say around 40 people have died and 115 more are injured after a fire at a ski resort bar where partygoers were celebrating the new year. We get more with Bloomberg's Tiwa Adebayo.
In terms of the cause of the fire, local officials are saying that it was an accident, and some eyewitnesses have told French broadcasters that it was a candle, a sparkler, on a bottle which ignited the ceiling. We have seen a photo this morning tweeted by a French broadcaster BFM TV on X, which appears to show some of those champagne bottlers with sparklers as well.
And that's Bloomberg's Tiwa Adebayo. Critically injured victims of the blaze are being treated in specialist burns units as far afield as Milan and Paris, underscoring the scale of the tragedy. Saudi warplanes have reportedly struck forces in southern Yemen backed by the United Arab Emirates. That, according to a separatist leader, there were no immediate reports of casualties. Tesla has finished off a dismal year in Europe with steep declines in several of the region's major markets for new car sales. In countries including France and Sweden, Tesla's sales plunged. Norway was the exception. Big tech companies led the gains last year on Wall Street, and that had some executives taking advantage. Big tech executives accounted for an outsized share of insider selling. In fact, CEOs and directors took more than $16 billion off the table. The largest sale came from Jeff Bezos, who sold 25 million Amazon shares. That netted him $5.7 billion. Michael Dell unloaded more than 16 million shares, while former Oracle CEO Safra Catz sold more than 12 million shares. We turn to the markets where futures are higher as we kick off the new trading year. 2025 was a good one for the bulls. The S&P 500 rose 16%, while the Nasdaq gained 20%. Nancy Dowd is a private wealth advisor at Ameriprise Financial.
For 3 years in a row, pretty much a small group of or a handful of AI and big tech stocks were the major drivers. So I think we're now looking at, well, will there be more evidence of monetization? And the AI story continues.
And that's Ameriprise Financial's Nancy Dowd. The S&P 500 coming off 3 back-to-back years of double-digit gains. That's its 7th best such run on record. Commodities are also higher to kick off the new year. Taking a look at COMEX Gold, it is up 1.6% at $4,408 an ounce. Spot silver is up 3.7% at $74.27 an ounce. ounce. And aluminum touched $3,000 a ton for the first time in more than 3 years due to a tightening supply outlook and bets on long-term demand. And S&P futures are up 0.5%, Dow futures up 0.4%, NASDAQ futures up 0.9%, 10-year Treasury yield 4.15%. That's news when you want it with Bloomberg News Now. I'm Karen Moscow, and this is Bloomberg.
Very dangerous trade. So, yeah, we have a list of names that we think are suspect, and when the time is right and some of the froth is out of the leaders in this space, that's when we're going to look at them. But until that point, you know, we're staying out of those waters.
Don't miss the opening trade, live every weekday.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary. We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We are just at such this early stage of people really thinking about ProSec or production for security or resiliency that there's a lot more going on. We're going to see this. We're going to see this through the electricity industry, whether it's nuclear. I just think, and again, this is an administration that is well aware that if stocks are not doing well coming into the midterms, it does not bode well. So look for lots of pushes to get the stock market going.
That was Peter Scheer of Academy Securities in a brilliant look at what he's looking for this year, particularly with his ProSec outlook on the world. Right now, you are seeing optimism to start 2026, led by, guess what, big tech leading the charge here, up about 1%. S&P futures up 0.5%. You are seeing just a bit of dollar strength, and despite what some people are saying, could be another year of dollar weakness. Euro 117.21 versus the dollar. A bit of a bid into bonds, but fading as the market grows older. 10-year yields 4.16%. And silver, another fantastic day after a fantastic year of 148% gains, 3.2% gains this morning in early trading. Counting down to the opening bell, here's the trading diary for the week ahead. On Tuesday, CES kicking off in Las Vegas. Watch some of the innovations. Wednesday, ADP data, JOLTS and ISM services. Finally, the data comes Thursday. Another round of jobless claims and the trade balance on Friday. The big one, the December payrolls report, the first clean read since the government shutdown. Also, University of Michigan sentiment survey. Before we get to all of that, Tesla set to follow Rivian to report its global fourth quarter sales shortly. Analysts expecting deliveries to fall 11% from a year earlier, while Tesla is even more pessimistic, calling for a 15% drop. Joining us now is Bloomberg's Craig Trudell. Craig, thank you so much for being with us. First, can you just give us a sense of what happened here, why Tesla tried to get out ahead of analysts that were surveyed by Bloomberg by giving a pessimistic outlook before this number?
Yeah, this was quite a curveball. We're used to getting those from Elon Musk, to be fair. But for the first time, the company posted on its IR website a consensus. So they put out averages both for the fourth quarter, for the full year, and actually going out a few years. And consistently, whether you were looking at fourth quarter or for full year 2025, even out the next couple of years, you actually saw the company compiled consensus that Tesla put out was more pessimistic optimistic than what the analyst averages that we compile on the Bloomberg terminal. So this was a bit of a surprise, and I think was sort of widely perceived as the company kind of lowering the bar for itself going into today's print.
So if we see a drop of, 15%, as the most pessimistic average would suggest, or even 10%, it makes me wonder about EV sales growth in general, beyond Tesla, both in the U.S. and globally. Aren't we still seeing gains?
I think, when you look at BYD, which actually just reported yesterday, we are both seeing, their sales continue to grow, and yet some softness in their numbers relative to the last couple of years. So I think globally, you're seeing the momentum in battery electric vehicle sales growth, really sort of losing steam. In the U.S., I think it's going to be a different story. Rather than just losing momentum, some possibility that you actually see sales declines. And I think, certainly in the near term, that feels likely, just because in the third quarter we saw such strong demand to try and take advantage of the federal tax credits that went away after the end of September, and we are widely expected to see huge payback for that in the fourth quarter, and that probably will carry on into the early part of this year. I think in terms of in Europe, it's maybe a different story where, we've seen Tesla be really weak in this region, and the Chinese players led by BYD are really sort of taking off, even despite, some trade protectionism, some tariffs that went into play in late 2024.
What does this mean, Craig, for EV sales, beyond Tesla and this quarter? For the world over the next 3, 4, 5 years, because we've started seeing a rollback in regulations as well. I thought Europe wasn't going to allow any more new gas vehicles to be sold after 2035, but that apparently is changing as well.
Yeah, and that was another big development in December that was very interesting to see. I think it was somewhat incremental, and at least on headline figures, where instead of aiming for 100% reduction in new vehicle CO2 emissions by 2035, that number is going to go down to 90%. But there's little ways in which you can sort of fudge that number to some degree as well. So I think in short, we're going to see a longer leash for hybrid vehicles, particularly plug-in hybrids in Europe. In the U.S., I expect to see more conventional hybrids that don't even have plugs. You think of this sort of base Toyota Prius. Those have been selling really strongly. You have a sort of situation where more and more manufacturers are sort of throwing in the towel on battery electric vehicles because they have struggled to make them pencil. And Ford, I think, was probably the biggest example of that late last year to announce that they were going to take $19.5 billion in charges related to unwinding various electric vehicle projects, doing away with the F-150 Lightning. That was a huge development, and we should probably expect more of those sorts of announcements to come from some of their competitors that similarly are going to struggle to sell EVs in this new environment without those federal tax credits.
Craig, just quickly, taking a step back and looking at 2025, how much of some of the sales declines for the likes of Tesla were because Elon Musk is such a lightning rod versus just the incentives went away? And you're seeing Rivian also with declining sales and deliveries versus last year, or versus 2024?
I think no doubt Musk hurt Tesla last year. I think, there are some questions about whether or not some of the, revolt against Musk has dissipated somewhat. We're going to see in the months to come, I guess, an easy comparison for the company. So if we continue to see declines for Tesla, in the next couple of quarters, it's going to be really troublesome in terms of, the state of this company's sort of here and out business. Thus far, he's managed to keep everybody focused on the future and on robo-taxis, but there too, I think there's been some letdowns in terms of execution and, some questions about how much that can continue in the months to come.
Craig Trudell of Bloomberg, thank you so much for being with us. And Matt Miller, are you didn't look for an electric motorcycle as you Google ChatGPT, some of the new details?
I have ridden some pretty impressive electric motorcycles. 10 years ago, I started riding electric motorcycles. I haven't bought one yet, but we are going to see electric motorcycle racing manufactured by Ducati in MotoGP, which is the top class in the world. So it could become something that you see more and more often.
But you don't hear because they're silent, which is
That's
kind
right.
of a lovely feature here. Matt Miller, thank you so much for being with us this week. It has been such a delight to have you. Coming up on Monday, Lori Calvasina of RBC Capital Markets, Ed Yardeni of Yardeni Research, Lisa Shallett of Morgan Stanley, and Aditya Bahave of Bank of America Securities. This was Bloomberg Surveillance as we bring you into the new year. Happy New Year. This is Bloomberg.
What about when you go to a cocktail party? People ask you for investment ideas all the time?
Let me reverse the question. What do they do with you?
Well, I'm not as good an investor as you are.
It worked out pretty good for you.
They mostly say to me, do you know Ray Dalio? At any point in your tennis career, did you say, I've had enough and I'm just going to retire at the top? Do you ever worry about that problem, staying too long?
It's a great question, and it's one that I think every athlete finds a different answer to. Mine came a little bit later than when I would have liked. I think stubbornness was a great quality that shaped a lot of my victories, but in the end of my career, I think it became a flaw because I was so stubborn to get healthy, for my shoulder to recover. I was also at an age where just my body didn't recover as quickly. And so for a year or two, that stubbornness got in the way of other great things in my life.
What would you say is the thing you're most proud of having done as a tennis player? Was it winning Wimbledon? What was the highlight of your tennis career?
I'd say consistency. I think consistency is, you can have results and they could, come at various times in your career, but I was consistent for many years, and you have to show up. You don't just show up to play first round of the finals, but you have to show up for press conferences before every match, before every tournament, and just the consistency and the mental wear and tear of showing up week in, week out. So I felt like I consistently showed up for my team, for my sponsors. As I look back, I'm proud of that.
In case you missed it on Bloomberg Crypto.
Well, we certainly understand needing to pay back the debt. That certainly makes sense. But on the dividend, why are you so committed to paying this dividend? Would you ever consider suspending it? Companies do suspend dividends from time to time.
Yeah, companies do suspend the dividend, but it creates fear, uncertainty, doubt in our preferred shareholders, which will impact our convertible shareholders, which will impact our equity shareholders. So I think preserving the payment of the dividend, even if our board has the rights to suspend it, it's the right thing for the short term, for the next 1, 2, 3 years, and it's important. It's also important for the Bitcoin asset class, and we realize we play a role bigger than just strategy in the Bitcoin world.
So would you say investors should think you will never suspend that dividend?
Never say never, but yeah, our objective is to pay the dividend into perpetuity.
Don't miss Bloomberg Crypto, live Tuesdays. Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
All right, good Friday morning from New York City. I am Paul Sweeney alongside Matt Miller. We're in New York.
Welcome to a special edition of Bloomberg Markets on Bloomberg TV Radio. We are simulcasting one more time. Matt, we're doing this again for the next...
I'm excited.
You're here for the next hour, right? And
Only an hour.
Because then you do something else?
No, I said, why don't I get to do the whole show? I wasn't given a reason.
Oh, interesting.
I think I was a little too energetic.
Too energetic?
On New Year's Eve. And they said, listen, we want to start 2026 on a little bit of a mellower note. So we can only deal with 1 hour of Matt Miller.
I did get a little feedback along that front, by the way.
Yeah?
Yes. so now we're getting Vonnie Quinn in for a couple hours, and we'll just see how that plays out. What could go wrong
I'll stay chill.
We got the futures market, Matt. We're looking to start the year on a good note here. The S&P up 36 points, 0.5%. The NASDAQ up about 240 points. Let's call that 0.9 of 1%. So starting out kind of where the year left off. Yields kind of steady here. Look, this smidge elevated here at 4.16%. But I'll tell you what's up yet again is gold, up another $37. I mean, talk about the precious metals continuing the trade there.
Not only precious, right? Aluminum went above $3,000 for the first time since, I think, 2022. And you know why I pay so much attention to aluminum.
Because cars and
F-150.
F-150.
That's an aluminum body truck. The average car, not just the Fords, 50 to 65% of raw materials costs for cars is steel and aluminum.
Yep.
It's a massive, massive cost input for these car makers. So when those prices go like this, especially...
Now, is this tariffs or is this just the market?
It's tariffs, it's the market, it's Chinese ceiling on capacity, it's the fire, that Ford saw. So there's so many different factors coming together to drive these prices higher, and it's just not going to help us pay any less at dealerships.
All right, let's talk some Tesla.
Yeah.
Do that. I mean, Tesla, the deliveries, the people in Europe are still not buying Teslas, folks. And Tesla, red headline crossing the Bloomberg terminal. Tesla, fourth quarter, other models deliveries, 11,642. The estimate was 16,959. Model Y, Model 3 production, 422,000 and change. The estimate was 452,000 and change. So
total deliveries, 418,000.
Yep.
And the estimate was for 440.
Okay.
So coming in even worse than expected.
Is this not really front burner anymore?
Well, the first thing to point out is that the fourth quarter delivery numbers aren't just below Bloomberg consensus. They're below the Tesla compiled consensus that they made the unusual step of publishing just before New Year's Eve. They always compile their own consensus. They just don't publish it. But you guys are kind of right that we got exactly what we thought we would get, which is a drop in deliveries year on year for the quarter, year on year for the year itself. But the stock and how investors value the company doesn't really have anything to do with that bread and butter business of delivering vehicles to consumers. Though I'd note, as I always do, in this compensation package for Elon Musk, the board does require him to continue to deliver vehicles to consumers going forward.
I wonder what you think about, we were just talking with Craig Trudell on Bloomberg Surveillance. He's Bloomberg's global auto czar. He's covered cars in Detroit, in Tokyo, now in London. And he said he thinks there's a possibility that we start to see no longer EV sales growth in America, like that we sell fewer electric vehicles in total, not just Tesla, but also GM and Ford and everything else.
Right.
As the incentives have gone away, it looks like we could see shrinkage here.
Yeah, that $7,500 federal tax credit that went away in particular is very interesting. Just very quickly on Tesla, but it's to your point. In the last few days of December, I already leased a Tesla, but the volume of marketing material and discounting and incentive that Tesla was offering itself, which is typical behavior. The company always tries to sprint to the end of a quarter to boost those figures, but they were offering a lot of discount, trade-in deals, etc., things like that. You mentioned Ford. I mean, that Ford news just prior to the holiday was really big, right? That they're essentially saying there's no point in us, even in the medium to long term, going all in on EV because it's not what the buyer is looking at right now. And so they pivot to that back to combustion, but with the hybrid part as well. But not uniform, right? There's pressure in the Chinese EV market. There are pockets of Europe where momentum continues.
I have a viewer question at a Bloomberg client writing in. How many robots was the consensus, and how many did they sell?
0 on the consensus and 0 that they sold. But, you know, again, I'll say it, I always say it, you know, Elon Musk is often missing his own deadlines. He does tend to get there in the end with whatever the company is in question. With Optimus, the plan was to integrate them internally as part of the manufacturing process in the thousands of units, and he's made bold predictions of the volume that he thinks he can sell to the consumer next year and going forward. But yes, 0 and 0 is the...
It was a tongue-in-cheek question, obviously. Yes. But listen, I do have a serious question about Optimus, and I was asking Dan Ives earlier, didn't get the straightest of answers. What is the intention for Optimus? Is it going to be on factory floors? Is it going to be a butler at my house, like B2B, B2C? What's the idea?
The thing with Tesla, different to the now quite crowded field of those working on humanoid robots, is them basically saying that this robot Optimus will do everything. You know, the way that Musk frames it is that it will be transformational for the global economy. I've written quite a lot about the idea that in certain sections of the US economy, for example, where there are labor shortages, you know, think about harvest season and things like that, some limited industrial use cases in the near term, that kind of makes a lot of sense. But Tesla's, you know, and again, a lot of this is Elon Musk posting on X and making claims on earnings calls. But, you know, they do see it as being like a babysitter, for example. Academically speaking, the industry more broadly, you know, they certainly see opportunity for the humanoid robot to assist in elderly care, for example. You know, imagine having that facility in the home of an elderly person. If they fall down, help them up, or literally just carry bags, you know, up and down the staircase, that kind of thing. I don't know if that answers your question.
No, it does.
The vision that Musk has, at least, is that it's very broad in all parts of the economy.
I hope it has the voice of Joan Rivers. Ed, great having you on this morning. Really look forward to your coverage from CES. Ed Ludlow, there, co-anchor of Bloomberg Tech. He is, I believe, off to CES next week.
The first question I have for everybody is, where are you staying? Because that tells me a lot about you as a person.
I was going to ask him. I interviewed him on Surveillance this morning. I was going to ask him that question. I thought maybe not serious enough for TV, but it could fly.
Yeah,
on radio and YouTube. Let's bring in Joyce Wong right now. She joins us from American Century Investments, where she's senior client portfolio manager. And Joyce, I want to ask you about Tesla specifically, or you know the lost EV incentive, but we did hear, and we are expecting many more tax incentives in one big beautiful bill for the beginning of next year. And you think that's going to keep us from much slower growth?
Yes, absolutely. I mean, anecdotally, I owned a Tesla Model Y. Unfortunately, it got in an accident and we had to get rid of it, but I replaced it with a combustion vehicle.
Oh, really?
Yep.
That's it. Yep. Ed, by the way, I know drives a Tesla Model Y as well. So, he's a big fan because it's autonomous. It drives him back.
I know. He's a little trouble with the Golden Gate Bridge.
Yeah.
What's the outlook here for 2026 here? Because we had fixed income. You guys had a great year in 2025.
Finally.
High single-digit return share. What are you looking for this year?
So, as Matt was saying, you know, this time last year, we were actually much more negative. We were actually thinking there was a very high chance there was going to be a recession in the U.S. Clearly, the data so far has shown that that is not the case. We don't have Q4 numbers yet. Obviously, we had the government shutdown in the very beginning of that, but all signs are pointing to a re-accelerating or stable U.S. economy. That being said, we do think that the first 6 months of 2026 could be a little bit slower. We'll see how the holiday shopping season kind of pans out, but we're seeing this K-shaped economy where high-end consumers, the top 10%, represents 50% of consumer spending. So that bottom 90% of consumers likely to pull.
Gaining ground again. When do we see this broadening out?
So that's what we're thinking. So I think this first half of the year is a great opportunity to start thinking about the opportunities to broaden out, because we expect that through this volatility in the market, there's going to be opportunities, both in credit and in equities. There's going to be opportunities to buy, because the second half of the year, we're actually more optimistic due to the fact that there will be these tax incentives flowing through. We will have a new Fed chair in place. Some of the uncertainty around monetary policy will be settled with the new Fed chair. So I think towards the second half of the year, you're going to get more clarity, or you're getting a little bit of a more reacceleration. So I would say now is the time to really look at options that are undervalued, that have underperformed a bit, that might come back.
How much credit risk do I want to take in 26? High yield really paid last year.
It did. And we do like select high yield names, but you have to be cautious, right? Spreads are historically extremely tight. So absolute yields look great. So you're getting 7-8% in high yield. But in terms of credit spread, you're not really getting compensated much for taking additional credit risk. So, you have to be cautious. We're active investors, so we are thrilled in this market because we're looking for these really special opportunities to find. We're not just buying beta. I wouldn't do that. But investment grade's also offering pretty attractive yields. You're getting 5-6% there for, A-rated bonds.
What do you think about the Fed, Joyce? I mean, do they continue to cut as the 10-year continues to rise? Because we've seen that divergence. And, we only have 30 seconds left, so just that.
We do think that the steepening of the yield curve has been, again, very positive for fixed income investors. We believe that the Fed is likely to only have one cut this year, despite a new Fed chair coming in. The data, again, economy's resilient. Unless unemployment spikes considerably, one cut is really our call.
All right, very good. Joyce, thank you so much for joining us. Joyce Wong, American Century Investments, joining us in studio on the day of January 2nd. That's pretty cool, because you're like the only person in this building besides us.
I drove to work today alone. I was the only person on the sawmill.
Exactly right. And people are smart out there. All right, coming up, President Trump pledges support to Iranian protesters. We're going to be live from Washington, D.C. to get some reporting on that. S&P futures up 34 points. This is Bloomberg. Good morning.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
In case you missed it on Bloomberg Crypto.
Well, we certainly understand needing to pay back the debt. That certainly makes sense. But on the dividend, why are you so committed to paying this dividend? Would you ever consider suspending it? Companies do suspend dividends from time to time.
Yeah, companies do suspend the dividend, but it creates fear, uncertainty, doubt in our preferred shareholders, which will impact our convertible shareholders, which will impact our equity shareholders. So I think preserving the payment of the dividend, even if our board has the rights to suspend it, it's the right thing for the short term, for the next 1, 2, 3 years, and it's important. It's also important for the Bitcoin asset class, and we realize we play a role bigger than just strategy in the Bitcoin world.
So would you say investors should think you will never suspend that dividend?
Never say never, but yeah, our objective is to pay the dividend into perpetuity.
Don't miss Bloomberg Crypto, live Tuesdays. Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Welcome to the world of decentralized finance. Bloomberg is covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, Tuesdays only on Bloomberg.
All right, this is a special edition of Bloomberg Markets on Bloomberg Radio and Television. Locked and loaded. President Trump took to Truth Social yesterday to say that the U.S. is ready to rescue Iranian protesters if they are attacked by authorities as unrest spreads across the country. For more, we're joined by Bloomberg's Washington correspondent, Tyler Kendall. Tyler, where did this come from? I didn't know the president was focused on Iran and some of the protests and maybe even taking some action. What does locked and loaded mean?
Yeah, hey, Paul. Well, at this point, President Trump didn't specify which actions he was considering, and that could be on the table, though I will point out that Andrew Bishop of Signum Global Advisors this morning told Matt Miller on Surveillance that this could potentially look like the U.S. targeting the IRGC's domestic facilities in a bid to give protesters a leg up when it comes to tackling the security apparatus. Now, that's just one expert's opinion based off of this.
likely that the populism of
Party has been trying to convince its domestic producers not to buy these chips. They've issued various warnings and regulations over the last year, and yet the demand is clearly still there. The sales are happening as much as they are allowed to by the U.S. It's also fascinating that, we're worried about the national security ramifications of allowing China to have this technology, but I guess if they pay us enough, we don't care.
Right. How much is it a national security issue and how much is it a commercial issue?
Right.
And that's been sort of the debate for a long time this year when it comes to a lot of national security issues and tech. It also speaks to what we saw yesterday with the CCP coming out and saying, we're thinking of maybe preventing you from creating certain AI-related technology unless 50% or more is manufactured in China. There was a caveat there, asterisk. There are certain areas where this could be exempted if companies demand it. How much are the companies pushing back against some of these national security provisions and saying, we need those to step forward?
Yeah, Chinese Jensen Huang's telling President Xi that, look, this is not only important for us in terms of profitability, but in terms of the best interests of this country, right? The idea that China should use our technology has been pushed by Howard Lutnick on this show, right? Because he says if they use our technology, if they get addicted to our technology, we're the ultimate winners there. And I guess they must see it the same way in reverse.
Yeah, a question of tech, belt and road and how much they want to and can implement that. Meanwhile, in the same kind of sphere, Elon Musk's XAI is planning on expansion of its massive data center complex in Memphis. The company has purchased a third building in the area that will bring its AI computing capacity to almost 2 gigawatts. Do you have any color on this, Matt, whatsoever?
No, I mean, just that 2 gigawatts is a hell of a lot of computing
Thank
power,
you for that color.
right? Because we need about 9 gigawatts to run New York City. So that just shows you how much 2 is. And I just love this story because of Elon Musk's pay packages and the targets that they've set, right? Tesla's worth $1.5 trillion, and he needs to get to $8 trillion. And a lot of people are questioning how he can do that without producing many more cars. But I think the answer is if you fold in XAI and you fold in SpaceX to Tesla, all of a sudden the market value balloons. And then you could see an $8 billion market cap sooner than you might have expected.
Then you get robots in everybody's home folding their
And
laundry.
then Elon Musk gets $1 trillion.
Exactly, and then there we go. And several gigawatts, I'm losing track of what these metrics really even mean at a certain point. Let's turn back to markets. Bridgewater Associates founder Ray Dalio sat down with Bloomberg to share what he sees as the five biggest risks facing investors in the new year. Take a listen.
I'm a practical investor. I've done this for 50 years. But in order to understand today, I had to understand things that happened before my lifetime. The big cycles, what causes breakdowns of monetary system. So I studied the last 500 years, and there are 5 big factors, 3 of which operate in a big cycle. There is the debt cycle, the debt money cycle, and I'll touch on that in a minute. There is, connected to the money and debt cycle, is the political cycle within countries, the left and the right. Gaps in wealth and values cause populism of the left and the right, which means that there are irreconcilable differences. So we have problems along those lines. And number 3, there's the geopolitical cycle, the world order, when rising powers challenge existing powers and existing systems. Those 3 are interrelated cycles: money, debt, the domestic economy, and the international economy. The 4th is through nature. Acts of nature, droughts, floods, and pandemics have been a big factor. They have killed more people than wars, and they can play a role. Certainly, it's playing a role. And then always throughout history is man's inventiveness, particularly of new technologies. And the inventiveness that we're seeing of the new technologies with AI particularly is clearly a force. So now, how does that play out? The first force is that we are having too much debt. Now, this is not just the United States. You're seeing this in England, you're seeing this in France, you're seeing this in China, you're seeing that dynamic. So that they can't increase the debt the way they did before. And then related to that is the politics. When you have these large wealth gap differences, who has the money? And when there's the accumulation of a lot of wealth that then isn't taxed, there's a tendency to want to tax that wealth. And that creates bubbles. In other words, when wealth is very different from money. In order to spend money, you have to sell wealth and get money. And when there's a lot of wealth that needs to be sold. So quite often interest rates play that role, but you could see wealth taxes play that same role, meaning the need to sell that. And that creates a bubble. So we have a debt bubble going on. We have that other kind of a bubble going on in the economy and related to politics. And then, of course, geopolitics. Capital flows and trade flows are different because we have a world in conflict. And in that world in conflict, no country could be secure. So that's why the United States wants to build self-sufficiency in these areas. Or China, which is that model where China would export to the United States and earn money and then invest in bonds, is no longer a viable path because the Chinese worry that they won't get paid on their bonds like the Russians don't get paid on the bonds. So that dynamic is what is behind what's happening, and it's becoming more precarious as we go forward. Like if we go into the 2026 elections, it's likely that the Democrats will take the House, significant possibility. If that happens, the political conflict will continue to be more difficult, and so on. And that's creating this risky environment. Particularly also, debts are maturing. So you have to roll over your debt at a higher interest rates. This confluence of factors is making the environment more risky as we're going ahead.
Out of the 5 forces that you had mentioned, what do you think is the biggest one that investors are not paying enough attention to?
I think it is the debt service, particularly the government position in the supply-demand of that debt, combined with the politics. What's happening in all of these governments is that they can't increase their spending because they can't increase their debt. And at the same time, they have the needs, more military spending and so on. And at the same time, they can't cut taxes. And so you're seeing a lot of political turnover. In the UK, they've had 4 prime ministers in the last 5 years. Same has been true in France, because there's not the ability to deliver on the economic promises that they're making. So I think it's the confluence of that economics, that situation, and the politics, the debt dynamics working with the politics, working then with this technology adding into it in a bit of a technology bubble.
So final question.
So that concerns me the most. And I would say particularly post-26.
Does that mean that you said recently that 15% allocation in gold and Bitcoin, do you still stand by that line?
I think that everybody should realize that gold is a type of money. It's not something to speculate in, just as you would hold cash. But other cash is a fiat money. And when you have debt, then the government needs to print money and make money easier, which lowers the value of that money. And so also to recognize that gold is a diversifier. When the other parts of the portfolio do badly because of some of the things we're talking about, gold will do better as a diversifier. So it has the effect in such times of raising the returns and diversifying the portfolio. A normal allocation would be between 5 and 15% if you just went into a portfolio optimizer.
That was Bridgewater Associates founder Ray Dalio looking at some of the big risks. And as you point out, Matt, he does have some pretty big risks when you talk about civil unrest and things of that nature, which is a reason why I do think it's notable how many conversations among politicians heading into the end of the year have to do with regulating AI. And I'm talking about both sides of the aisle. How much does that come back as you see a sort of pushback against some of what we've heard from Washington, D.C. so far this year?
Yeah, I've actually talked with Paul Tudor Jones about that this year, and he has warned that we won't get any guardrails on AI because we need to beat the Chinese and other rivals with this technology, neither side is going to really be able to push through any meaningful regulation. And certainly this administration isn't a huge fan of regulation. But I think Dalio's use of the actual term civil war has been really fascinating throughout this year. And he's said something similar just now in this interview. And he's said as much lately that the left and the right have irreconcilable differences. And it's not just on social issues, but also in terms of the rising government debt, the deficits that are resulting from the latest budget, and the large wealth gaps. I mean, we have a story on the terminal today about the fact that the top 500 richest people in the world have added another $2.2 trillion to their wealth, while the poorest people in this country are not adding to their wealth. In fact, they're getting paid less, and inflation is taking more and more money out of their wallets. So. Yeah. It is interesting to look at those bigger picture, giant macro risks.
I think that we can reconcile some of those differences and say that maybe there should be a holiday period for markets to be on hold from Christmas through the new year. Just suggesting it. I don't know. Do you think that you could get behind that?
Are you still like Dr. Doom on this show?
No, I'm not. I'm actually, you just went totally Dr. Doom. And I'm thinking, all right, well, Happy New Year. Have a good one. I mean, honestly, no. I think that there are plenty of reasons to be optimistic. Always times to worry. You can look in ChatGPT for that one. Anyway, let's move on. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burton. Lizzie.
Hi, Lisa. President Xi Jinping says that China's set to meet its economic targets for 2025, with growth expected to reach about 5%. Addressing the country's top political advisory body on New Year's Eve, Xi said that the economy has demonstrated resilience despite challenges. His remarks were bolstered by official data showing the first expansion in factory activity in 9 months. Elsewhere, COVID-era subsidies that help Americans pay for Obamacare health plans are set to expire today. It'll result in more than 20 million Americans paying higher premiums next month. A handful of House Republicans are joining Democrats in a maneuver that will put a 3-year extension of the subsidies to a vote next month. And Nvidia is looking for help from TSMC to ramp up production of its H200 AI chip orders. According to Reuters, Nvidia has 700,000 H200s, but Chinese technology firms have ordered more than 2 million chips for 2026. TSMC is expected to start work on the chips in the second quarter of the new year. And that should be my brief, Lisa.
Thank you so much, Lizzie. Up next, Goliath is winning.
3 words sum up our view on U.S. banks. Goliath is winning. Will big banks do well in 2026? And I think it's pretty clear that the answer is yes.
Chris McGrady of KBW joins next. This is Bloomberg Surveillance. A bit of softness to close out 2025, at least if this holds. It would be the 4th straight session
profile credits go south. What was interesting, Lisa, is the performance of the banks when that happened, right? The largest banks had the exposure. JP Morgan had exposure, but it was absorbed by the revenues and the momentum elsewhere in the franchise. And you take a company like Zion's, a mid-cap that had $50 million of exposure, and they lost 10x in their market cap in those couple weeks. So it just shows you that high degree of sensitivity. But if you look at credit spreads, if you look at credit conditions, the banks have done an exceptional job passing that test.
I actually just pulled up on my Bloomberg terminal a year-to-date chart of JP Morgan stock versus Blue Owl Capital. Because Blue Owl has become kind of the poster child for these private credit companies, rightly or wrongly, it's down 33% this year, and JP Morgan is up 38%. And, because of the discussion about cockroaches and the back and forth between Jamie Dimon and Mark Lipschultz, it makes it all the more interesting. Does that continue, or do you think we're mispricing private credit here?
It could be a little bit of both. I think what we've seen from the private credit perspective of the past 5 years, if you back up, is a lot of the loan growth that normally would end up on the bank's balance sheet has moved to private credit. Now, part of that is regulation post-financial crisis. So I would say following a crisis, there's a tendency to overregulate, and we're seeing some of those rules get relaxed. But there's definitely an arbitrage between the banks and the non-banks.
And I can back out to 5 years because the comp function does that, and JP Morgan has tripled in that time. So, these big Wall Street banks, especially heading into the Trump 2.0 period of deregulation, just stand to benefit even more, don't they?
They do. The scale is winning, right? If you look at JP Morgan, we think JP Morgan is a growth company. It's an unpopular, unconventional view, given it's the largest bank in the world. But JP Morgan is growing top-line revenues at a high single-digit rate. It is growing expenses slightly less, so there's operating leverage in the model. But JP Morgan and the largest banks, they've developed these models. And what's interesting over the past 10 years is when I started my career 20 years ago, the largest banks traded at the lowest multiples because it was too big to grow. Or too large to grow. Now it's the opposite. The largest banks trade at the highest multiples. And I think what's interesting is they've developed and produced the most consistent returns and the moat around their businesses across all the business.
This has happened at a time where volatility is really low. And you're seeing this in the bond space. You're seeing this even in equity implied volatility. The Fed is still expanding its balance sheet in order to counter certain liquidity concerns heading into year end. Is there a fear that if we do get some sort of spike up in volatility, that could dramatically shift the landscape?
It could. Credit spreads are low. We've seen, capital markets be exceptionally healthy. But if credit spreads were to go the other way in 2026, or we see some period of volatility, that will understandably be an excuse to probably sell banks, right? I think capital markets has been a huge tailwind. And as long as the capital markets are functioning and we see a healthy IPO pipeline, we see a healthy M&A pipeline, that could disrupt it. But again, we're in a pretty good spot.
It seems like the risk versus greed paradigm is really shifting toward the greed in terms of what companies get rewarded for. Do you think that when banks report earnings come January, they will get rewarded for expanding their balance sheets? They will get rewarded for even increasing their pool of credit reserves for charge-offs as they expand to try to get more profits?
I would say growth has been the missing link for the space, right? If you think about the 200 plus banks that we cover at KBW, loan growth has been tepid, right? It's been a source of deleveraging. It's been the intermediation of private credit. As we see, 2026 guides be unveiled, I think we will see decent guides. I think we will see conservative guides with room for upside, and it's going to be upside from margin expansion, capital markets momentum, and deregulation.
Yeah, well, Chris McGrady of KBW, thank you so much for being with us and have a wonderful new year. Great to see you in person. A real question of whether the U.S. can outperform Europe as well, because European banks have really done absolutely tremendously so far this year, Matt.
Yeah, far better. I was just looking at price to book, and Deutsche Bank is more than 1. I spent 6 years in Germany when it was like 0.3. And we've seen in Madrid, the banks outperform to the tune of 50% gain for the IBEX. So it's pretty amazing to watch.
Yeah, the expansion of credit there continues to build. Although the IBEX in Spain has done absolutely tremendously. I think it's been their best year since 1993. When you take a look at the returns there, so Spain, there's something in the Spanish water. I think you're going to be heading
If you're a dollar investor, it's even better.
Exactly.
Right?
Yeah, well, maybe we can all get some jamon. Coming up in the next hour, Marky Patel of Allspring Global Investments, Becky Blaine of The Points Guy, Claudia Sum of New Century Advisors, Advisors as we take you toward the last economic indicator of 2025, the jobless claims that come out at 8:30 Eastern. And Whitty Caesar of Credit Sites, where we could talk all about the credit profile, particularly how it's transitioning with some of the AI influence. From New York, this is Bloomberg Surveillance. Good morning.
Kind of see shades of this K-shaped economy, K-shaped market.
Instead of any sort of dramatic surge that could reignite inflation pressures, we will see hiring activity slowly start to pick up.
If employment keeps weakening, if inflation kind of stays somewhat cool, it's hard to imagine that the Fed doesn't cut more.
What matters is how the interplay of the risks and the tailwinds are going to interplay in 2026.
2026 is really about adaptability.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance on this New Year's Eve. Stocks on track for a fourth straight day of losses, with traders lacking a reason to shift around their equity holdings after a pretty big year. Some big moves, though, still out there, particularly in precious metals, with escalating volatility prompting CME Group to hike margins for the second time in a week, and in just about a half an hour time, getting the final economic release of 2025. Jobless claims due out in a half an hour, with Fed officials signaling 2 more rate cuts to come in 2026. Matt Miller alongside me right now, as we do see fireworks going off in Sydney, Australia, because it is a new year already. It already is 2026. First, we got Auckland, now New Zealand. Now we've got Sydney. It already is the new year, Matt.
Yeah, we'll be rolling fireworks around the world. This morning, I'm going to see Tokyo and Seoul at 10 o'clock New York time. And it's been a pretty good year for stocks around the world, too. Globally, remember, many of these markets have outperformed the U.S., and we've done very well with a 17% gain on the S&P 500. If you compound the gains over the last 3 years, actually 80% for 23, 24, and 25. So it's been an amazing run and added a ton to global wealth.
Yeah, although some people have pointed out that you've seen even bigger gains in the likes of Germany, with the biggest year going back to 2019, led by defensive stocks, as well as some of the other shares of the likes of Deutsche Bank. You also have seen Spain deliver its best performance since, I believe, 1993. Other superlatives for the year: the dollar, on the flip side of some of that equity outperformance internationally, has been weakening at the fastest pace going back to 2017. Watching that space closely, it's also been the biggest year for gold and silver going back to 1979. This is setting up 2026, which we are already entering in the down under. Does this continue in terms of U.S. exceptionalism being challenged by the international landscape?
You know, I ask that question of guests on my show all the time, and the answer is inevitably yes. Many investors think that overseas, especially EM investment, is going to pay off better than U.S. investment. What do you hear here on surveillance?
I think it's a motley picture. Some people say that that is the case and that you do see diversification. Other people saying that that is a trade that depends on the waning of the AI trade. And as long as you get a waning of the AI trade, the rest of the world should benefit if you do get that broadening out. That is one of the biggest questions. Also a big question with oil at the worst year going back to 2020. Do we see a continuation of that? Right now we are seeing stocks just coming off. Bond yields really getting bid this morning, 4.11 on the 10-year. Coming up this hour, Marky Patel of Allspring Global Investments, with stocks on track for a 4-day losing streak to end the year. Becky Blaine of The Points Guy expecting a more stable airline environment in 2026. And Claudia Sam of New Century Advisors breaking down the latest and last jobs data of the year. We begin this hour, stocks just edging lower, with Marky Patel of Allsprings Global Investments writing, "We do not expect the stock market to broaden out materially in 2026. We think the strong sectors will continue to have high growth." Marky joins us now. And Marky, thank you so much for being with us. You really are answering the question that Matt was just asking, which is how much do you see this outperformance of the rest of the world, of the rest of the 493, really taking hold next year?
Well, I think for the rest of the world, it's really sort of a catch up after a long period of underperformance. And I think that the U.S. still has some of the best fundamentals of any country in the world. And we have good momentum. Really this year, we saw it in the third quarter. That should continue in the fourth and well into next year with the tax treatment, lower withholding, higher refunds, and the very favorable capital expenditure treatment in the new tax bill. So we think that the U.S. is going to be one of the better performing sectors next year in the world, really.
And it does hinge, in your view, on AI remaining the dominant trade. How much is this on a currency-adjusted basis versus overall in absolute terms?
Well, I think the artificial intelligence trade is going to continue. But really, over the last few months, we've already seen some erosion in the price earnings ratios of some of the leading companies in AI. So the market is already making an adjustment if we're looking at some moderation from the extremely high growth, which is probably likely. But still, that says to me that's going to be one of the sectors that have well above average growth when you look at the whole economy. So we still think that's a great sector.
What kind of broadening out do we get in earnings, Margie? Because we have seen the Mag 7 earnings, though still, massive double-digit gains, slow down, and the rest of the S&P, at least says the S&P 493, starting to catch up to some extent, but it hasn't really been substantial. Does that change in 2026?
No, I don't think so. I think the same sectors that have been strong for this year and a couple of years before are going to continue to be strong. The other sectors that I think particularly for consumers may be rather disappointing. So we still think it'll be technology, industrials, relating to the electrical grid. And those will be the sectors. And aerospace defense will continue to be the strong sectors and really outperform those other sectors.
We've seen, year to date, all of the GICS sectors on the S&P 500 are up, but real estate has barely budged. I wonder if that changes with interest rates coming down. Consumer staples is the second worst performer, and energy, oddly enough, is the third worst performer, I guess because of oil, right? But we're going to need so much energy to power these colossus data centers. Why doesn't it pay off?
Well, I think really when you look at the data centers and the growth in power that we need in this country and other countries really is going to come from the gas side. So we think that gas will continue to be in strong demand and really detached from the price of oil. And when you actually look at oil, although there seems to be a glut today, if you look down the road a year or two, it may look like that the countries producing oil have really been underinvesting. So we may have, not today, not tomorrow, a year from now, have a big surprise to say, oh, we really need to invest more in oil. But we think the case for gas, especially in the U.S., the shale producers feeding into the electrical grid and the need for more power, it's really the only realistic source, is going to make that sector very strong and really detached from what happens to the price of oil.
How much, Margie, does this really lean into the whole real world economy, the old world economy, being dominant? We've seen that to some degree with the metal space so far this year. Do you expect that to continue next year?
Yes, I think so. And I think the U.S. is going to continue to be one of the strongest economies, particularly because the fundamentals are really on our side. When you look at the emerging markets, a lot of them have had a big comeback, but fundamentally their economies don't have what we need to really see the sort of sustainable growth. In the U.S., it looks like we're on track to say 2 or maybe 3% next year, which would really put us near the high end of the range of sustainable growth around the world.
I know that back in the day, Margie, you and I used to talk all the time about high-yield bonds and investment-grade bonds and how fixed income fit into a portfolio. Increasingly, you've talked about how equities have been a better proposition for a risk-on move and, frankly, for returns than bonds. Do you think that that's going to shift come 2026?
No, I think the bond market is a place of very small risk and very moderate returns. So you'll get, particularly in high yield, a little bit extra yield, maybe 2 percentage points, maybe 3 percentage points more than the Treasury yield. So say 5.5 to 6 3/4, something like that. But you really can't look for much beyond that. If you look at the high yield market, a lot of the poor quality issues have been siphoned off, gone into the loan market. So the U.S. public high yield market has a default default rate only of about 2%. So it's actually quite safe on a relative basis. And the defaults have been more on the private credit side, which are more than twice that amount. And we think that'll continue. And as I said, there's no room for capital appreciation because most bonds in the high yield universe are trading above their face value. So we can't have the old-fashioned capital appreciation that we would talk about in years past. It just isn't, the math just isn't there.
Margie, I'm just an equities simpleton, so this is a little bit too much for me to understand. Why do we have credit metrics getting better and better? Torsten Slok put out a note about it today, and defaults falling at the same time as bankruptcies hit the highest level since just after the great financial crisis. How does that work out?
Well, because the public high yield market, number one, they have not gotten the poor quality issues they may have in other years because those have been siphoned off into the private credit market. So you just don't have those very vulnerable names. And secondly, during that period of zero interest rates, many high yield companies took advantage of that to restructure their balance sheet, to pay off their bank lines, to issue new debt at very, very low coupon rates, pre-refund issues that might be callable or coming due in a couple of years. So actually, the high yield bond market as a whole has never had such a strong balance sheet overall. And secondly, the supply is really pretty modest compared to the insatiable demand for higher yielding securities. So we think the high yield market is a little, I would say, an island of tranquility, but it really looks pretty good. The only criticism is you aren't going to get those types of equity-like returns that we've seen in other markets, especially if the Fed is very much on even keel, relative stability. It'd be a different case if the Fed were going to slam on the brakes, jack up interest rates, but that doesn't look like that's on the horizon at all. So we think the high yield market, for what it is a modest yield, modest risk, and some investors like that. And that's so for that, it's a good sector.
What does this mean for private credit, Margie, as we go into 2026 and I see all of these non-bank lenders in Blue Owl, Apollo, KKR, Blackstone, underwater for 2025. They haven't performed for equity investors.
Well, and that reflects the fact that many of transactions that were done were in the poorer quality companies that really don't have the ability to improve their balance sheet, to raise their growth. And it was really just sort of a play on spreads of the cost of money versus what they get. And we think that'll continue. And actually, that's a market that is now larger than the U.S. high yield market. It's more than doubled in the last 5 years. So it's really a case of that's where all the marginal dollars have flowed to. And so that will be where the marginal risk will be. And I think that, as we've seen, when there are bankruptcies or blow-ups in that market, it really hasn't washed over into the bank sector, hasn't washed over into the high yield market with spreads widening out because the market has distinguished those companies that are under pressure, got way too much money from the high yield market, where it's more of a because of the better balance sheets and the credit outlook and moderate use of funds. When you look at high yield bonds, the purpose of why they're borrowing money, more than half, maybe even close to 3/4 of the last few years have been to refinance other debt. So they aren't going crazy with paying themselves big dividends or to make acquisitions that will turn out to be too risky. So it's a very attractive sector looking at the fundamentals, really.
Margie Patel of Allspring Global Investments. Wonderful to see you. Thank you so much for being with us. Have a wonderful new year. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burden. Lizzie.
Hi, Lisa. Tatiana Schlossberg, the granddaughter of former President John F. Kennedy, has died at the age of 35. She had disclosed and detailed her battle with acute myeloid leukemia, a cancer of the blood and bone marrow. Schlossberg was an enterprising journalist who wrote for the Metro and Science desks of the New York Times before transitioning into freelance writing. Elsewhere, Warner Brothers Discovery is planning to reject a takeover bid from Paramount after the company amended the terms of its offer. Sources telling us here at Bloomberg that Warner Brothers board will meet next week to make a final decision. The board is concerned that Paramount has yet to increase its offer, which was earlier rejected as inferior to one from Netflix. And Michael Burry, the money manager, who is, of course, made famous by The Big Short, denying being short Tesla shares, despite calling the company ridiculously overvalued earlier this month. Burry's comments come after Tesla took the unusual step of publishing a series of sales estimates indicating the outlook for its vehicle deliveries may be lower than many investors were expecting. And that should be my brief, Lisa.
Thank you so much, Lizzie. All right, Matt, you're a car expert. So what do you think of the Tesla? Do you kind of get into the electric if they had an electric truck or an electric motorcycle?
I increasingly hear positive reviews about the Cybertruck. I have not driven one myself, and I think they're horrendously ugly. But I applaud the company for taking that kind of brave step to doing something different. And so I think it's pretty cool.
Yeah, although I have seen people with Cybertrucks not allowed into passing lanes because people are not very happy with the Cybertruck. I've seen that in a variety of places. Have you ever seen that?
No.
Okay.
No. Well, in general, U.S. drivers don't allow anybody into the left lane.
That's true.
They get in the left lane and drive very slowly.
People tend to be a little bit less than polite there. Up next, the morning calls plus Becky Blaine of The Points Guy expecting less turbulence for the airline industry in 2026. That's coming up next. This is Bloomberg Surveillance.
When you think about some of the dynamics that we're seeing in terms of supply, we have immigration that's falling. We have retirements that we think continue to accelerate. At the same time, your demand for labor, while slowing, still hanging in there. So what that means is you're going to have a situation where the need for workers is still there. It's just showing up as replacement demand. So payrolls aren't going to look great by any means, but we are going to expect an environment where the unemployment rate remains low.
That was Michael Reed of RBC speaking earlier as we do wait to get that jobless claims number at 8:30 Eastern in about 12 minutes time. Right now in markets, you are seeing just a touch of softness in the S&P. Futures down by about 0.1%. Euro-dollar stuck there around 117.53. 10-year yields now higher, which is sort of interesting given the fact that they were lower earlier in the session. They are selling off 4.13% rounded off. Remember that they started the year at 4.55%, and crude firming up after the worst year going back to the height of the pandemic. Time now for the morning calls. First up, Citizens raising its price target on Alphabet to $385 from $340 while maintaining an outperform rating on the shares. The firm expecting Google to accelerate search revenue in the fourth quarter, down about 0.25% in pre-market trading on Alphabet shares. Next up, BTIG raising its price target on TKO Group from $235 to $250 and keeping a buy rating on the shares. The firm seeing additional upside in TKO's sports and live entertainment businesses in 2026. Can you say TKO?
TKO. Technical knockout.
TKO. I'll try to get it again. It's sort of, punch out, right? Isn't that what it is?
Technical knockout.
Okay, thank you. Technical knockout. I'll just call it technical knockout company. And finally, Jefferies raising its price target on Vanda Pharmaceuticals to $7.50 from $5 while maintaining its hold rating on the shares. The move coming after the FDA approval of Vanda's new motion sickness drug. Those shares up almost 20% in pre-market trading. Turning now to
are there any, though, that are better than the rest? Is Delta one of those that outperforms in terms of customer satisfaction regularly?
Delta does. And I think United is up there as well. One of American's big goals for 2026 is to work on its customer service and increase its profitability there with on-time performance as well. And so what we're seeing, though, with a lot of these carriers across the big three U.S. carriers is they're increasing their premium product offering. There's been a demand for it from the U.S. travel market, especially when you look at those outbound international flights. That's where demand is strongest right now. We've seen inbound travel, drop off this year due to a variety of reasons, including government shutdown, immigration policy. And so that outbound, though, remains strong. And the airlines are really counting on that going into 2026. And increasing that product. When you look at some of the, I was just looking at airline prices the other day to go to Europe in 2 weeks, and I saw a premium economy seat for $5,300, but you could fly first class for $3,000. And so that gives you just a little bit of an indication of what the U.S. market is demanding. They want that better than economy, maybe not willing to pay first class price, but sometimes you'll find a deal like that because premium economy is in such demand right now.
Matt, when was the last time you went on vacation? I'm just curious. I mean, you're just yelling at a cloud this morning.
Well, no, because I'm 6'3", right?
Okay.
And unless I pay for a business or first class seat, it's just an awful experience. I mean, there's no attempt by airlines to make it any better for American-sized people.
Okay.
And
PSA
that's because they need to please obviously shareholders and make as much money as possible, which is fine. If you're an investor, I get it, but if you're a customer, it's not a great experience.
It's also, though, about traveling to places where you can do fun things, like ski, like be on a beach. And I am wondering, Becky, from your standpoint, whether you are seeing better incentives, the idea of miles or other points that people can get from airlines, from their credit cards. Are those still carrying as much heft, or are you seeing a real inflation in some of those areas?
We've seen some program devaluations over this last few years, but you have to remain nimble. And one of our best pieces of advice at the Points Guy is to leverage points and miles in a program that you know you're going to earn and use the most. I'm a big fan myself of transferable rewards, so I might double down on American Express membership rewards or Chase Ultimate Rewards points, put my spending on those cards, and then I take those points and transfer them to the airline. So to Matt's point, if you want to fly in a premium seat, like I've flown long haul overseas to Europe from the West Coast for 50,000 miles in a lie flat seat on Air France. Now those seats run about 60,000 miles one way, but still, those deals are out there. Matt, we're going to sign you up for our daily newsletter.
Those are few and far between. I mean, come on. That's very
not,
unrealistic.
You could fly in a lie flat seat from New York to London on Virgin Atlantic starting at 6,000 points. Well, economy is 6,000. You can fly upper class for a little bit more than that. We're talking like maybe 24,000 miles or points there, depending on what program you're transferring from. So you just have to know where to look and how to look and who the transfer partners are from the different credit cards. And usually like a one-to-one transfer direct into the airline might not be the best use of your miles or your points. I might look at American Airlines, and I'm an elite traveler with American Airlines. I have been for many years. I look at some of their redemptions, and they want 400,000 miles for a seat that I can transfer and book through a different program and maybe pay 60,000 miles or points for.
Becky Blaine of the Points Guy, I look forward to you making Matt a happier guy with the newsletter that he receives, and it comes up with some deals so that you could actually travel without raising your fist.
Dress codes would be great.
Oh, my
if an
goodness.
airline would instate, because what's the deal with sweatpants and Crocs?
It's comfortable, and you have to take your shoes off. I guess not anymore, but if you have to take your shoes off, you're going to ban sweatpants. What, you think everybody should dress in a suit?
I think, you've got to dress for the occasion, especially if you're going, for you, right? If you're going to go skiing in St. Moritz or whatever, then you should wear a coat and tie.
A coat and tie? I should wear a ski outfit, or I should wear your jacket. I'll wear your jacket next time I fly to go skiing. Coming up, less of that, the more of this. The latest jobless claims data is set to cross with the last economic indicator of 2025. Claudia Sam of New Century Advisors with us to break down the numbers. This is Bloomberg Surveillance. Right now, about an hour away from the open, and we do see a soggy start to the day, the fourth potential straight day of losses to end 2025. Right now, what you do see, although we are clawing back from some of the earlier declines, down about 0.1% on the S&P. When you take a look at the bond space, 2s, 10s, and 30s, a real question about whether the Fed has the space to cut rates and what this means on the long end. A bit of a sell-off as we wait for the latest jobless claims, which we are just getting now, and they come in below expectation, 199,000 versus the expected 218,000 unemployment claims. They also was a slight revision up, but basically flat on the prior week, 215,000 from the previously stated 214. Continuing claims people have been watching as a sign of how much people who are unemployed can actually get work. It does look like the continuing claims came down to 1.86 million. Down from 1.9 the previous week. So we do see declines. And Matt, this really does speak to the ongoing quiet in the labor market, that things don't seem to be falling off a cliff, despite some of the concerns that have been out there.
Yeah, I think it's fascinating. You know, you get down below 200,000, and that has only happened a few times in the last 4 years. But we have been stuck in this range with initial jobless claims since the end of 2021. We have been stuck between 200 and 250,000. Ed Hyman once told me it was the most reliable piece of economic data that comes out on the Bloomberg terminal. But I don't know what it means when it stays the same number every single week, right?
You're not alone. And I think that's the reason why you aren't seeing a massive move, although the 2-year yield is popping higher, up 1 basis point on the back of this data. The unemployment claims, definitely something that has remained fairly stagnant, although the continuing claims has caught some people's attention because that had been ticking up. So a good sign that we have seen that come in. Claudia Sahm of New Century Advisory joins us now to give us some insight. Claudia, thank you so much for being with us, and Happy New Year. What do you make of this? Matt's point that we've seen unemployment claims basically at the same place for almost a year.
Right. So, as you said, we're not seeing signs of deterioration in the labor market. Like, the layoffs have not picked up in a way that was the downside risk that the Fed has been very acute to. And we haven't seen that. So we're not seeing the bad news story. Frankly, we still need to see some good news in the labor market. So the claims don't get at the piece that's really been sticky, and that's that the hiring rate has been quite low. So yes, good news on the continuing claims for this week, but they are still quite elevated. And so we need a little bit more of the good news. But, the fact that the layoffs have not shown up despite a lot of layoff announcements, like, we're not seeing them in terms of actual layoffs, and that's good news.
Claudia, do you take anything from the idea that continuing claims came in to some of the lowest levels that we've seen going back about a month? Not significant, and they are elevated, as you've said, but does that indicate that people are actually finding work?
It's possible. These are, while the claims data are very timely, we get a quick read. We have to be careful around the turn of the year. It's just really tricky with the holidays, and, just reading these data is much harder at the turn of the year than, say, in the middle of the year. But it is potentially a good sign. And what we're looking for are signs of more stability in the labor market, signs that the hiring rates start to pick up off their very low levels. So this is encouraging, but this doesn't make the case yet, right? We need to see it in the hiring data.
Claudia, what does the labor market look like with the stop in immigration, no new people coming to the U.S., and the demographics, fewer and fewer people having babies, or people having fewer babies? It would seem to me that if you have the economy growing, and we do, and corporate revenue and profits growing, as we do, that, lack of supply in the labor pool would mean more demand. But it doesn't look like that, as you point out.
Right. Well, there are all kinds of timing issues, right? It is quite unusual. We saw, in the third quarter, GDP really, moved up higher, and so did the unemployment rate. Right. In a much less dramatic fashion, but it is moving higher. And so, you have the ingredients for the good news story of the labor market going into 2026. Consumers are still out there spending. You've still got the business investment. Companies will need, as they expand, to draw on their labor force. And we should see, and I think this is the optimism that you can kind of see in the minutes from the Fed's December meeting. There's an outlook there that these pieces should come together, and we should have hiring pick up. It doesn't necessarily need to pick up to levels that we saw, 2-3 years ago when immigration was much stronger. But we are at low levels that we have seen wage growth slow some. We've seen the unemployment rate tick up. That is a sign of the demand for workers is just lagging behind the supply.
Diane Swank pointed out a couple of months ago that cutting rates, the Fed lowering rates, isn't going to help consumers in the lower quintile, because subprime rates don't come down with the front end of the curve. But I wonder if it does help the labor market. We've lost, I think, 70,000 manufacturing jobs this year. We've got a ton of incentives in the one big, beautiful bill to, I guess, bring those back, and tariffs are supposed to do that, too. If those things don't work, does cutting rates help to bring back manufacturing jobs?
Well, cutting rates is supportive of both households and businesses in expansion. I mean, and particularly, say, smaller businesses that, the interest rates that they borrow with, that's a key, calculus in their decision to expand. And as they expand, they can bring on more workers. So, we shouldn't have the view that the Fed has the magic wand here on the economy and it's going to, on its own, revive the labor market. But the Fed pulling restriction out of the economy, it helps. It moves in the right direction. And again, it's a piece of the puzzle. There's also more fiscal support coming early in the year. And it does appear that uncertainty, just broadly about policy and maybe some of technological change, has weighed on the labor market this year. And as that dissipates, that's also another ingredient to kind of get hiring going again.
Uncertainty has also been pretty strong because we haven't known how much we can trust the data or whether we're going to even get the data. And even in this latest batch of numbers, one terminal user points out that seasonal adjustment, if you strip that out, you actually see initial jobless claims that are higher than the previous week. So what do you make of these types of seasonal adjustments, of these types of calculations that have raised more questions than given answers?
Right. Well, these issues with seasonal adjustment, these are the mainstay of trying to read macroeconomic data, right? Like, as I said, around the turn of the year, claims data are tough. From Thanksgiving into early in the year, it's just that's just a hard read. And so you do a lot of averaging, kind of look at the basic trend, and the basic trend looks pretty good, right? So don't make too much out of 1 week. But yes, these are our regular issues. Unfortunately, we're also dealing with, the backlog of the government shutdown and data collection having been very disrupted. And even as we're getting data, and the claims data, this does not apply to them, but say like the CPI or the labor market data, the shutdown casts a long shadow. Like, we have distorted data in a way that we don't typically have distortions. We don't typically lose a month of data and then try and pick up the pieces afterwards. So it does make it more complicated. But, thankfully, there's a lot of information out there. You just kind of, pull it all in and get a sense of what's going on. And really, the tenor of the data in general is pretty good. I mean, solid. There, like I said, we still need labor market to pick up, but the ingredients are there.
When I want to feel good, I walk down the street and I see all these people going to stores and being together and going to work. And when I want to feel bad, I read the news. And I read all these stories about how computers are coming for our jobs and how a lot of places are seeing opportunities to replace human labor with algorithmic programs. I'm just wondering, based on the data that you've been looking at, how much credence is there behind this sort of replacement concept of AI?
Well, I think looking at surveys, industry level data, when we think about the labor market being somewhat slow right now, I don't think that AI really can, you can point to that as a key driver broadly. There are some industries in tech, increasingly in finance, where you see more adoption, and there probably are cost savings happening with employers. I think, it does fit into this piece of the broader uncertainty, right? Like, do you need to hire? Do you need these workers? That's much harder to parse out of the data because there's a lot of different sources of uncertainty right now that businesses have. But in terms of, the adoption really holding back the labor market, I think it's hard to point to a broad story, but it is certainly something to watch. But we should also remember that the new technology also enables new jobs and new uses of technology. So it's not just about saving labor, it's also about making labor more productive. And that can be a real good news story over the long haul.
Claudia, I love when you're on because I learn so much from you, and because of your notable achievements in economics, but also because you went to Denison and I spent a year there. My dad went to Denison. My mom went to Denison. I grew up in Granville. What do you think of the value of a college education for the average American these days? Because so many, not just kids, but adults are having trouble meeting repayment requirements well into their 40s, and it doesn't look like recent graduates are getting a huge advantage in the jobs market.
Right. Well, technical skills and training are, they're always important for getting ahead. They do pay off. I have a very ecumenical view. I had an excellent education at Denison University, a liberal arts college, but that's not for everybody. My daughter's in engineering school at Illinois. She's, different technical training. And I think, in the trades, and there are lots of ways to gain skills. And we certainly don't want to push every child through a college education, particularly with the cost of it. But it doesn't, I still think, and the data bear this out, like the education and the skills, they do pay off.
Claudia Sahm of New Century Advisors. Wonderful to see you. Happy New Year. Thank you so much. See you in 2026. Matt, to your question about college education, having just gone through that process with my oldest, I will say there is this interesting calculus that I didn't find myself making when I was a kid. Do they have job programs to get kids into jobs during, whether it's the summers and internships or not? That's an increasing focus from pretty much every college we visited. So to your point, definitely this is on their minds as well.
And it's so much fun, right? College. It's
Not
such
if
a blast.
I can help it. Not mine. Anyway, Matt Miller, thank you so much for joining over the past hour and 45 minutes.
Happy New Year.
Happy New Year. Love the outfit. I look forward to you in a kilt next year. He's heading over to the radio studio, and he'll be taking you through the next 3 hours on TV and radio, just because he hasn't had enough and he wants to really enjoy his heading into the new year right now. By the way, I really love the jacket.
Thank you.
Are you going to switch it out to different jackets throughout the day like Mr. Rogers?
This is just a New Year's thing.
Okay.
So, but yeah, next year, if we have double-digit gains again, I will be on this program in a kilt.
All right. Right now, we can hold him to that. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burden. Lizzie.
I don't know how I'm going to concentrate with the thought of Matt Miller's legs in my head in a kilt. But moving to the news, we've got Elon Musk's XAI purchasing a third building in Memphis to expand its data center complex. The billionaire wrote on X that it will bring the company's AI computing capacity to almost 2 gigawatts. Musk has publicly discussed the plans to build the world's largest data center for AI training, and posted earlier this year that Colossus 2 will eventually have 550,000 chips from NVIDIA. Now, if you're hoping to get a Trump mobile phone, you're going to have to wait a little bit longer. According to the Financial Times, the phone company launched by the president's family business won't be available by the end of this year, as originally planned. The company telling the FT that shipments of the $499 gold-coloured phone were delayed by the recent government shutdown. And revelers wanting to celebrate the new year in New York's Times Square will need to bundle up. New York City temperatures are projected to drop as low as 26 degrees Fahrenheit, with a chance of snow later in the evening. Meanwhile, on the West Coast, there's a rising risk of flash floods in Los Angeles, and there's a near 100% chance of a wet New Year's Day rose parade. That's your Bloomberg Brief, Lisa.
Thank you so much, Lizzie. As you pointed out, people will still have a good time. And it's December. Of course, it's going to be cold in Times Square. Lizzie will be back with us in just a little bit with your morning movers. Up next, Winnie Caesar of Credit Sites breaking down artificial intelligence's growing share in the public credit markets. Lizzie's going to be taking a look at NVIDIA, up on reports that it's pushing for an increase in H200 production over for Chinese consumption. This is Bloomberg Surveillance. Good morning.
The biggest risk is that the Fed has to consider raising rates at some point over the course of next year. That would be the biggest shift that could potentially throw a wrench into the low vol and easy financial conditions and high overall base metal price conditions that we are currently seeing today.
That was Mark Cabana of Bank of America talking about the year ahead outlook and the potential for more rate cuts. Right now in markets, you are seeing a new color after 3 days of red. You are seeing some green, although marginally so, after after the jobless claims came out below expectations, essentially flat on S&P and NASDAQ futures as well as Russell 2000 after three straight sessions of losses. Meanwhile, in the bond space, a reversal there as well. You can see the two-year yield in particular now up 2 basis points after having been lower by a basis point to 3.47%. You are seeing the sell-off in a similar fashion for the 10-year at 4.14%. And that 30-year yield ending higher than where we began the year, 4.83%. So we are seeing that yield curve steepening for 2025. Under 1 hour away from the cash open, let's head over to London with your morning movers with our very own Lizzie Burton. Lizzie.
Hi, Lisa. Well, I want to start in the chip space now because we have had the news from Reuters that NVIDIA's been sounding out TSMC to help ramp up production of its H200 AI chip. Now, we don't know how many units it would be ordering, but what we do know is that it's got about 700,000 in stock and about 2 million ordered by Chinese tech firms for 2026. So Reuters reporting that it's going to be TSMC that helps fill that gap and the work to start in the second quarter of 2026. So both of these up in the pre-market. But if you flip the board over, you've got losses in the pre-market for AMD and Micron. We did earlier. They flipped into the green, like me. So it's actually not such a mixed picture in the chip space. Everybody looking to end 2025 in the green. Let's flip over now to Nike as well, because we've had the CEO, Elliott Hill, buying $1 million worth of shares. This following on the footsteps of the Apple CEO, Tim Cook. He bought $3 million on Christmas Eve. So that stock liking it, the shares up nearly 3% in the pre-market. Happy New Year to you, Lisa.
Happy New Year to you, Lizzie. In green, bringing the market with you as you speak. Right now, counting you down to the opening bell. Here's a trading diary for the week ahead and the start of the new year. Tomorrow, markets are closed. Happy New Year, and thank you for being with us. Next Wednesday, we get data, ADP data, JOLTS data, and ISM services. Thursday, another round of jobless claims and the trade balance. And on Friday, this is a biggie, the December payrolls report and University of Michigan consumer sentiment. Turning to the tech story that has been the dominant story for 2025, AI-related debt issuance in public markets is doubling this year as build-out costs surge. Winnie Caesar of Credit Sites writing, with spreads still very tight, we are maintaining our cautious view on credit risk and prefer taking duration risk. Winnie joins us now for more. And Winnie, thank you so much for being with us. How much has the increase in AI-related issuance increased the riskiness of the investment-grade debt market? I think that, Winnie, if you could just stick with us, I believe we are not getting your sound. We will get back to you in just 1 second. Just to point out how much the returns have been. If you take a look at investment-grade credit markets, you have seen an 8% return so far this year. In the high-yield space, you have seen more than 9% returns so far this year. Spreads have tightened. That means the extra yield over benchmark rates. As people take a look at credit profiles that have looked better than expected, in particular because of what we have seen with just companies terming out some of their debt structures. But in the investment grade credit space, and this is something that Torsten Slok pointed out not so long ago, you have seen an increase in AI related issuance to about 14% of total investment grade credit issuance in 2025 versus 7% of issuance in 2024. This has raised concerns about AI being the dominant theme and frankly, overwhelming every trade in the market, whether it's in equities or whether it's in credit. This is one of the reasons why it has been incredibly concerning for some investors who don't want to get invested so heavily in particularly data centers and other aspects. At the same time, these are companies with incredible balance sheets, the like of Alphabet, which issued a 50-year tranche. And we had on a guest earlier in this week who talked about how we did actually see buyers there for that, including herself, because of the duration. This is the reason why some people are still leaning into this debt because of the cash balances of so many of these companies. Heading into next year, though, a lot of people saying that credit spreads are priced to perfection. You have seen credit spreads drop to some of the lowest levels that we've seen going back years. And frankly, people are looking at this and saying how much alpha actually is left. Right now, you're seeing high yield credit spreads ending the year at 2.67 percentage points over benchmark rates. That is one of the lowest rates that we've seen over in history. Going forward, one of the big questions is going to be how much you get volatility, how much private credit could potentially be a concern, especially given some of the opacity of that. And then, of course, the rate picture. And when you take a look at the rate backdrop, right now you do see yields just ticking higher because you are not seeing the jobs picture fall apart. Yesterday, we did get the Fed meeting minutes, and they showed that people were more concerned about the labor market and potential weakness there than in inflation. While inflation has still remained above 2%, for 5 straight years, it has been ticking lower, and people point to things like the housing market that have been pretty subdued, that are not adding really to any of that inflationary pressure. When they take a look at that, they emphasize the labor market, which is the reason why you've got 2 rate cuts priced into the market for next year. Today, we saw jobless claims actually come in lower than expected. And right now, you are seeing a sell-off with 2-year yields up 2 basis points to 3.47%. The 10-year space also selling off to 4.14%. And you do see a steepening in the yield curve throughout the day. And this has been something that people have been talking about. Let's head over to Lizzie Burden right now to talk. Oh, excuse me, Lizzie is not there. But coming to the up on Friday, we are going to be speaking to Jeff Yu of BNY Mellon, who's going to lay out his look going forward, given the fact that right now people are still expecting another double-digit return for 2026. Jeff Yu of BNY Mellon will be joining us, Dan Ives of Wedbush, Peter Scheer of Academy Securities, Catherine Rooney Vera of StoneX Group, as we look forward to a new year. The key aspect is going to be truly economic data coming, given the fact that we haven't really gotten a clean read. Next week is going to be the new year. We're going to be getting ISM services, ADP employment, as well as, of course, the jobs report for December. That could potentially be the first clean read. The key aspect there is how much do you get an increase in the unemployment rate, something that Citigroup has been pointing to, given the fact that if you do get a 4.7% unemployment rate, even with this low hire, low fire dynamic, that could indicate that the Fed could move as soon as January 28th. One aspect that they highlighted in a note last night was as the balance of risks shifts more towards downside risks to employment and away from upside risks to inflation, we continue to expect 75 basis points more of rate cuts in 2026. That does it for me. It has been a wonderful year with you. Thank you so much for joining us on Bloomberg Surveillance. We look forward to seeing you bright and early in the new year on Friday. From New York, this is Bloomberg.
You kind of see shades of this K-shaped economy, K-shaped market.
Instead of any sort of dramatic surge that could reignite inflation pressures, we will see hiring activity slowly start to pick up.
If employment keeps weakening, if inflation kind of stays somewhat cool, it's hard to imagine that the Fed doesn't cut more.
What matters is how the interplay of the risks and the tailwinds are going to interplay in 2026.
2026 is really about adaptability.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome to the final trading day of 2025. Stocks on track for a fourth day of losses in light trading as investors lack a catalyst to get off the couch. Jobless claims on deck as the final economic indicator of the year, with yesterday's Fed minutes highlighting more rate cuts to come in 2026, and gold and silver very much in focus again, with the CME raising margins on precious metal futures for the second time in a week amid heightened volatility. John and Anne Marie are enjoying a well-deserved holiday. We're holding down the fort here in New York, looking back on a pivotal year for markets, policy, and politics. And just to let you know, it is already New Year, at least if you're in Auckland, New Zealand. We're kicking off the New Year's celebrations. We'll be heading over to Sydney, Australia next, then Tokyo and Seoul and Beijing. Before the day is out, we'll have Paris and London full New Year's before it hits New York City. Just taking a look back at the year in markets, it's been a wild ride, many superlatives, another double-digit year for U.S. equities, the third in a row. Bonds and stocks both delivering pretty significant gains. The dollar weakening at the fastest pace since 2017. We saw the biggest year for gold and silver since 1979. We also saw the worst year for oil since 2020 on supply gluts. And we saw the best year for Spanish stocks since 1993. A key question heading into 2026 is, will the rest of the world continue to outperform the United States? In the bond space today, you are seeing a bit of a bid in. Yield curves have steepened throughout the world as people face off with inflation and government debt. Right now, we are ending with a bit of a whimper. We begin the day with stocks poised for a fourth session of losses. Right now, looking at just this slight decline and really led by what we've seen in the NASDAQ with respect to losses there. And right now, you are seeing a decline of about 0.4%, leading losses. A question going into next year will also be the rotation trade, and we'll continue to see it in the bond space. That yield curve steepening has been the theme so far for the year. You see that continuing this morning. At the front end, you have 3.44%. That is down from 4.23% to start the year on the 2-year. 10-year yields at 4.11%. They started the year at 4.55. 30-year yields slightly above where they began this year, 4.77 to start the year, 4.79 to close out. Coming up this hour, Michael Purvis of Talbot and Capital Advisors. As stocks pare back a strong year of gains, George Pollack of Signum Global with healthcare costs set to jump for millions of Americans with the ACA subsidies expiring today. And Michael Reed of RBC as investors eye one last read on the labor market for the year. We begin this hour, stocks cutting into gains of more than 17% for this year. Michael Purvis of Talbot and Capital Advisors writing, the biggest threat to the S&P next year is that AI spend will be considered not to generate compelling returns. This means multiple contraction for a key part of the market. Michael joins us now. Michael, thank you so much for being with us. Happy New Year to you. Let's start with this idea of how much AI has really upheld the rally so far this year. Can you take a look back and give us a sense of how dominant that theme was and how that might be poised to shift in 2026?
Well, Lisa, if you look at the sort of large tech relative to cyclical and value pair over the last, not year, but the last 6 or 7 years, that line goes up to the right, just like the overall market does. It's sort of one and the same. And what I've argued for years now is that the big tech rally is kind of the broader SPX rally. There's just consistent outperformance in almost every year, except when you have bear markets like 2022. And even then, it wasn't really that ferociously sold off. There's very good reasons for that, which is that they generate not only a superior quantity of earnings, but the quality, meaning the volatility of those earnings, is remarkably low. And so compared to cyclical and value earning streams, they're just a lot more superior. What I'm really, the question I think that I have as we look into 2026 is that you have these giant companies, you have, Microsoft, Meta, Amazon, and so forth. All of them have very distinct business models. And many of these companies are really now converging in a very massive way on this AI spend, which is they're taking their business models from a very distinct place almost to a somewhat similar place in some respects, right? We're talking about $1 trillion of cash out of 4 companies over the next 24 months here. So just to finish the thought, Lisa, I think that the question that I'm really asking is that if the return on invested capital is not there, and if you look at the free cash flow yields on stocks like Microsoft, they're at record lows right now. So the price earnings and earnings growth ratios look very compelling. The free cash flow is the problem, and so it all works if the returns are there. But if it's not, you're going to see a real re-rate in the big tech pillar of the market.
Is there a signal that you're getting, Michael, just to sort of build on this idea from the race of some of the acquisitions that we've seen to close out the year, whether it's NVIDIA with Grok, whether it's what we saw with Meta and that Singapore-based company having to do with AI, whether it's what we see right now with NVIDIA potentially acquiring an Israeli-based tech company? I mean, they're using their free cash flow to do something. What's the signal for how much this is a shift in narrative going into 2026?
Well, yeah, I mean, I think it does remind me of a little bit of 1998, 1999, 2000, when telecom and tech were converging and frantically, there was frantic deal activity and frantic CapEx activity as well there. And of course, there were some ultimately great winners, and there was a lot of write-offs as well. I don't think, like we talk about FOMO in the stock market, and I think there's FOMO in the C-suite here too, which is that all these giant companies are frantically trying to position themselves, for the long haul here. And in that process, you're going to see a lot of narrative rewrites going on, and a lot of people speculating as to who the winners and losers ultimately are. I go back to 3 years ago when Google had that all hands on deck meeting because they were frantically behind in AI, and OpenAI was going to clean their clock, and here we are, and that narrative seems to have just twisted on its head here. I still think it's still so early in this game that it's very hard to declare where the ultimate winners are going to be. I mean, I think that, I talked to a lot of tech executives there that are on the front lines of AI, and they are just sort of bewildered by how the stuff is going to shake out themselves, and they're in this market every day.
Well, to me, this really goes to the question of how do you broaden out, right? What does it mean to diversify? Everyone who's come on this show to end the year has said that diversification is the key for next year. We've seen that in the precious metals trade, although it's arguable that that's not exactly diversification, particularly like when it comes to silver. How much do you see equal weight as being true diversification in this type of backdrop?
Well, really since last January, I started pushing this narrative that, as much as I love the big tech story as a core part of the portfolio, if you want to rotate and diversify, not to go into U.S. cyclicals and values. Now, obviously, there's a lot of specific sectors and specific stocks that have done incredibly well this year in the United States. But thematically, at the index level, what I'd advocated for was a rotation into European equities, which were sort of the ugly ducklings for so long, and in some respects they still are. But I think where I am right now is that, look, we've got the SX5E, I call it the SPX for the European continent. That has outperformed most every U.S. index in local terms, almost caught up with the Mag 7 index. And on a currency adjusted basis, it's blown away most every U.S. major equity index. So looking forwards into 2026, where I'm at right now is I think that's going to happen. It's a very different set of dynamics. So I think, look, if the Germans really are going to start committing to this stimulus, and I think that's happening, it's hard to tell. But that is sort of a massive and a very different type of force than, say, the AI force, right? When you're talking about this pretty significant economy really pushing stimulus to a place that it's never been. They have the fiscal space to do it, unlike many other sovereign nations in the developed world.
Right.
And that will be really resonate there. Meanwhile, I think for the U.S. cyclical value trade, well, there's still a lot of, I think, sentiment tied to that. So if you are concerned about the tech, I don't want to use the word bubble, but the tech theme, the dominance of tech theme, if you're sort of worried about that kind of not really working next year, to me, I think I sort of see Europe as a pretty good place, with a caveat that the rally this year has been driven largely by PE expansion, and the relative to PEs from Europe to, say, their U.S. counterparts are in a less compelling place than they were 12 months ago.
Yeah, and we have seen that outperformance, particularly on a dollar-adjusted basis so far this year. Just taking a step back, heading into next year, you talk about the fiscal space. And one theme for 2025 has been yield curve steepening. Bespoke Investment Group put out a chart showing that on the Bloomberg Global Aggregate Index, you saw the biggest yield curve steepening going back to the steepest levels since 2016. How much do you expect this to continue and for bonds to fail to provide that haven, particularly on the long end?
Hello? Sorry, Lisa, you cut out for a second. I think I froze up.
Michael, I'm so sorry. Let's leave it there. I think we're having some technical difficulties. Michael, wonderful to hear your thoughts, and I'm sorry to leave it on that note. Michael Purvis of Talbach Capital Advisors, Happy New Year to you, and hopefully we'll see you soon. Right now, let's get you an update on stories elsewhere this morning. Let's head over to London, your Bloomberg Brief with our very own Lizzie Burton. Lizzie.
Hi, Lisa. Warner Brothers Discovery is planning to reject a takeover bid from Paramount after the company amended its terms for its offer. Sources telling us here at Bloomberg that Warner Brothers board will meet next week to make a final decision. The board's concerned that Paramount has yet to increase its offer, which was earlier rejected as inferior to the one from Netflix. Elsewhere, money manager Michael Burry, made famous, of course, by The Big Short, denying being short Tesla shares, despite calling the company ridiculously overvalued earlier this month. Burry's comments come after Tesla took the unusual step of publishing a series of sales estimates indicating the outlook for its vehicle deliveries may be lower than many investors were expecting. And you were just discussing the metals. Well, gold and silver are slipping in this final trading day of 2025, though both remain on track for the record annual performances. The past few weeks have marked a tumultuous end to a historic year for precious metals, and these wild reversals prompted the CME to raise margin requirements on precious metal futures for the second time in less than a week. And that's your Bloomberg Brief. Lisa.
Thank you so much, Lizzie. And it raises a question about the banking sector as well as the shadow banking sector, and we'll get into that later in the show. Up next, American healthcare.
These Obamacare subsidies are expiring now. More than 20 million Americans are now bracing for their premiums to skyrocket.
Yeah, they will skyrocket because it was never any good. It's a bad thing. We can have a great thing. Let the money go directly to the people and let them buy their own health care.
George Pollack of Signal Global joins us as we look at ACA subsidies expiring at the end of today. From New York, this is Bloomberg Surveillance.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends. Get ahead of them.
And so many more.
Well, perhaps we didn't get a Santa Claus rally, but we got the rally that everybody wanted and maybe didn't expect this year. The third straight year of double-digit gains, really seeing the track record that we saw back pre-pandemic and the immediate aftermath of it. Right now, you're seeing a little bit of edge come off that froth. What we are seeing is the NASDAQ leading stocks lower, futures lower by about 0.33%. This is the fourth straight day, potentially, of losses as people lack a catalyst to really do anything. Very thin trading. What we have noticed in the bond space, yield curve steepening, and this is a global phenomenon. Take a look at two-year yields, 3.45%. They started the year at 4.23%. They have come down more than 80 basis points. 10-year yields 4.11. They started the year at 4.55. Excuse me. We haven't seen those kinds of levels in quite a while. The 30-year yield is actually higher than where it was to start the year at 4.77%, and it is another basis point higher today. The yield curve steepening has been the main theme for bond markets around the world and raises a question about how much this has to do with fiscal prowess, the idea of how much government debt there is, as well as potential inflation. When it comes to the fiscal backdrop, under surveillance this morning, American health care.
These Obamacare subsidies are expiring now. More than 20 million Americans are now bracing for their premiums to skyrocket.
Yeah, they will skyrocket because it was never any good. I'd like to see the money that is going to the insurance companies by the hundreds of billions of dollars. Their stocks are up through the roof over a fairly short period of time because they're getting vast amounts of money. I want that money to go to the people directly and let the people buy their own health care. And they'll get much better health care than they get with the Unaffordable Care Act. It's a bad thing. We can have a great thing. Let the money go directly to the people and let them buy their own health care.
Here's the latest. Enhanced Affordable Care Act subsidies are set to expire tonight, sending premiums skyrocketing and impacting coverage for millions of Americans. Congress failing to find a resolution before the deadline. Bloomberg's Tyler Kendall joins us now. Tyler, can you give us a sense of what's going to happen at midnight tonight? What has been the discussion in Washington, D.C., and what steps might possibly come early in 2026?
Hey, Lisa, good morning. Well, this is going to have potentially huge impacts for millions of Americans when it comes to higher prices, but then also potentially losing coverage. Data cited by Bloomberg News estimates that out-of-pocket premiums are going to more than double for those on Obamacare. Now, as you mentioned, we're talking about the enhanced subsidies. These were the tax credits that were expanded under a pandemic-era law. So starting tomorrow, those tax credit levels are going to snap back to pre-pandemic levels for lower and middle-income households, but then they're going to go away completely for households earning more than 4 times the federal poverty line. Now, as you mentioned, Congress failed to act, but there are a few ideas on the table. But just keep in mind here, lawmakers aren't back in Washington until January 5th. One is we are going to get a vote on a so-called clean 3-year extension. The Congressional Budget Office estimates that this will add $83 billion to the deficit. That is at least one of the reasons why Republicans remain divided over whether or not they will support any type of extension, though they are pretty aligned that if there is an extension, there has to be structural changes such as an income cap or anti-fraud protections. That's why we're keeping our eyes on this effort that's brewing in the other chamber in the Senate, a bipartisan plan that would include some of those structural changes and then pair it with perhaps a shorter term extension like 1 or 2 years, essentially to buy lawmakers time so that they can come up with a broader health care plan down the road. Now, Lisa, it's important for us to mention that these ACA premium subsidies, these are refundable tax credits that are calculated on an annual basis. That's why even though we're already past the deadline, you could still see an extension be retroactive. Rather, when I talk to people on the Hill, they're less concerned about getting this money ultimately back into consumers' pockets and more concerned about those consumers that may not enroll if they wake up and see sticker shock and say they don't want one of these plans.
Just quickly here, Tyler, there is this question of another deadline that's coming in January that could potentially lead to another government shutdown. How much discussion is there of another shutdown on Capitol Hill?
So this is something that it could go either way. I have to say a lot of the people that we actually are talking to here in Washington think that we're going to avoid it because Congress has actually done a lot of the legwork already to accomplish their actual job, which is appropriating the spending for the year. We could see another holdup, of course, related to this healthcare battle that is going on. As we know that Democrats are really trying to hold Republicans' feet to the fire. In fact, we've already started to see campaign ads for the midterm starting now that has to do with potentially these rising healthcare costs. But Lisa, as of now, we'll see what happens when they come back in January. But the odds are actually towards that we may avoid that shutdown at the end.
That will be a note of relief, at least for the airline industry, as well as all the other federal workers out there. Tyler Kendall, thank you so much, and we'll see you later in the show. Joining us now is George Pollack of Signum Global. Can you just give us a sense, and great to see you, George, stepping back, how much of a focus this is for Republicans to keep some sort of healthcare solution, how much it is a popular thing for them to do heading into the midterm elections?
Well, the biggest issue for Republicans is healthcare is the one issue where Democrats poll better than Republicans. This is the issue where Democrats can really go on offense and say, we have the better ideas, or at least the more popular ideas. And going into a midterm election, that's already going to be a challenge when they've had the trifecta in DC. Allowing these subsidies to expire and exposing people to doubling of healthcare premiums is just not sustainable, especially if they want to keep the House.
We were talking at the end of last year, or the beginning of this year, about cutting the budget deficit and about cutting expenses. DOGE was a big effort. Now there is a question of how much of those cuts are going to basically come back onto the balance sheet, whether it's IEPA or whether it's some of these subsidies that get passed over. I'm just wondering from your perspective, how much of a focus cutting the budget deficit still is in Washington, D.C.?
Look, I think it's a great line. I think when you're the party out of power, it's something you discuss, and you've seen moderate Democrats talk about it, and you've seen most Republicans talk about it. But the reality is, when they passed a one big beautiful bill, yes, that made tax cuts and the tax system permanent and gave businesses and Americans a idea of permanence, but it also cost billions and it cost a significant amount of money and added to the deficit. It's a great campaign line, but unless there's no real appetite for embracing entitlement reform or anything like that, because it really is the third rail of U.S. politics.
How do you see 2026 being different politically than 2025, given the fact that the midterm elections are coming up and what happened in the midterm elections that we just saw?
I think what you're really going to see is these moderate Republicans who voted for things like the one big beautiful bill, who have defended the president, who are facing a very tough reelect, and with Democrats getting some pretty strong recruits in moderate districts, they're going to really try to separate themselves from the administration, and they're going to really try to stake out themselves as independent or focus-oriented members of Congress who just want to do what's best for America. And I think with Speaker Johnson having a very narrow majority, that's going to be something that he struggles to navigate, especially if he wants to do a second reconciliation bill.
George, there's something that not a lot of people are talking about, but is coming up increasingly on talk shows as well as just in op-ed pages across the country, across the world, how much of a focus there's going to be on artificial intelligence and either regulating it or providing some sort of safety net should there be some sort of mass job loss in the wake of a real adoption that does mean that certain humans are not needed anymore. How much of a discussion is there in Washington, D.C. about this as we head into 2026?
I think what you're going to see is the administration has fully embraced AI as the next great thing for the U.S. economy. And what you're going to see is the likes of both Republicans, so like Governor Ron DeSantis or Governor Spencer Cox, and you're going to see Democrats as well campaign against the administration's whole hog embrace. You've already seen Senator Bernie Sanders talk about suspending data center construction. I think what I put it a parallel to is when they were negotiating the original NAFTA and that trade disruption and the job disruption. I think Democrats are going to say, you're disrupting American jobs. You're threatening social stability, and you're increasing costs in things like energy. And they're going to use it as a huge attack line for the president, especially because Americans are pretty divided. I think there was a recent poll out that only by 5% are they really positive about AI. And that's really people who haven't yet learned all the details. And I think as Democrats hit the administration and the likes of David Sachs, I think that's going to be a very potent issue for Democrats in particular in 2026.
You mentioned Senator Bernie Sanders of Vermont. He is going to be at the inauguration of Zohran Mamdani, I believe, tonight, along with AOC, along with a host of other progressive Democrats. I just wonder what this really signifies for the Democratic Party in 2026. Not necessarily Zohran Mamdani's inauguration, but just is this going to be the mainstream of the Democratic Party heading into the next presidential election season?
Look, I think that's a fantastic question. If you're a tri-state Democrat like Laura Gillen or Tom Suozzi, you're not happy about this because you're going to have to run against Mamdani and you're going to have to deal with the after effects of Mamdani's policies. But I think in reality, this midterm election is going to be a referendum on the president, a referendum on the Republicans. And when the Democratic Party has the likes of Marie Gluesenkamp-Perez in Washington, Jake Angelos in Massachusetts, and formerly Jared Golden in Maine, it's really just going to be, Republicans will try to make it circa Nancy Pelosi 2006, 2008, but it's really not going to fly when Americans are more concerned about increasing health premiums, increasing energy costs, and the potential threat of AI.
George Pollack of Signum Global, thank you so much for being with us. Have a wonderful new year. I'm sure we will catch up with you in 2026. Right now, what we do see in markets is a fourth day of softness as traders essentially stay on the couch. It seems like there's not a lot of motivation to get off of it and take any action. The last economic indicator that we get of 2025 will be coming at 8:30 a.m. Eastern. That will come in the form of jobless claims. Coming up, we'll be wrapping up a volatile year for commodities, including our conversation with Chevron CEO Mike Wirth. We have seen the biggest one-year decline in oil futures going back to 2020. We'll discuss why. Plus, Lizzie Burden with your morning movers. Nike jumping after a big stock purchase by its chief executive. Those shares up almost 2%. From New York, this is Bloomberg Surveillance. Good morning. It looks like we're setting up for a fourth day of losses, although meager losses after a blockbuster year for equities, the third in a row right now, just taking a little bit of heat out of that 0.2% decline on the S&P, leaving out that euro-dollar cross around the same place where we've been for quite a while at that 117 mark, 411 on the 10-year with yields lower by about a basis point. Silver, look at that, lower by 5.6%. Yesterday it was higher by 5.8%. The day before it was down by 9%. No wonder that the CME Group is raising its margin requirements for the second time in a week. 3 hours away from the cash open, here are your morning movers with Lizzie Burton. Lizzie.
Hey, Lisa. Well, we're going to kick off with Nike shares.
This message is brought to you by Apple Card. Isn't it time you earn daily cash back on your everyday purchases? Apply for Apple Card in the Wallet app to see your credit limit offer. Subject to credit approval, Apple Card issued by Goldman Sachs Bank USA, Salt Lake City branch. Terms and more at applecard.com.
News when you want it with Bloomberg News Now. I'm Nathan Hager. President Trump is trading threats with Iran as protests continue in cities across that country. The president says the U.S. is ready to come to the rescue of demonstrators if authorities crack down on the unrest. We get more from Bloomberg's Laura Davison in Washington.
This was a social media post that hit about 3 o'clock in the morning, where he said the U.S. is also, quote, locked and loaded, if the Iranians used lethal force against some of these protesters. So this is, sort of a clear escalation here, and Trump, indicating that the U.S. would be willing to get involved in yet another foreign conflict, not unlike what we've seen, playing out with some of the saber rattling regarding Venezuela as well.
Bloomberg's Laura Davison reports the head of Iran's Security Council responded to the president on X, saying U.S. interference would destabilize the whole region. In Switzerland, authorities say many of the people who were injured in a ski resort bar fire are fighting for their lives. The death toll now stands at 40 still from that New Year's Eve blaze in Crans-Montana, but more than 100 are seriously injured. This man survived and spoke through an interpreter.
A woman climbed onto another woman's shoulders with 2 bottles with birthday fireworks in, and she held them too high, close to the ceiling, and suddenly it caught fire.
Police say 113 survivors have been identified. 6 more are in the process. Some victims are being treated as far away from the scene as Stuttgart, Germany, Milan, and Paris. In Ukraine, Russian authorities say 27 people were killed in a New Year's Eve drone strike on a cafe in a Russian-occupied village in Ukraine's Kherson region. They say they've opened a criminal terrorism probe. Ukraine denies targeting civilians. Meantime, Ukrainian President Volodymyr Zelensky has named military intelligence chief Kirill Budanov as his new chief of staff. Zelensky's previous chief, Andrei Yermak, resigned amid a sweeping government corruption scandal. Back in this country, New York City's new mayor, Zoran Mamdani, is set to make an announcement this afternoon, a day after making plenty of announcements in his inaugural address.
City Hall will deliver an agenda of safety, affordability, and abundance, where government looks and lives like the people it represents.
Mayor Mamdani announced 3 executive orders related to housing affordability after his inauguration. Other promises like universal child care could face a challenge, as we hear from Bloomberg News senior reporter Miles Miller.
He thinks the funding source for that right now should be raising tax.
Vehicle sales officially giving up the crown as biggest EV maker in the world to China's BYD. But Bloomberg's Craig Trudell reports Tesla CEO Elon Musk has been turning his focus away from cars.
He does also talk quite a bit about robo-taxis, and yet in terms of execution there, we have vehicles in Austin and in the San Francisco Bay Area that are operating still with people supervising up front. And, yes, the company did do some testing toward the very end of the year, some driverless testing, but, that would put them years behind Waymo on that front.
That's Bloomberg Global Autos editor Craig Trudell. As another one of Elon Musk's companies deals with a setback, XAI's artificial intelligence chatbot Grok has been creating sexualized images of minors.
Health is in perfect condition, so that's kind of the main takeaway from that interview.
Bloomberg Government's Maeve Sheehy in Washington, and in the Truth Social post, President Trump also said he aced a cognitive exam for a 3rd straight time. He made a similar claim last month. That's news when you want it with Bloomberg News Now. I'm Nathan Hager, and this is Bloomberg.
There are lots of renewables, but it's worth mentioning that oil demand in the broad terms continues to tick higher. Gas demand is ticking higher. Coal demand has yet to peak in the Chinese economy. So it remains a very energy-hungry economy. And so you're not going to lose huge amounts of oil demand from China, perhaps. And we have other economies coming to fill the gap. India, of course, but other emerging economies in Asia, in Africa, in Latin America.
Will Kennedy, thank you so much for being with us. As always, have a wonderful new year. Meanwhile, crude is not there yet. It's on track for its deepest annual loss since the pandemic. Producers weighing geopolitical tensions against concerns about that global glut we were just speaking with. Earlier this month, Anne-Marie and myself caught up with Chevron CEO Mike Wirth and discussed his outlook for 2026 and beyond.
We make our investment plans on a long-term basis. We look at supply and demand.
As a longtime foreign correspondent, I've worked in lots of places, but nowhere as important to the world as China. I'm Jane Perlez, former Beijing bureau chief for the New York Times. In our third season of Face Off, the US versus China, we'll explore some of the biggest issues dividing these global powers today. Trump and Xi Jinping, AI, China's growing military might, and also robots. New episodes of Face Off are available now, wherever you get your podcasts.
This message is brought to you by Apple Card. Isn't it time you earn daily cash back on your everyday purchases? Apply for Apple Card in the Wallet app to see your credit limit offer. Subject to credit approval. Apple Card issued by Goldman Sachs Bank USA, Salt Lake City branch. Terms and more at applecard.com.
The social media trend that's landing some Gen Zers in jail. The progressive media darling whose public meltdown got her fired, and the massive TikTok boycott against Target that actually makes no sense. You won't hear about these online stories in the mainstream media, but you can keep up with them and all the other entertaining and outrageous things happening online, in media, and in politics with the Brad vs. Everyone podcast. Listen to the Brad vs. Everyone podcast on the iHeartRadio app, Apple Podcasts, or wherever you get your podcasts.
Bloomberg Audio. The end product is this amazing tool you can find at Bloomberg.com.
What I try and do is take the top line calls and then we piece them all together in the feature and we make it searchable. You know, you can filter by the financial institution or by the topic or by the asset. And it allows you to compare and contrast all the different calls.
Sam identifies each firm's base case for the economy and markets. And what he's keeping an eye out for are high conviction calls.
Lots of them are very much, they sit on the fence. They say, well, this could happen or that could happen.
No conviction.
We're optimistic, but there are risks. Or you get these ones that try and be creative and thematic, and they will say, here are the top 5 trends that we think will shape humanity in the years ahead. They are ultimately their marketing tools. But some of them can be super interesting, either super bullish or super bearish.
It may not surprise you, given how 2025 shaped up, that the biggest theme for 2026 is artificial intelligence.
The thing that sort of leapt out of me in this year's outlook was this idea that everyone on Wall Street, or seemingly everyone on Wall Street, is bullish about AI. They talk of it as a game-changing, revolutionary technology. But at the same time, the biggest risk that most of them see is that the AI investment cycle is overhyped, that we could be in a bubble, and that things could turn ugly.
And it wasn't lost on me, as I talked to Sam about all the work that went into this project, that maybe AI, the technology that led markets to record highs, could have made his job a lot easier.
Actually, in the end, I made a point of not using AI for this. I used the same method that I was using 7 years ago, which means possibly I'm inserting my own bias and misfunctioning brain instead of AI's, but at least it's consistent over the years.
I'm David Gura, and this is The Big Take from Bloomberg News. Today on the show, from AI to geopolitical risks to gold, what Wall Street expects for 2026. Sam, we're at this moment where more investors seem to be questioning or thinking differently about AI's growth, in particular how much money is being poured into the infrastructure that powers AI. How does Wall Street see that playing out in 2026?
On balance, they lean on optimism here. most of them see the transformative power of AI, changing the way we work, changing the way we innovate, boosting productivity. They also look at the expenditure and say, well, who's paying for all this? And in many cases, these multi-billion-dollar deals that we see hit the headlines, the company behind them is one of the tech mega caps, heavily cash rich. They can afford to make this expenditure until they see returns on it. And these tech mega caps, their earnings are still super solid. It's not like the dot-com where the firms that were throwing out these huge deals didn't really have earnings potential, were very concentrated. The Magnificent Seven are highly diversified companies with massive earnings potential. So a lot of Wall Street takes comfort from that, and it sort of backs them into thinking that this AI expansion is going to be sustainable for the near future, at least.
Are there any outliers of note, anyone who is calling this a bubble definitively?
There's not an awful lot this year. There's not an awful lot of kind of outlier firms. Vanguard springs to mind. They're very cautious on the valuations currently being quoted for the Magnificent Seven. They're worried about it. But even there, they say, we think the market's overconcentrated. We think these companies are potentially overvalued, but we don't recommend you get out of AI investing. Instead, look for the second order sort of companies, the ones who will benefit from AI, or look for the infrastructure investments that are tied in with it.
2025 was this year in which so much focus was on and so many of the returns came from just a handful of stocks. It's also true of 2024, I should say. All the while, there's been this conversation, this persistent conversation in the background about whether this market is going to broaden out, the need for it to broaden out. As these strategists look ahead to 2026, is there any confidence that is going to happen?
They certainly think so. A lot of the recommendations are AI is not a bubble, or it's not yet a bubble, but given the valuations and the market concentration surrounding the mega caps, it may be time to diversify. And by diversify, they mean look for the sectors that are going to really benefit from implementing AI, look at where this expenditure is going, so in infrastructure, in data centers. So these outlooks are telling us, get ready for this market to broaden out. But would just point out, this isn't the first year we've heard that, and probably not the second year we've heard that either. I was interested to write the summary section for AI, and as I wrote it, I was actually on the back end in the system we use, I was deleting the old one from last year. And the old one from last year was talking about, we expect the gains of AI to broaden out into more sectors and, look for the winners from AI. So it seems like we're still waiting for that broadening out and for those sectors to really adopt and apply it. So a good question is whether in a year's time we're going to be having a very similar conversation to this, I suppose.
Sam, what about other risk assets? I'm thinking stocks, commodities. Does Wall Street expect they're going to continue to climb?
Yeah, mostly. Again, off the back of the AI boom and the frenzy around that, plus we have very fiscally loose governments, plus we have central banks leaning towards easier policy in most major geographies. All of these things are seen as a tailwind for risk assets. So while no one's predicting huge double-digit returns this year, everyone seems pretty confident that you're better off being invested than not, put it that way.
I wanted to ask you about gold. What do these outlooks say about the prospects for assets that aren't risky, ones that are considered kind of more haven or safer assets?
Yeah, there's some advice to look for new hedges. I think one thing noted that given the situation where we've potentially got short-term borrowing rates coming down, but very fiscally expansive programs in government, that means the long-end yields are going to stay high, so a steeper curve. What that can mean is that maybe bonds will provide you income. They're not necessarily going to act as that hedge against equity risk. So there's talk about where you find your hedges. Gold is still up there. Seems like not many firms want to predict the end of gold's upswing.
We start 2026 with the Federal Reserve still very much focused on inflation, higher than it wants it to be. also very clearly worried about future prospects of the labor market. What did you learn, Sam, from these outlooks about sort of what Wall Street expects from the economy in 2026?
Yeah, so it's interesting. The Fed is definitely a big question because they are very much seen caught between slowly declining but still very sticky inflation that's way above target and a labor market that is sort of feeling the pressures of rising costs, of tariffs, and the political pressure, let's face it, from the Trump administration for lower rates. And we also have the Fed chair set to be replaced, a number of votes surrounding other members of the Federal Reserve. On balance, mostly people expect the Fed to ease a little bit, but the stickiness of inflation will mean they can't go quite as far as perhaps Trump and the politics want. Economy-wise, the various tailwinds mean moderating growth, most of them saying growth's going to be pretty much in line with the long-term trend.
Another big theme in 2025 was private markets, private credit, and a couple of bankruptcies in that space that really raised worries that an economic downturn could maybe expose troubled companies. We had JP Morgan Chase CEO Jamie Dimon now famously warning that when you see a cockroach, there are probably more that could emerge in this space. I'm curious how much ink was spilled about that in these outlooks, kind of raising concern, raising questions, thinking about sort of the way that private markets are going to play a continued role in the economy in 2026.
Yeah, a lot of them tackle that pretty much head on. They see the various, the cockroaches as pretty much contained, to be honest. There's a lot of positivity around private markets still, private equity and credit, various credit structures. I think their argument is that it's a good diversifier, that the returns are potentially good, that mostly companies, corporations are in pretty rude health. It does bear saying, though, that most of them say private markets look good, but what you need is expertise to guide you through it, and we're the ones to give you that expertise. So I'm always well aware that the more complicated or obscure or hard to invest in the market, the more money that Wall Street can make from helping you invest in it. So, yeah, a lot of talk about private markets. They think that bandwagon has got some distance to go yet.
Coming up, how accurate were last year's calls? And what does that say about how we should look at this year's?
This message is brought to you by Apple Card. Apple Card members can earn unlimited daily cash back on everyday purchases wherever they shop. This means you could be earning daily cash on just about anything, like a slice of pizza from your local pizza place or a latte from the corner coffee shop. Apply for Apple Card in the Wallet app to see your credit limit offer in minutes. Subject to credit approval. Apple Card issued by Goldman Sachs Bank USA, Salt Lake City branch. Terms and more at applecard.com.
You can get the news whenever you want it with Bloomberg News Now. I'm Amy Morris.
And I'm Karen Moscow, here to tell you about our new on-demand news report delivered right to your podcast feed. Bloomberg News Now is a short 5-minute audio report on the day's top stories. Episodes are published throughout the day with the latest information and data to keep you informed.
Yes, there are other products like this from a variety of news organizations, but they usually rerun their radio newscasts throughout the day. That's not what we do. We create customized episodes that can only be heard on Bloomberg News Now.
And we don't wait an hour to publish breaking news. When news breaks, we'll have an episode up in your podcast feed within minutes, so you're always getting the latest stories and developments.
Get the reporting and the context from Bloomberg's 3,000 journalists and analysts. We're all over the world. Listen to the latest from Bloomberg News Now on Apple, Spotify, or anywhere you listen.
The social media trend that's landing some Gen Zers in jail. The progressive media darling whose public meltdown got her fired.
I'm going to take Francesco off the network entirely.
The massive TikTok boycott against Target that makes no actual sense.
I will continue getting stuff from Target, and I will continue to not pay for it.
And the MAGA influencers whose trip to the White House ended in embarrassment.
It's so refreshing to have
the press secretary after the last few years who's both intelligent and articulate.
You won't hear about these online stories in the mainstream media, but you can keep up with them and all the other entertaining and outrageous things happening online, in media, and in politics with the Brad vs. Everyone podcast, hosted by me, Brad Palumbo. Every day of the week, I bring you on a wild ride through the most delulu takes on the internet, criticizing the extremes of both sides from an independent perspective. Join in on the insanity and listen to the Brad vs. Everyone podcast on the iHeartRadio app, Apple Podcasts, or wherever you get your podcasts.
Bloomberg's Sam Potter has done this analysis of Wall Street outlooks for 7 years in a row now. And while he looks ahead, Sam also takes stock of how accurate the preceding year's outlooks were. So I asked him how often Wall Street's predictions pan out.
That's so hard to answer because so often they couch everything in this could happen, this may happen, this is what we're worried about. I think if you're in our business, if you're in the financial business, what you're probably dealing in as much as anything else is ideas and possibility. And oftentimes the audience to these things are going to be making their own mind up as well. They're going to be experienced professionals. They're going to have their own expertise. When I look through them, I'm looking for anything that jumps out as unique or sticks out about a year ahead. And also the common themes. So when we see dozens of reports saying we don't think AI is a bubble, that lends you some maybe confidence. I don't know, maybe we should be worried that everyone thinks it's not a bubble. Maybe that's the contrarian warning sign.
Sam says one of last year's most prescient calls also involved breaking from the pack.
We saw that actually in 2025. One that stood out last year, BCA were extremely bearish on tariffs. And they basically in their outlook said, everyone's underestimating Trump and what he wants to do with tariffs. It's going to be ugly. This is what we think is going to happen. And of course, come April, they were pretty much spot on.
Sam, you've been through this cycle a few times now, and every year you start with a stack of calls that may look totally reasonable. What sort of things tend to upend them? What are the X factors?
Geopolitics is always the one that they worry most about because it's the hardest to foresee, particularly with Trump administration, and he's a fairly unpredictable guy. In fact, at one point that was seen as a deliberate policy that he would sort of surprise people. But the shocks, I think it's not so much shocks they're worried about this year as any major shift in trend. So AI, maybe it's a bubble, maybe it isn't a bubble. Even if it's not a bubble, if confidence starts to wane in AI, then it would be like the tanker turning. It would be a big mega trend turning. And in credit and private markets, if they're wrong and there are more cockroaches than they think, again, it could bring to an end a sort of long-term trend. If Trump does do something unexpected and there is more trade friction and inflation actually starts to increase, a big inflation shock is actually probably that's one of the biggest potential tail risks that people say. That's the fat tail. If inflation goes the wrong way, then it throws so much other stuff, fiscal, monetary, out of the window.
We've talked about AI, we've talked about the mega caps, talked about this narrow market. When you compare the outlooks for 2026 to the outlooks for 2025, how much do they have in common? How similar are they this year to what we saw last year?
Thematically, last year I remember leading the story part of the feature with Trump because he had just been re-elected. He was set to take office, and that kind of overhung everything. Obviously, that's much more, if you can ever call Trump a known quantity, but it is much more of a known quantity now. The tariff situation is seen as stable, if not settled. So we've been able to move on from last year, move on a little bit from Trump. I think people also look ahead and see the midterms and think that might restrain Trump's excesses a little bit. But there remain some big similarities.
Before I let him go, I asked Sam how he hopes people in the industry, readers, and the generally curious will use his tool.
So I think that such is the volume of stuff that Wall Street produces for the year ahead, and so sort of disparate. I don't think people have the time or necessarily the easy access to read it all, to consume it all. I hope what I do, if nothing else, is give them a tool that aggregates and allows them to compare and contrast, and it allows them to sort of fix their place in the Wall Street universe, their firms standing alongside others. I'd also hope that if I was in the industry, I'd want to be checking it and make sure that I wasn't accidentally in a huge outlier position with all my money on betting against AI or something when everyone else on Wall Street feels differently.
This is The Big Take from Bloomberg News. I'm David Gura. The show is hosted by me, Juan Ha, and Sarah Holder. The show is made by Aaron Edwards, David Fox, Eleanor Harrison Dengate, Patty Hirsch, Rachel Lewis-Kriski, Naomi Ng, Julia Press, Tracy Samuelson, Naomi Shavin, Alex Segura, Julia Weaver, Yang Yang, and Taka Yasuzawa. To get more from The Big Take and unlimited access to all of Bloomberg.com, subscribe today at Bloomberg.com/podcast offer. Thanks for listening. We'll be back on Monday.
I'm Barry Ritholtz, inviting you to join me for the Masters in Business podcast. Every week, we bring you fascinating conversations with the people who shape markets, investing, and business. CEOs, fund managers, billionaires, Nobel laureates, traders, analysts, economists, everybody that affects what's going on in the market. Whether you own stocks, bonds, real estate, commodities, crypto, you really need to hear these conversations. Sometimes it's behaviorists like Dick Thaler or Bob Schiller. Sometimes it's fund managers like Peter Lynch, Bill Miller, Ray Dalio. Sometimes it's authors, Michael Lewis, author of The Big Short and Moneyball. Regardless of the conversation, these are the folks that move markets each week. That's the Masters in Business podcast with me, Barry Ritholtz. Listen on Apple, Spotify, or wherever you get your podcasts.
The social media trend that's landing some Gen Zers in jail, the progressive media darling whose public meltdown got her fired, and the massive TikTok boycott against Target that actually makes no sense. You won't hear about these online stories in the mainstream media, but you can keep up with them and all the other entertaining and outrageous things happening online, in media, and in politics with the Brad vs. Everyone podcast. Listen to the Brad vs. Everyone podcast on the iHeartRadio app, Apple Podcasts, or wherever you get your podcasts.
Bloomberg Daybreak is your best way to get
on the latest in global news, politics, and international relations.
Listen to the Bloomberg Daybreak U.S. edition podcast each morning for the stories that matter with the context you need.
Find us on Apple, Spotify, or anywhere you listen. News when you want it with Bloomberg News Now. I'm Nathan Hager. President Trump is trading threats with Iran as protests continue in cities across that country. The president says the U.S. is ready to come to the rescue of demonstrators if authorities crack down on the unrest. We get more from Bloomberg's Laura Davison in Washington.
This was a social media post that hit about 3 o'clock in the morning, where he said the U.S. is also, quote, locked and loaded, if the Iranians used lethal force against some of these protesters. So this is, sort of a clear escalation here, and Trump, indicating that the U.S. would be willing to get involved in yet another foreign conflict, not unlike what we've seen, playing out with some of the saber rattling regarding Venezuela as well.
Bloomberg's Laura Davison reports the head of Iran's Security Council responded to the president on X, saying U.S. interference would destabilize the whole region. In Switzerland, authorities say many of the people who were injured in a ski resort bar fire are fighting for their lives. The death toll now stands at 40 still from that New Year's Eve blaze in Crans-Montana, but more than 100 are seriously injured. This man survived and spoke through an interpreter.
A woman climbed onto another woman's shoulders with 2 bottles with birthday fireworks in, and she held them too high, close to the ceiling, and suddenly it caught fire.
Police say 113 survivors have been identified. 6 more are in the process. Some victims are being treated as far away from the scene as Stuttgart, Germany, Milan, and Paris. In Ukraine, Russian authorities say 27 people were killed in a New Year's Eve drone strike on a cafe in a Russian-occupied village in Ukraine's Kherson region. They say they've opened a criminal terrorism probe. Ukraine denies targeting civilians. Meantime, Ukrainian President Volodymyr Zelensky has named military intelligence chief Kirill Budanov as his new chief of staff. Zelensky's previous chief, Andrei Yermak, resigned amid a sweeping government corruption scandal. Back in this country, New York City's new mayor, Zoran Mamdani, is set to make an announcement this afternoon, a day after making plenty of announcements in his inaugural address.
City Hall will deliver an agenda of safety, affordability, and abundance, where government looks and lives like the people it represents.
Mayor Mamdani announced 3 executive orders related to housing affordability after his inauguration. Other promises like universal child care could face a challenge, as we hear from Bloomberg News senior reporter Miles Miller.
He thinks the funding source for that right now should be raising taxes on the wealthiest New Yorkers. The governor, obviously going into this re-election year, has no appetite for that. So they will find the pay-fors together, working with the state legislature to get that done.
Bloomberg's Miles Miller reporting from New York, where Mayor Mamdani's announcement is set for 2:15 Wall Street time. You can hear it live on Bloomberg Radio or watch on Bloomberg Television or the Bloomberg podcast page on YouTube. As for Wall Street, on this first trading day of 2026, stocks have turned mixed. Right now, the S&P 500's little changed. The Dow Jones Industrial Average is lower by 0.3%. The NASDAQ Composite's holding on to a 0.2% gain. Tesla shares have moved lower now. They are down 1%. The EV maker posted its second straight year of falling vehicle sales, officially giving up the crown as biggest EV maker in the world to China's BYD. But Bloomberg's Craig Trudell reports Tesla CEO Elon Musk has been turning his focus away from cars.
He does also talk quite a bit about robo-taxis, and yet in terms of execution there, we have vehicles in Austin and in the San Francisco Bay Area that are operating still with people supervising up front. And, yes, the company did do some testing toward the very end of the year, some driverless testing, but, that would put them years behind Waymo on that front.
That's Bloomberg Global Autos editor Craig Trudell. As another one of Elon Musk's companies deals with a setback, XAI's artificial intelligence chatbot Grok has been creating sexualized images of minors in response to user prompts in recent days. Grok posted on X that it has identified lapses in its safeguards and is urgently fixing them. Grok has positioned itself as more permissive than other AI models. Last summer, it introduced a spicy mode to allow for more suggestive content. President Trump says White House doctors are reporting him in perfect health. The president posted that on Truth Social this morning after he gave an interview to the Wall Street Journal to try to tamp down concerns about his advancing age. Bloomberg government's Maeve Sheehy has more.
He said that he takes more aspirin than the doctors would like him to, but it's fine. He likes thinner blood coursing through his heart. He said he regrets doing advanced imaging because it raised questions about his health. But basically, throughout the entire interview, he insisted that his health is in perfect condition. So that's kind of the main takeaway from that interview.
Bloomberg government's Maeve Sheehy in Washington. And in the Truth Social post, President Trump also said he aced a cognitive exam for a third straight time. He made a similar claim last month. That's news when you want it with Bloomberg News Now. I'm Nathan Hager, and this is Bloomberg.
This is Scarlett Fu.
And I'm Paul Sweeney, inviting you to join us for the Bloomberg Intelligence Podcast.
Every day, we harness the power of Bloomberg Intelligence to bring you deep dives into the companies that are moving markets, from publicly traded companies like Apple to those that are privately owned but known by everyone on Earth, like OpenAI.
Now, I helped to build Bloomberg Intelligence to what it is today, Scarlett, and now our analysts are the best in the world, covering more than 2,000 global companies.
That is your legacy, Paul, and we speak to those in-house experts every day. They are Bloomberg's go-to authorities on sectors, companies, and legal processes.
And we do it all live each weekday, then bring you the best conversations in our daily podcast.
So be sure to search for Bloomberg Intelligence on YouTube, Apple, Spotify, or anywhere else you listen.
Listen in the afternoons on your way home from work to catch up on the market news you missed during the business day.
That is the Bloomberg Intelligence Podcast. I'm Scarlett Fu.
And I'm Paul Sweeney. Subscribe today wherever you get your podcasts.
This is Tom Keene.
Wedbush out with its top AI stocks for 2026. Dan Ives writing, heading into 2026, investors are both excited and nervous about the AI revolution. 2026 is an inflection point year. Dan joins us now with his colorful self. Happy New Year. Wonderful to see you.
As always.
So let's talk about that. Why is it an inflection point? What do you mean by that?
It's really about, to me, it's about the second, third, fourth derivatives playing out across AI. Look, it's monetization. And you talk about Tesla, it's the next phase in terms of autonomous, robotics, consumer AI, especially when it comes to Apple, and I think what we're going to see. Look, I think it's a prove-it year, but that actually makes me more bullish because I think now we go into the next phase of AI. I think tech stocks are up 20, 25% in 2026, but it's not just big tech, it's about second, third, fourth derivatives playing out.
I will be fascinated to see. I don't think anything is officially expected, but you're going to CES, right, which is not only the biggest tech conference in the world, but has become the most important car maker conference as well. It'll be fascinating to see if Tesla comes out with any other products there, or if we see a lot more robotics and automation products.
Yeah, and to your point, look, it all starts with the godfather of AI, Jensen. He'll be there with the black leather jacket, because when his speech, to me, is just so important on Monday, because it really starts off strategically what AI is going to look like. He's going to talk about physical AI in terms of autonomous robotics. I think the two best physical AI plays in the world today, it's NVIDIA and it's Tesla. And I think that speaks to you talk about like Tesla, what everyone's focused on. This is autonomous chapter now coming to Tesla. I think you see Musk right now, wartime CEO. That's the focus when it comes to AI, but also it's the monetization. Remember, only 3% of U.S. companies have gone down the AI path so far.
Are these robots expected to be like B2B robots, so building things in factories, or like a Roomba for consumers? What kind of products do you expect them to monetize?
Yeah, especially at CES. Look, humanoid robotics is going to be front and center, autonomous. You're seeing flying cars. A lot of the presence, you talk about a lot of the tensions between U.S. and China. The presence of Chinese companies is going to be, it's going to be a monster in terms of what we see there. I think doubling, over the last few years. But I think it's really going to be about humanoid robotics. It's going to be about autonomous, but this is also going to be about more embedded AI devices that consumers are going to see. CES, we're not just talking about flying drones and refrigerators that talk to you. Now these are much more sort of front and center in terms of it's a who's who. Every big tech player is going to be there, even if they're not unofficially there. They're there to look for acquisitions.
I love the idea of opening the refrigerator and having it say, do you really want that? I mean, I can just imagine the future for, move over Ozempic. So there's this question here also about what some of the moves in late 2025 mean. And I'd love your take on this because we saw some acquisitions made by the likes of Meta and NVIDIA. And I just wonder whether there's more cost consciousness and more of a competitive advantage that they're looking to solidify at a time where suddenly companies are saying, hold on. What are we paying for this, and what are we actually getting?
Look, I think you hit on a great point because the reality is it's an arms race. That's what's going on with big tech, and right now, at the top of that mountain is big tech. And when you look at like Google's win versus DOJ, antitrust, I mean, this is sort of go time for big tech. And I think you're going to see more and more acquisitions. And we've talked about not just on enterprise, on energy, and I think really across the board. And it speaks to really what we're seeing right here is that it's not just about big tech getting bigger and bigger, doing acquisitions, spending. You're going to have $600 billion in CapEx in big tech, but it's also you're going to see other players being like, don't forget about me. Look at AMD. You're going to see look at Cisco, look at IBM. I mean, there's going to be a lot of other players saying like, hey, we want to get into that AI party. We don't want to look through the windows. Like a lot of the bears are.
We were talking about BYD triumphed over Tesla to become the world's biggest electric vehicle manufacturer. We also have seen big tech in China outperform on an equity market perspective in 2025. Do you expect that to continue and for China to really solidify more of its neck-and-neck position with the U.S. or even supersede it?
Look, I think the reality is for the first time in 30 years, U.S. is ahead of China when it comes to tech. And I think that's very important, obviously led by NVIDIA, Microsoft, Palantir, and others. But in China, look, we're bullish on China tech. We talk about Alibaba, you look at Tencent, you look at a lot of the other names there. I think what you're seeing is it's a narrowing, but it's something where you're seeing robotics really play front and center, autonomous, EVs, BYD, and others in China. But when you think about how to play it, you have to play U.S. tech, and then there are Chinese tech players to go after. But in terms of AI revolution, like we've said, it's third inning, one out, relative to this AI game. And I think the bears, like I said, like in hibernation mode, they can see AI in the spreadsheets. And I think 2026 is going to be a year that's going to be another bull market year for tech and for AI.
I had really the same question as Lisa again, because we've seen so many stories this morning about Baidu's chip unit filing for an IPO, another chip designer, I think Breiner, with a very successful IPO today, maybe another mini DeepSeek moment, right, with a cheaper artificial intelligence, all among the most read stories on the Bloomberg terminal. So clients are paying attention to what's going on in China with AI. How do you bet on that? I mean, do you buy the individual stocks? Is there an ETF that you like? Do you have some of these stocks in your ETF?
Yeah, sure. So obviously, for the IVES ETF, I mean, what we really focus on is the AI 30. It's like who are the 30 winners? We have a few of the Chinese players in there. I think Baidu, you look at Huawei in terms of the success they're having. Look, right now, NVIDIA's 4 to 5 years ahead of any other chip player. And I think that's well known. That's why even a third-rate H200 restricted, China big tech's going to line up despite what the politics in Beijing. But this is an arms race. It's the narrowing of the gap. You want to play some of those Chinese tech players. But the reality is in the U.S., from NVIDIA, AMD, we talk about our top 5, Palantir, CrowdStrike, and cybersecurity. Tesla, I think it's going to be the most important year ever for them. Microsoft, I think on hyperscale right now, Microsoft, Oracle, those are names, I think, table pounders in my opinion in terms of what we see. And then Apple, finally, they come to the AI party instead of being on the treadmill at 2.0 speed. And now they actually start to get in terms of the consumer AI revolution, $75 to $100 per share.
There's only one company that you didn't mention that's on your list, and that's Microsoft. Where is Microsoft in terms of winning out versus Google? Who is its main competitor?
Look, in terms of Redmond, the enterprise, this is their backyard. When you think about companies that are moving to AI, the first phone call goes to Nadella. And I think you're seeing Google, you're seeing Amazon, what Jassy's doing, they're narrowing the gap and they're going to be successful. But when I look at Microsoft, you have 25, 30 billion incremental monetization that I don't even think is factored into street numbers. That's right, in the stock ultimately has a 6 in front of it. And I think this is going to be, we're going to go into January, into earnings season. I think that's going to be kind of the show me story, showing like, look, this is not stopping. Like we said, AI party started at 9 p.m. It's now 10:30, 10:45 p.m.
Me and Lisa are asleep.
Yeah, 100%. That's exactly what I was thinking.
But the party goes to 4 a.m. And that's where we are.
Locked and loaded. President Trump saying the U.S. is ready to rescue Iranian protesters if they are attacked by authorities. Protests escalating over the country's deepening economic crisis. Bloomberg's Tyler Kendall joins us now from Washington. Tyler, locked and loaded. What does that mean?
Yeah, hey, Lisa, good morning. Well, President Trump did not provide specifics on what actions he was considering taking, but it does mark an escalation in what has been a series of threats in recent days by the U.S. Earlier this week, President Trump vowed next to Israeli Prime Minister Benjamin Netanyahu to strike Iran again if it rebuilds its nuclear program. Of course, international sanctions against Iran's nuclear ambitions have led to the widespread economic problems that are fueling these protests, from inflation to a currency that's rapidly depreciated, losing 60% of its value since the June war with Israel. Now, our analysts at Bloomberg Intelligence say that there is a very strong likelihood that we could see Iran taking a more heavy-handed approach to these protests if they do continue in the coming days. And while President Trump has long vowed to curb Iran's nuclear ambitions, these remarks overnight do signal more of a willingness to intervene in a foreign crisis, something that he broadly campaigned against, but of course comes against this broader geopolitical backdrop that the White House has been escalating tensions with Venezuela, taking in recent days actions to curb the so-called shadow fleet that Venezuela
Hi,
and
I'm
Iran
Kim
actually
Vanel
share.
in Wanganui, New Zealand. It's Friday, January 2nd. Today, Switzerland is left reeling after the death toll from a New Year's fire tops 40. Tesla hopes for a better 2026. And China launches a so-called condom tax to try and boost birth numbers. This is Reuters World News, bringing you everything you need to know from the front lines in 10 minutes, 7 days a week. Residents of the Swiss ski resort Crans-Montana are in shock after a New Year's fire killed dozens. Now, a convoy of vans are waved through police tape to retrieve the dead. More than 100 people are injured, most of them severely. Officials say the burns the mostly young partygoers suffered were so severe that identifying the dead could take days.
Et puis il y a tout le processus, et je crois qu'il ne faut pas le sous-estimer, d'identification.
Swiss federal president Guy Parmelin saying on a visit to the resort that efforts will be made to identify victims as efficiently as possible, calling the fire one of the worst tragedies in Switzerland's history. Reuters correspondent Emma Farge is there.
What we know is mostly from witnesses and social media footage. The pictures on social media, some of which witnesses are starting to confirm, show sparkler candles in champagne bottles being carried through the bar. That caused the ceiling to catch fire. That spread very, very quickly throughout the bar and actually then caused some sort of explosion. Now, Swiss authorities are ruling out any sort of attack. This is being treated as an accident right now, but in a closed space with lots of people, apparently flammable materials, including wood, possibly other soft materials. This fire spread very, very quickly. Within minutes, we had a catastrophe where people were panicking and trying to get out. The identities have not been officially released from Swiss officials. We know that they're young people, also from social media footage. They have pictures of people, and these are baby faces.
Emma says the scale of the incident in the resort town has created paradoxical scenes.
I arrived yesterday morning, 24 hours ago. There's a lot of people in shock. So on the scene yesterday morning, New Year's Day, people were sort of walking about glassy-eyed, just in disbelief. But then there's also people going about their normal lives, their holidays. This is peak season, so you see ski instructors with their red outfits carrying their skis. You see children. You also see people from all over the world having a good time. So that's the scene.
Russia and Ukraine have traded accusations of deadly attacks on New Year's Day, with Moscow reporting a deadly strike on a hotel in territory it occupies in southern Ukraine, while Kyiv said there had been another broad attack on its power supplies. And a new twist in the back and forth over another allegation from earlier in the week that Ukraine tried to attack Russian President Vladimir Putin's residence. Moscow says it has evidence which it will give to Washington. A senior Russian military chief handing over what he says is part of a Ukrainian drone to a US military attaché, saying it contains data proving the drone was targeting Putin's house. Ukraine and Western countries have disputed Russia's account of the alleged attempted strike. Russia previously said it plans to review its negotiating stance with the US on ending the war in Ukraine as a result of the alleged attack. But with the negotiations up in the air, Russia appears to be asking Washington for a favor. Moscow has made a formal diplomatic request for the US to stop its pursuit of an oil tanker in the Atlantic Ocean. That's according to a New York Times report. The tanker was headed to Venezuela when the US Coast Guard gave chase, a chase which almost 2 weeks later is still ongoing. The US has seized a number of oil tankers in the area and launched strikes on alleged drug boats, all part of a campaign by President Trump to heap pressure on Venezuela's President Nicolas Maduro. Now, Tesla has had a tough 2025 as the loss of US tax credits and rising global competition has weighed on demand. Analysts expect Tesla to report falling fourth-quarter deliveries and a second straight annual decline in vehicle sales. But as our correspondent up here at Roy's reporting, the company's hoping 2026 will bring a more positive outlook.
Well, sales for Tesla and frankly for the entire EV industry has been affected in the fourth quarter by the removal of US tax credits at the end of September. The expiring tax credits actually had boost sales in the third quarter, but Tesla's problems started much earlier. There's rising global competition against Tesla's aging lineup of vehicles. And early this year, there was a major backlash against Elon Musk for his far-right political rhetoric and work for the Trump administration. Those actually hurt Tesla sales in the first and second quarter.
Up Europe says Tesla has a bit of a balancing act to do in 2026.
Analysts actually expect Tesla sales to recover in 2026 after Tesla launched stripped-down versions of its Model Y and Model 3 vehicles. Those are expected to help sales in Europe and Asia, where Chinese EVs are gaining ground. But in the US, Tesla still faces stiff competition from a slew of affordable vehicles that are about to hit the market next year. But Elon Musk's big goal is to expand robotaxis and launch humanoid robots. Much of Tesla's valuation actually hangs on that big bet.
And Elon Musk seems to have big hopes this year for another one of his companies, Neuralink. In a post on X, Musk says his brain implant company will begin high-volume production of brain-computer interface devices this year and will move to fully automated surgeries to implant them. Neuralink started human trials in 2024 after addressing FDA safety concerns and says it's since implanted 12 patients worldwide. Several people are reported to have died in Iran as protests over the cost of living have turned violent. The semi-official Fars news agency says that 3 protesters were killed during an attack on a police station in the western province of Loristan. More deaths and arrests have been reported elsewhere in the country. Iran's clerical rulers are grappling with Western sanctions that have battered an economy already reeling from more than 40% inflation. Authorities are offering talks, but security forces remain on high alert. A so-called condom tax has come into effect in China. Really, it's a 13% tax increase on all contraceptives, and it's part of a wider effort by Beijing to encourage people to have more babies. China's declining birth rates were spurred on by the one-child policy, which ended in 2015, which means there are fewer women to have babies in the first place. Farah Master in Hong Kong has more.
China's been trying for the past few years to increase the birth rate by offering subsidies, including those for housing, and also like within universities and schools, trying to teach like love and marriage courses. So this year, they're really trying to make childcare cheaper. So they're trying to make preschools free and much of like middle school, high school. They're trying to ensure that the cost of childcare is as low as possible. This is also happening at the same time that they're trying to make the cost of birth as low as possible, like making the costs of childbirth, including checkups, fully reimbursable on insurance. It's a big hindrance for many people just because it's so expensive.
And for today's recommended read, a special report on just how Israel's truck bombs ripped through Gaza City. You can follow the link in the description to see the report from our graphics team on how, in the weeks before the ceasefire, Israel deployed a new weapon, armoured personnel carriers repurposed as explosive-laden bombs. And as it's a Friday, we have a recommended listen too. So we want to let you know about tomorrow's episode of our On Assignment podcast, which is all about Syria's Alawite.
Going to happen to Maduro and his regime.
Kate Sullivan, thank you so much, as always, for joining us and for that insight. China is reportedly requiring chip makers to use at least 50% domestically made equipment for adding new capacity. According to a Reuters exclusive, the rule is not public, but chip makers are being told they must prove that at least half of their equipment will be Chinese made. It comes after a lot of speculation about how much U.S. chip makers are really going to be allowed into China as a very nationalistic push happens there. Guy, how important is it to really see things like this in addition to Meta's recent acquisition of Manus? This question of if you sell it, will they come? If the U.S. can sell some of these chips, will China buy them?
The answer appears to be, well, probably no at this point, doesn't it? It's really interesting that NVIDIA keeps trying to push for the idea that maybe it should be able to sell chips into China, trying to get the White House maybe to give it the green light, and it appears to be making progress on that front. But the Chinese are the problem here. It's fascinating. Jensen Huang's biggest problem is not the White House, it's what's happening in Beijing. The Chinese clearly feel that they have to catch up. They clearly feel that this is an area that they have to make progress in. It's just interesting in terms of the imbalances that exist within this space. The US has the chips, but maybe doesn't have the electrons, the power. The Chinese have the power, but don't necessarily have the chips. Kind of, how does that even out, and what will that race look like in 2026? The Chinese desperate to catch up on the chip front. That feels like it could be something that you could do faster than maybe catching up on the electricity front, which maybe gives the Chinese the advantage at this point.
Well, right now, the advantage really goes to metals because that has been the one area as everyone tries to build out the physical world that continues to get bid. Silver, meanwhile, recovering some losses after its biggest one-day drop in more than 5 years. Supply shortages keeping the metal on track for a monthly gain of close to a third. Bloomberg's Christine Aquino joins us now for more. Christine, before we get into the bigger trends, just can you talk a little bit about how much leverage, how much sort of fast money is behind some of the pretty violent moves that we've seen over the past couple of weeks?
Well, Lisa, the short answer is a lot. There's been a lot of speculation in this market, especially as investors started to observe that silver very much extending the gains that initially were rooted in gold, right? And, initially this was kind of a higher beta play, right? Silver usually seen as a higher beta version of gold. And so when gold started rallying, investors started wondering, where else can I put this momentum behind? And silver became the focal point. But of course, very interesting because silver, very much a precious metal, but it also has very important industrial functions, right? And so we've really seen that speculation ramp up. We've seen, exchanges now having to raise their margins. China's silver play fund, pure silver play fund, turning away new investors. These are just some examples of just measures that authorities and bodies have taken to really curb the speculation that has ramped up so much in the last month or so as silver really turned into very much from a precious metal play, a haven play, to a speculative play. And that's what we're seeing now.
Christine, once silver takes over, once the kind of the gold-silver ratio shifts, what does that tell us? What does history tell us about how much longer the precious metal rally has to run?
Well, Guy, it's very interesting because it really is just boiling down to supply, right? I think that ratio very much a signal for some investors. And again, what we've seen, gold rallying and then silver taking that rally and then extending it so much more. And that is very much a result of that shift in the ratio that you're mentioning, the gold-silver ratio. It hasn't really held above 100 to 1 for very long. And so that, I think, signaled the shift for a lot of investors. But how much longer it can run really just boils down to how much silver is there left to buy. And at the moment, there is a critical shortage of the metal. And this is why we're seeing a lot of these restrictions, a lot of these curbs. And that's not necessarily going to alleviate heading into 2026. We have potential tighter exports coming from China. China's not a major exporter of silver, but, that just really further shrinks the pool of available silver to buy. And then, of course, a lot of real silver actually still stuck in U.S. warehouses as investors await the result of the U.S. Section 232 probe into critical minerals. And so not necessarily a lot of clarity on that front. And so really, it's just going to be a question of supply when it comes to how much further this rally goes. If there's not much clarity on supply alleviating anytime soon, then, this market is going to be very, very tight for the foreseeable future.
Bloomberg's Christine Aquino, wonderful reporting. Thank you so much for being with us. Let's turn to autos, another once demand supply, at least for some of these metals. Tesla lowering expectations for its annual vehicle sales. The EV maker posting a compilation of analyst estimates below averages gathered by Bloomberg. Craig Trudell joins us now. Wonderful reporting, Craig. Just can you lay out how much of a disappointment some of these projections really are for Tesla?
Yeah, I think, just starting off with the fourth quarter, you have this company compiled consensus, as they call it, round numbers looking around 423,000 vehicles. That's a pretty substantial difference between, what Bloomberg's average estimates are. That's around 445,000. So it's about a 22,000 vehicle shortfall. I think, going forward, what's interesting is also not a whole lot of optimism about the outlook for 2026. And we've seen consensus come down for next year pretty substantially as well over the last couple of years where, the expectations for the company was, on this time frame to be selling, 3.5 million vehicles. And we're now sort of seeing, those estimates come down to, yes, higher than what we will probably end up seeing for 2025, but not substantially so, and sort of a continued rut for this company that was once growing really like gangbusters year after year.
Craig, does it matter? Honestly, does it matter? If you're a shareholder in Tesla, does this matter?
Lately the answer to that has been no. And I think what's really fascinating here is that you seem to have this, coalescing consensus around two ideas that seem to be very much in conflict with one another. On one hand, an expectation that this company is on the verge of, quote unquote, solving self-driving and, rendering its vehicles capable of turning into robo-taxis. And yet, on the other hand, not a substantial change in the sort of sales outlook for this company. You would think that if there's so much optimism about this company's autonomy prospects, that you would see that sort of translate into, oh my gosh, demand is going to shoot up, and yet we're not seeing those move in unison with one another.
Craig, do we have a sense of why Tesla has seen its fortunes kind of shift when it comes to the actual number of cars that it expects to sell? Is it because of some of the political issues around Elon Musk? Is it because of China demand and competition domestically there? Or is it because of the subsidies in the United States, the lack of them, and the fact that people are moving away from electric vehicles here?
Yeah, I would say all the above to some degree. I think particularly over here in Europe, you've seen continued, substantial weakness. I think a lot of that has to do with Elon Musk being something of a turnoff. I think it also has to do with, rising competition with, the sort of quote unquote incumbents, and also the Chinese manufacturers really getting some traction across Europe. In China, you see the domestic players really kind of taking that market and running with it, whereas, Tesla at best has been sort of stable. And in the U.S., you have, to Tesla's credit, they had a great third quarter, in part because of the rush to take advantage of those tax credits you mentioned. But we now are in a paradigm where those have, fallen by the wayside. The Trump administration not only has taken those away, but taken away, fuel economy regulations and emissions rules. So, this is an industry that is kind of, turning back the clock and going back to selling as many big pickups and full-size SUVs as they possibly can. And they're doing that without, sort of any abandon. They're not having to worry about buying regulatory credits from Tesla. So you have not only headwinds for the company from a vehicle sales perspective, but also a part of its business that it's counted on for substantial revenue for many years.
Craig Trudell, thank you so much for joining us and for all the reporting throughout this year. Craig joining us there of Bloomberg News. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burden. Lizzie.
Hi, Lisa. Copper's heading for a 10th day of gains and its longest winning streak since 2017. The surge is adding to the metal's biggest annual climb since 2009. Bulls say tariffs, a weaker dollar and supply issues are all helping to drive up prices for the commodity. Elsewhere, Meta is agreeing to buy Manus, a Singapore-based artificial intelligence agent, to build a business around its AI investment. The deal values Manus at more than $2 billion and marks a rare US acquisition of an Asian tech company. Meta's intending to continue operating and selling the Manus service. And shares of PopMart falling the most in 3 weeks on falling demand for Labubu dolls. The sell-off stemming from reports that scalpers have paused buying the toys. PopMart had staged a dramatic market rally, but has since cooled on weaker than expected holiday season sales and doubts about the company's brand. I'm sure none of those were in your stocking this Christmas, Lisa. That should be my brief.
Thank you so much, Lizzie. Trying to break a streak of 2 days of losses, we are seeing futures churning ahead of the open in this penultimate
but their revenue sources are broad-based, and their viability doesn't hinge on any single AI outcome. Laura joins us now. Laura, wonderful to see you. Thank you for being here in the flesh. One question here is, can you get behind some of this issuance? Because even if they have the revenues, they're levering up at a time of some speculation about the cash needs and, frankly, the end use case.
Yeah, it's a great question. And I think there is valid concern about the monetization of those investments, the volume, the sheer volume of that investment. But ultimately, these are very broad-based. These companies have very broad sources of revenue. We analyze them as we would any other corporate credit. Leverage is modest and manageable, debt service coverage as well. So, unlike on the equity side, where you have to be correct not just about the trajectory of this investment playing out, but also the timing of it, I think we're much more comfortable on the corporate credit side with these very high-quality issuers.
It raises an issue, though, of the change in composition of the overall investment-grade debt market. You've seen a record, some $66 billion, or a significant amount of issuance from these tech companies. The AI-related IG issuance so far this year, this according to Torsten Slok, has jumped from 70% in 2024 to 14% in 2025. Does that make you think again about the concentration risk of the investment grade index?
It definitely does. And not just the concentration risk within investment grade corporate credit, but more broadly across the economy as a whole. We know that so much of the equity market growth has also been driven by this investment in AI and data center infrastructure development. We know that that in turn has been driving some of the consumer spending, the higher income cohorts that have seen their wealth portfolios grow with this market growth. All of that hinges back to this strength of AI and the heavy investment in AI infrastructure development and data center build out and so forth. So I do think it is concerning. We have a lot of eggs in the same basket here.
Laura, good morning. It's Guy in London. Do you think, given the scale of the issuance that we are going to see, that yields will remain higher?
I think there are concerns around the demand for the ability of the market to absorb the increased supply. I think that we could see spreads under pressure a bit. I think, we don't have an outlook for a fundamental a recession per se, but I do think the increase in supply and the amount of demand that has to be created to absorb that supply specifically around AI and data center investment, I think we could see spreads come under pressure. So I think that, all-in yields could be a bit inflationary as far as, driving prices and pressuring prices.
Yeah. How careful are you being? Like, what's the difference between Oracle and Amazon? What's the difference between Oracle and Alphabet? How careful do I need to be in terms of which corporates I'm looking at?
I think it makes a big difference. You're talking as far as leverage, as far as credit quality, diversification of revenue sources. I think, we're being very particular in terms of how we participate in the hyperscaler credit specifically. That's a much different risk profile than in some of these asset-specific deals in the securitization market, for example, where your outcome and your credit risk is hinging on the success of one particular asset. That's a very different risk profile. Similar with the equity side. I think, we're very comfortable at the corporate credit level. These are very high quality AA rated companies that are investing in this next leg of IT progress. And I think that there's a very valid case for that. But on the equity side, again, you have to be much more careful and much more certain about not just the trajectory, but the timing of monetization of those investments.
So earlier this year, Google sold some $25 billion of corporate bonds, including a 50-year tranche. And we were wondering who's going to buy a 50-year batch of bonds from Alphabet, which has had a changed business model. Yes, it's been a sticky company and has a huge revenue stream. You might have been one of those buyers. Is that right?
Yes, we've been favorable on some of those longer duration issues from the very high quality hyperscalers. We have long duration needs across some of our portfolios, and with valuations being very tight, we're underweight. But we like that high quality supply for some of those longer duration needs that we have to fill.
How much, just going forward and stepping back, aside from just the AI story, do you see disruption in the market, in the economy, that will cause an acceleration of bankruptcies, akin to what we have seen over the past year, frankly, although stealthily? Do you think that's going to pick up even without a turn in the economic cycle?
I think there is risk of that. And, one thing working in our favor right now, I think, is actually the limitation of power availability. I think that's providing a bit of a governor on our ability to overbuild. But I do think there are risks. There's so much capital going into these infrastructure developments, and some of it is being funded privately. So we don't even have, the entire market is exposed to that, but we don't all have the transparency to see how those assets are performing. So I think there is risk that we get out over our skis a bit. And some, Steve Eisman likens it to the build out of the railroad industry, where you had, in some cases, developers building out railroad infrastructure side by side in competition. Some failed and some succeeded. And I think we could see some of that. So I think the question is, with the entire economy, so much of GDP growth is coming from data center investment and also consumer spending, which we know consumer spending is concentrated in that higher income cohort, which has been supported by wealth growth from market acceleration. Also, hearkening back to data center investment, it's like a Jenga tower. All stemming, the very bottom row is all this AI and data center capex. So I think it is very possible, it doesn't take much disruption to have quite a few domino effects that are going to impact the market in a more holistic way.
Laura Mayfield, thank you so much for being with us this morning. Have a wonderful new year. Laura Mayfield of Fort Washington Investment Advisors. As people look to concentration risk, Guy, it's not just in equities, it's not just in bonds, it's frankly in the economy too, as we try to understand the low hire, low fire dynamic and what exactly is going to be going with that.
It's a really confusing market, isn't it? But at the moment, everybody's on the same side of the boat. Everybody's going into next year looking super positive. You talked about where are the vigilantes earlier? Where are the bears in these markets as well? It's too big a ride to get off at the moment. The question is, when it is time to get off, how quickly can you do it?
And that's what we're going to be talking about coming up. Dana Doria of Envestnet, Nicole Bichot of ZipRecruiter, Bloomberg's Enda Curran, and Tyler Bowley of Bank of America Institute as we look to the final days of 2025. This is Bloomberg Surveillance. Good morning.
There's going to be a meaningful correction at some point over the course of 2026.
We want to make sure we're managing risk well next year.
What the market is saying is that earnings matter more than ever right now.
It is encouraging that we are seeing broader participation in the rally.
Investors need to be ready for surprises and the unexpected.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks seeking direction heading into the penultimate day of trading this year, with silver and gold rebounding after yesterday's brutal session. Tech companies keeping busy to end the year, with Meta the latest to make an acquisition, and all eyes on the U.S. economy with some jobs data out in about 15 minutes time. And tomorrow we get jobless claims, all of that possibly shedding light on what to expect in 2026. Jai Jansen joining us from London this morning. I'm in New York. John and Anne-Marie are both off this week. A real question here, Kai, about how much clarity we can get into 2026 amid a pretty murky backdrop economically.
There's so many things that are unclear at the moment. What happens with the Fed next year? What's going on with inflation? What does that mean in terms of the dollar? Is Europe really going to spend? What is happening on the geopolitical front? There are multiple wars that are still raging that could also catch light and go further. There's so much uncertainty going here. It is stunning that the US economy remains as strong as it is. Is that down to big tech? It is stunning that asset prices remain as elevated as they are. How much volatility are we going to see next year?
Right now, not a whole lot, at least not in the equity space. We saw a little bit of a dip yesterday and the day before, although we are seeing stocks near all-time highs. S&P futures going nowhere, no volatility there, no action there. You are seeing a bit of dollar strength reassert itself. The euro down just 0.1%, 117.61. Bond selling off. Watch the space because it has built throughout the morning, up about 3 basis points on the 10-year yield to 4.14%. And silver, if you want action, if
If you want excitement, check out the metals market. Silver up 5.7% after yesterday's biggest one-day loss going back more than 5 years. Silver and gold, best years going back to 1979. Copper experiencing its best year going back to 2009. What is the metal space telling us? Meanwhile, what we are expecting this week, today and tomorrow in particular, we're going to be getting that ADP weekly labor market indicator in about 13 minutes time. That will come out. We'll break that down. Then, of course, at 2 p.m. this afternoon, we do get Fed meeting minutes. Jobless claims come out tomorrow at 8:30 a.m. Eastern. And then everybody takes a well-deserved break on Thursday for New Year's Day. Coming up this hour, Dana Doria of Envestnet, as stocks aim to avoid a 3-day losing streak. Nicole Bichot of ZipRecruiter previewing the labor market for 2026. And Taylor Boley of Bank of America Institute looking back at the top 5 themes from this past year, dissecting what the consumer could be telling us. We begin this hour with stocks going nowhere as traders trim bets on mega cap tech stocks heading into the end of 2025. Dana Doria of Envestnet joins us now. Dana, you did some work on what a Santa rally actually is, looking at how often you usually see gains. Why is it not working this time around?
Yeah, unfortunately, it's not. I mean, of course, we have nothing to complain about, right? That this has been another double-digit year. And, you know, the economy has remained very strong in spite of kind of taking some crazy hits when we look back across the course of the year. So we may not hit that 20%. It's not looking good at this stage of the game, but it's still been a phenomenal year in markets. And I think, you know, it might be too much to expect at this point, you know, and stocks don't really have a catalyst, right? There's, you know, to your point on, you know, kind of Fed meeting minutes coming out later this afternoon, we'll get some interesting content there, but, you know, and jobs report coming out. But I mean, where things stand today, there's not a huge amount that's going to happen in the course of this week that's going to kind of drive stocks forward. I think we probably have to be happy with the phenomenal performance we already received this year.
That probably is too much to ask for people waiting for extra gains to put into their stocking at year end. There is this question, though, about whether we are seeing a true rotation. And that's what you're seeing this morning on the margins. I mean, it is tepid, let's be honest. It's not exactly an active trading session, but you are seeing the outperformance come from the Russell 2000. And you have seen that over the past 3 weeks. Is that something you can kind of sink your teeth into and say it has lasting power?
We'll see. We certainly have economic data at this point that suggests that the Fed saying that there's one rate cut coming next year is low, right? We know Fed funds futures already thinks that, you know, we're going to have more than that. If employment keeps weakening, if inflation kind of stays somewhat cool, it's hard to imagine that the Fed doesn't cut more. And if the Fed cuts more, that's great for small caps. And so I think to a certain extent, some of that might be filtering into, you know, the expectation set for that part of the economy. Look, I'm a strong believer in having that kind of diversification in the portfolio to begin with. I mean, obviously, large caps have outpaced small caps this year. But I think if you take a step back and look from just a broad diversification theme, we've had a phenomenal year for diversification, right? International, developed, emerging market stocks, 30 plus returns. So as good as it's been in the US market, if you had a diversified outlook in your portfolio, you probably did better. And small caps are around 15%. This is not a bad outcome, right, for spreading your dollars, spreading the risk a little bit, particularly when we know the large cap index is so concentrated. It's so heavily dependent and top heavy on, you know, certain stocks. So whether we're rotating into small caps or, you know, we're seeing some of the effect of interest rate chatter, I think it's a great thing to have that kind of diversification in your portfolio.
Dana, let's dig into that a little bit more. Does the dollar continue to weaken in 2026? You've just talked about the fact that maybe the Fed continues to cut. That would imply maybe it does.
Yeah, for sure. I mean, obviously, the dollar's been kind of a release valve here over the course of the last year. And, you know, notwithstanding that, you know, we don't know for sure what's happening with inflation, right? We see a report that came out. The data, we know because of the shutdown, the data, there's questions around that. We want to get back to a place where we're collecting data very effectively, efficiently as we used to, and getting what we feel is a really solid look at what inflation is doing. And that's obviously going to have a huge impact on where the dollar goes in 2026. But for sure, you know, to the extent that we have interest rate cuts, you know, and by the way, this is just sort of to a large extent getting the U.S. on pace with the accommodative policy we've seen in the rest of the globe, you know, throughout the year as well. So this isn't, you know, it's not to say that this is deterministic, but we have to see where inflation goes. And yes, interest rate cuts, of course, if they're significantly more than expected, will have that impact.
Dana, you talked about the diversification trade. In dollar terms, if I'm a dollar investor, I've made 30% in the FTSE 100 this year, 25% in the CAC 40. The DAX has delivered nearly 40%. The Spanish market has delivered nearly 70%. Are those kinds of numbers for US investors going to be available next year? How much emphasis do I need to put on the ex-US part of my portfolio?
I think, the starting point from an academic perspective, right, if nothing else, first principles here, the starting point is what is the global ratio, right? So MSCI ACWI, All Country World Index, that gives me a great starting point for where I potentially want to have international stocks. Now, of course, coming from a place where it's retail investors, it's advisors needing to keep clients disciplined in their portfolios, which is sort of job number one, you have to measure that to a certain extent. If US is gangbusters next year, and they're measuring against the S&P 500 index, it may be hard to keep them in place if international stocks don't deliver. So to a certain extent, there's a behavioral question here around how much can the person tolerate? What are they looking to as the benchmark against that portfolio? If they're looking to a world index, I think the starting point being the world, that ACWI index that includes emerging markets. But if they're not, if they're really tied to a US view, then maybe you have a little bit of a reduced, diversification hedge there with international, but it's not as big in the portfolio as it otherwise would be because the client just, if US does poorly, they're expecting their portfolio not to do as well. But if US outperforms, it's tough for them to kind of stay put. And, these are just kind of the behavioral considerations. And I'll again say, I think small caps have a place. Both small caps and value stocks over time have outperformed. We haven't seen a lot of that in the last several years, but I think some of these fundamentals, these first principle fundamentals, are good not only for the potential to outperform over the long haul, but also for diversifying, again, what is a very concentrated, top-heavy, index at this point. And most people have that in their portfolios, right? Unless you have massive tracking error to the index, you have a ton of AI trade, right? A ton of big tech.
Well, the diversification trade has sort of taken on new meaning every single year as people try to decry the death of the 60-40 portfolio. I just wonder how much you have seen a true shift toward precious metals as a diversifier at a time where you've seen an incredible run so far this year.
Yeah, no doubt. People it was this barbell kind of approach, right, to how people were putting portfolios together. And so I want to not miss out on the AI trade, but at the same time, the ballast in my portfolio becomes gold or even silver now at this point. I do think what's happening in the retail space as well is more diversification into these sort of alternative asset classes. And a lot of that is happening because of product innovation in the space. So not only commodities, not only precious metals, but private equity, private credit in particular. And a lot of that's happening because there's vehicle availability that allows retail investors through things like interval funds. These are point and clicks. You can't get out of the fund as quickly as you can a standard mutual fund, but you can get in and you can get access to a different return stream. We all know there's correlation there. It's the mark to market that kind of makes that correlation look lower than it is. But at the same time, you are getting access to companies that you're not going to get in the public equity markets. And so what we're seeing in the retail space is massive interest in sort of, to your point, diversifying that 60-40 and doing it with alternative assets now that they're more accessible to the average client.
Dana Doria of InvestNet Solutions, thank you so much for being with us. Happy New Year to you. Right now, let's turn focus and get an update and stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burden. Lizzie.
Hi, Lisa. President Donald Trump reiterating that he'd love to fire Fed Chair Jay Powell. Trump saying he might still fire him for, quote, gross incompetence. Trump came close to seeking the Fed chair's ouster in July, of course, but backed away after a negative reaction in financial markets. He said he'll probably announce his pick for Fed chair in January, and his preferred candidate hasn't changed. Elsewhere, tensions are escalating in the Arab world after a Saudi-led coalition carried out airstrikes on a port in Yemen. The strikes targeted a weapons shipment from the UAE, which is supporting armed groups in the south of the country. Saudi Arabia told the UAE to withdraw its forces and halt its support, saying its actions are highly dangerous. And a high-speed railway company, Eurostar, has indefinitely suspended its cross-channel train services between London and continental Europe due to an overhead power supply problem. The company has strongly advised companies to postpone their trips to another day, despite this being the peak travel season. That has been my brief. Lisa.
Thank you so much, Lizzie. Up next, the weekly ADP employment data set to cross in just about 3 minutes' time. Nicole Bachot of ZipRecruiter with us to break down the state of the labor market. That's next. This is Bloomberg Surveillance. Good morning.
If Powell chooses to stay, which would be historically unprecedented, then it will mean that there's probably less willingness to cut rates aggressively. If he leaves, it'll give the Trump administration one more seat in which they can potentially remake that committee and potentially then advocate for lower rates. History would suggest that Powell will step down, but this is indeed his decision.
That was Mark Cabana of Bank of America as the race to replace Fed Chair Jerome Powell heats up. That conversation ongoing. The likely successor to be announced probably early next year. Right now in markets, you are seeing a churn across the board. Equity futures going nowhere, at least at S&P and NASDAQ, essentially flat. You are seeing yields higher, though. Watch the space. 2 basis point increase on the 10-year yield, 4.13% in silver, gaining almost 6% after yesterday's sell-off of the biggest going back to 2020, as a real question emerges about what silver and gold are coming up. For time now for the morning calls. First up, Baird reiterating its outperform rating on Tesla with a $548 price target. The firm recommending owning the EV into the new year. It continues viewing the company as a core holding. Those shares up 0.8% despite discussion currently about waning demand. Next up, Raymond James removing Shake Shack from its analyst current favorites list, given softer industry trends through the fourth quarter. Raymond James continues to have a strong buy rating on the shares with a $150 price target. Those shares lower by 2.2% in pre-market trading. And finally, Barclays raising its price target on Johnson & Johnson to $217 from $197 and keeping an equal rate rating on the shares. The firm seeing upside to Q4 consensus estimates. Those shares essentially flat. Turning to the economy, weekly ADP employment data not crossing yet. Bloomberg's Enda Curran joining us now. And hard to know what to do with this data, but heading into this, how clear of a look have we had on the U.S. labor market picture?
It's obviously a volatile period right now, at least as you know, around the holidays between the ADP today, of course, the initial jobless claims tomorrow. There's lots of noise in those figures. What we do know, though, is that clearly the labour market has been softening. We had the official read recently showing the unemployment rate went up to 4.6%, the highest in a couple of years. But still, where the tension in this story is, Lisa, is over whether or not we are now seeing a significant slowdown with broad-based layoffs, or whether it's still kind of isolated, pocketed examples of, even though they're well-known brand-name companies announcing job cuts, that's not necessarily translating into wide-scale job losses in the broader labour market. So I think right here, right now, the story hasn't changed much over the last couple of months, really. It's that, yes, the labour market's softening. We know that policymakers are worried about it, but the big debate going into 26 is just how weak it is. And that won't be resolved, I think, in the near term by these private sector data.
Well, the private sector data is supposed to come out at 8:15. Hasn't come out yet, but we will catch you up on it as it does potentially cross and occur, and stay close as we do wait for those numbers. So turning to the labor market picture, we want to speak with Nicole Bachot of ZipRecruiter, who wrote, "The low hire, low fire environment that defined much of 2025 will persist into early 2026, but with a crucial difference. Employers are preparing for growth, not just survival." Nicole joins us now. Nicole, thank you so much for being with us. So let's get into that, this idea that you could start to see a revival of a labor market that has been pretty moribund for the second half of this year.
Whatever movements we see in 2026 will be gradual. This is going to be slow and steady wins the race here.
instead of any sort of dramatic surge that could reignite inflation pressures, we will see hiring activity slowly start to pick up as clarity kind of comes into view around policies like inflation and tariffs and how these factors are going to continue to impact employers into the new year.
Nicole, who's going to be employed in this next phase? Is it going to be graduates? Is it going to be workers on AI data centers? Kind of where is the growth going to come from?
We're not seeing AI really reshaping where people are working. We're really seeing AI right now impacting the labor market in how certain roles are showing up. Workers who are able to utilize AI to increase productivity, to streamline their processes, that's where we're going to see the most demand. And we're already seeing employers start to focus on upskilling their current workforce, and employers who are able to remove unnecessary barriers to make it easier to integrate AI into their workflows and to train employees on how to use those tools properly. Yep. That's where we're going to see the biggest hiring bumps into the new year, is employers who are really going to be able to take advantage of those movements. When we look at the new grad side of the house, we have seen, obviously this is a really challenging labor market for new entrants. There is evidence from some surveys that we've done at ZipRecruiter that employers are eager to hire more new grads into the year, more early talent into their pipeline that has kind of been missed over the last couple of years, as focus has been shifted away from those higher tenured roles into earlier processes in the labor market.
What does this mean for wages?
Wages will likely start to stagnate across 2026. We've seen wages and inflation kind of converging together over the past several months. As inflation continues to cool, wages will likely continue to come down from where they're at. We saw around 3.5% annual growth in the last labor market readout, and we'll likely see that continuing to slip a bit into 2026 as well.
How much, Nicole, are we starting to see the employment picture move away from healthcare and some of these defensive areas that need bodies and go to more growth areas? I'm thinking of services. I'm thinking of manufacturing. Are you starting to see any of that shift whatsoever?
Quite the opposite. We're still seeing healthcare being the dominant industry, as well as construction and other manual labor and skilled labor trades. Healthcare is going to continue to dominate throughout 2026 and beyond, especially as the U.S. population continues to age. There will be more demand for healthcare services, especially support roles like nursing and home health aides, as we're seeing the population demographics kind of point towards a more bulk in that workforce for the future. So we will continue to see those manual and skilled trades kind of pushing up the labor market, and the cyclical cycles of industries where we look at manufacturing and retail, those are going to continue to stay stagnant while employers are figuring out how tariffs are really going to be impacting their business lines moving forward.
Taking a step back, Nicole, when we take a look at 2025, a lot of people will say this was the year when suddenly the labor market was buffeted by a secular trend with artificial intelligence and companies not wanting to hire particularly entry-level jobs in entry-level positions because they could see potential efficiencies with technology. Do you have any evidence to back that up? Do you think that that's going to become an even greater story in 2026?
I don't. And I don't know that there's a lot of evidence that really points to AI being the actual reason, whether that's in the headlines or not, being the actual reason for a lot of the slowdowns in hiring we've seen. It's a convenient excuse for low hiring, given a lot of the other factors going on in the macro environment that are impacting businesses right now. When we look ahead to 2026, there's a lot of room for AI to continue to reshape how workers show up to their jobs, but there's so much work that's not able to be taken over by AI, especially not where we're at right now. So this is still going to be a gradual pickup to where we see AI really, hitting its stride and taking over a lot of the automated tasks in the workforce, but that's not necessarily what we're seeing right now.
Nicole, the Fed has delivered a series of rate cuts, which were labeled insurance cuts, insurance about relating to a labor market that was apparently slowing down. A, were those insurance cuts required? And B, if they were required, what effect have they had?
Unemployment has been rising throughout the second half of 2025. So the cuts intending to stabilize unemployment, did come at the right time. But the goal of those cuts is to stimulate more hiring activity, and we have not seen that happen yet. We haven't seen businesses be able to translate those lower rates into actual hires and more job growth. That hopefully will come in the next couple of months. This is also coming at a really challenging time, as you all know, with this big kind of data blackout and murky data situation due to the government shutdown. So as we look ahead to next week, where we're anticipating a new jobs report and JOLTS report to look at how openings and job growth look towards the end of this year, that will really help to clarify, whether or not we're actually seeing those cuts do what they're intended to do, or if we're still seeing a lot of stagnation as tariffs and sticky inflation continue to take hold of employers.
Nicole Pichot of ZipRecruiter, thank you so much. And a quick note.